Welcome to Trade Like an O'Neill Disciple, the audiobook that brings William J. O'Neill's legendary trading principles into the 21st century. Whether you're a seasoned trader or just starting your journey in the markets, this book is designed to help you think like one of the greatest investors of all time, without needing years of trial and error. William J. O'Neill, founder of Investors Business Daily and pioneer of the CAN-SLIM investing system, left behind a blueprint for identifying high-probability stocks that rise dramatically. Today's markets are faster, more data-driven, and infinitely more complex. That's where Gil Morales and Dr. Chris Casher come in. In this audiobook, they don't just explain O'Neill's original ideas, they expand on them with modern strategies, advanced technical analysis, and actionable insights for navigating the volatility of today's trading environment. You'll learn how to spot powerful price patterns like cup with handle formations, leverage momentum indicators, and apply relative strength analysis to find stocks poised for explosive growth. But here's what makes this audiobook truly unique. It's not just theory. Morales and Casher break down every concept with real-world examples, step-by-step trade setups, and the disciplined mindset needed to succeed in a market that rewards patience and precision. Who should listen? This is for any trader or investor looking to refine their strategy, whether you're new to quantitative trading, familiar with CAN-SLIM but want to level up, or even an experienced trader seeking fresh perspectives on momentum and institutional behavior. If you've ever felt overwhelmed by the noise of the market, this audiobook will help you cut through it with clarity and confidence. So grab your headphones, find a quiet moment, and let's dive into the principles that have made O'Neill one of the most successful traders in history, and how to apply them today. Your journey to mastering the markets begins now. Let's get started.
Trade Like an O'Neill Disciple. How we made over 18,000% in the stock market. Chapter 1. The Evolution of Excellence. The O'Neill Trading Method. As portfolio managers who once ran money for William J. O'Neill, we have observed that a meaningful portion of the O'Neill body of thought is derived from the philosophies of those who preceded him, particularly the works of Richard Wyckoff and Jesse Livermore. When it comes to market thought, you can never entirely understand Bill O'Neill until you have read and understood these two gentlemen. Obviously, the techniques and philosophies of the famous trader Jesse Livermore, as presented in the classic Reminiscences of a Stock Operator by Edwin Lefevre and Livermore's own How to Trade in Stocks, figure heavily in the underlying pulse that governs the way Bill O'Neill and his stable of portfolio managers trade. Richard Wyckoff, as one of the first to write about Jesse Livermore in his original work, Jesse Livermore's Methods of Trading Stocks, espoused much of the common-sense investment philosophies and maxims that have found their way into the writings and investment thought of William J. O'Neill. Even Nicholas Darvas, in his famous book, How I Made $2 Million in the Stock Market, Carroll Publishing Group, 1998, laid the foundation for O'Neill's chart bases with his own boxes, which he described as simply normal consolidation channels within which a stock's action was judged to be normal or abnormal. Themes that echo from Wyckoff, Livermore, Darvas, and others weave the essential fabric from which O'Neill-style investment methodologies are cut. These methodologies utilize the work of O'Neill's predecessors by bringing into play the time-tested characteristics of winning stocks that O'Neill painstakingly identified, analyzed, cataloged, and verified in his numerous model book studies, some of which your authors had the privilege of producing and contributing to. By sifting through the best-performing, institutional quality leading stocks in each and every type of market cycle, O'Neill identified their key common characteristics, the most basic of which provided the genesis for O'Neill's unique stock selection template, commonly known to the investing public as CAN-SLIM. Certainly, O'Neill owes a debt to the thinking of Livermore, Wyckoff, and others, and the roots of the O'Neill investment methodologies run deep in this regard. However, as former portfolio managers for William O'Neill Plus Company, Inc., we can vouch for the fact that such roots do not imply that O'Neill simply copied his predecessors. That would be a gross oversimplification, since the truth is that the O'Neill methodologies took the thinking of these outstanding stock market investors from the past to a much higher level by bringing greater clarity to the process, as he formulated a concrete, concise, and practical approach to making money in the stock market. The parallels between O'Neill and his predecessors provide an overarching backdrop to a general philosophy, a certain ethos, if you will, toward the market that is more than just Livermore's or Wyckoff's or even O'Neill's. As O'Neill himself used to tell us, it's not my system. It's the market's, because it is based on how the market actually works. In this manner, O'Neill simply sees his own work as furthering the basic process of understanding the market through observation and the application of common sense rules gained thereby. It is nothing more or less than understanding all the small realities that make up the stock market. Reviewing how O'Neill has taken and expanded upon the works of his predecessors is a useful exercise and sets the backdrop for much of the research we have done to further our approach to the O'Neill/Livermore/Wyckoff approach to the market, and which is one of the main topics of this book. Preparation, study, and practice. Don't dabble in stocks. Dig in and do some detective work. William O'Neill, How to Make Money in Stocks, 2nd edition. New York, McGraw-Hill, 1995, 34. This is the essential premise of O'Neill methodologies. They are in no way, shape, or form intended as a panacea for making money in the market. Human beings are complex organisms, and so represent the greatest variable in the implementation of any investment methodology, whether of O'Neillian origin or otherwise. This is why O'Neill insists that one must put in the time, effort, and work required if one intends to become a successful stock market investor. Human nature being what it is, 90% of the people in the stock market, professionals and amateurs alike, simply haven't done enough homework. O'Neill laments the fact that so many investors are looking for some magic formula that enables them to produce an optimal result in the stock market with little or no effort. In The Successful Investor, he laments the rise of the individual investor during the dot-com bubble market of 1999. Most people, both investors and advisors, got hurt in the 2000 to 2002 downturn because they never took the time to learn sound investment rules and principles. In the 90s, they thought they'd found a way to make money without doing much homework. They just bought tips, touts, and stories. William J. O'Neill, The Successful Investor, New York, McGraw-Hill, 2004, Roman 12. While most investors do not hesitate to dabble in the markets, they would rarely dabble in medical or legal practice, or even in playing professional baseball. O'Neill reminds us, however, outstanding stockbrokers or advisory services are no more frequent than our outstanding doctors, lawyers, or baseball players. William O'Neill, How to Make Money in Stocks, 2nd ed. New York, McGraw-Hill, 1995, 256. This is not too far off from Richard Wyckoff's astute observation that a person becomes competent in other fields because he has generally gone through a long period of practice and preparation. A physician, for example, goes to college, attends medical clinics, rides in an ambulance, serves in hospitals, and after some years of preparatory work hangs out a sign. In Wall Street, the same MD would hang his sign first, then proceed to practice. Richard Wyckoff, How I Trade and Invest in Stocks and Bonds, New York, The Magazine of Wall Street, 1924, 159-160. Investing is hard work, and an investor requires no less preparation and expertise than any other white shoe professionals practicing their craft, whether it be law, medicine, software design, movie-making, or otherwise. Jesse Livermore became annoyed when he was approached by friends or acquaintances who would ask him how they, too, could make money in the market. Biting his tongue, Livermore's answer eventually evolved into a curt, "I don't know," as he found it difficult to exercise patience with such people. In the first place, the inquiry is not a compliment to a man who has made a scientific study of investment and speculation. It would be as fair for the layman to ask an attorney or a surgeon, "How can I make some quick money in law or surgery?" Jesse Livermore, How to Trade in Stocks, Greenville, Traders Press, 1991, 15. While reminding investors that success can only be achieved by hard work and persistence, O'Neill, always the optimist, makes it plain that success is within the reach of anyone willing to make the effort, and in his book, How to Make Money in Stocks, 2009, 9, He urges us all on with a touch of self-sufficient idealism. The American dream can be yours if you have the drive and desire and make up your mind to never give up on yourself. But O'Neill insists from the start that, as Wyckoff wrote, anybody who thinks he knows of a shortcut that will not involve sweat of the brow is sadly mistaken. How I Trade and Invest in Stocks and Bonds, New York, the Magazine of Wall Street, 1924-93. Buy expensive, not cheap stocks. Like Livermore, O'Neill despises a lazy approach to the market because it results in one trying to take what is perceived as the easy route to stock market riches. Nowhere else is this more embodied than in the idea of buying stocks that are cheap. This age-old trap is easy to fall into, since most novice investors approach the market with an incorrigibly ingrained consumer mentality that views anything selling today at a lower price than it was yesterday as a bargain. This is perhaps because the individual investor views herself as a consumer in point, when in fact, the investor should act like a business that purchases raw or finished goods and intends to turn around and sell them at a higher price. Hence, O'Neill's story about red dresses and yellow dresses, where the slower-selling yellow dresses are marked down by the store owner to get them out of the portfolio, otherwise known as the store inventory, so that more of the hotter-selling red dresses can be purchased and resold at higher prices. O'Neill advocates buying stocks that are red dresses selling like hotcakes at all-time high prices. The reason for this is simple. Real leaders start their big moves by selling at new price highs, not near new lows or off a good amount from their highs. How to Make Money in Stocks, 4th ed. New York, McGraw-Hill, 2009, 426. In a contrarian sense, this is what makes the concept of buying stocks at new highs so effective. It is simply not obvious to the crowd, who fear buying a stock that looks to be selling at such a high price, because, as O'Neill points out, what seems too high in price and risky to the majority usually goes higher eventually, and what seems low and cheap usually goes lower. 2009, 174. The market tries to fool the majority of investors the majority of the time, so if new high prices in a particular stock make the crowd timid about buying it, then that is likely the precise time to be buying the stock. Like O'Neill, Jesse Livermore appreciated higher-priced stocks far more than cheap stocks, advising, one should never sell a stock because it seems high-priced. Conversely, never buy a stock because it has had a big decline from its previous high. The likelihood is that the decline is based on a very good reason. That stock may still be selling at an extremely high price relative to its value, even if the current level seems low. Jesse Livermore, How to Trade in Stocks, Greenville, Traders Press, 1991, 25. Averaging down. Trying to buy cheap stocks is but one frequent sin committed by novice or lazy investors. Another lazy man's sin eschewed by O'Neill and his predecessors is the concept of averaging down. Richard Wyckoff observed, a great deal of money is lost or tied up by people who make a practice of averaging. Their theory is that if they buy a security at 100 and it goes to 90, it is that much cheaper, and the lower it goes, the cheaper it grows. Retail stockbrokers, when in need of a way to avoid taking responsibility for a bad recommendation, often try to use averaging down as a way to justify the initial decision to purchase a stock at higher prices. To some extent, this evolved as a convenient corollary to the retail investment concept of dollar-cost averaging when purchasing mutual funds, about which we're sure many readers are only too familiar. To O'Neill, this is shameful. About the only thing that's worse is for brokers to take themselves off the hook by advising customers to average down. If I were advised to do this, I'd close my account and look for a smarter broker. How to Make Money in Stocks, 4th ed. New York, McGraw-Hill, 2009, 247. Jesse Livermore was no less harsh in his assessment of the averaging down technique when he said, "It is foolhardy to make a second trade if your first trade shows you a loss. Never average losses." Let that thought be written indelibly upon your mind. How to Trade in Stocks, Greenville, Traders Press, 1991, 26. Richard Wyckoff took the concept just a little bit further by adding, "It is better to average up than to average down." Stock Market Technique number 150. And as we know, O'Neill contrasts his sermons against averaging down by strongly advocating averaging up on one's winning stocks, cutting losses quickly. Jesse Livermore wrote in How to Trade in Stocks, "You should have a clear target where to sell if the market moves against you. And you must obey your rules. Never sustain a loss of more than 10% of your capital. Losses are twice as expensive to make up." I always established a stop before making a trade. How to Trade in Stocks, Greenville, Traders Press, 1991, 171. O'Neill advises a 7 to 8% automatic stop-loss policy on all stock purchases, and the main reason for this is to keep oneself out of danger. Huge losses in the market can be debilitating, and O'Neill views a strict stop-loss policy, whether at his threshold of 6 to 7% or Livermore's 10%, as absolutely necessary for survival in the stock market. Livermore observed, "Taking the first small loss is wise. Profits take care of themselves, but losses never do." 1991, 7. Richard Wyckoff in Stock Market Technique No. 1 advised, "Your first line of defense is a stop order placed when you make the trade or immediately thereafter. If you fail to limit your risk at inception, make a practice of looking over your commitments every day or twice every week and selling out at the market, all showing a loss. That will keep your sheet clean and allow your profitable trades to run until the time comes to close them out." 1933, 96. This concept of using a stop-loss as a line of defense runs parallel to O'Neill's thinking that letting your losses run is the most serious mistake made by almost all investors. How to Make Money in Stocks, 2nd ed. New York, McGraw-Hill, 1995, 93. Simply because, if you don't sell to cut your losses when you get into trouble, you can easily lose the confidence you'll need to make buy and sell decisions in the future. 1995, 252. Not only do losses cut into the capital an investor has available to capitalize on potential opportunities in the stock market, they also take their toll on an investor's psychological capital, their all-important self-confidence. To O'Neill, Livermore, and Wyckoff, losses are just part of the process, and it is always better to take a little pain now rather than a lot of pain later, because, as O'Neill reveals, the whole secret to winning big in the stock market is not to be right all the time, but to lose the least amount possible when you're wrong. 1995, 240. Taking profits too soon, letting your winners run. The O'Neill methodology is essentially a trend-following system. You want to be in the market when the trend is in your favor, and you want to capture a large portion of any trend by riding with it for as long as possible. To O'Neill, buying a winning stock is only half the problem, because the key to capitalizing on a big price move in any potential, big, winning stock is in how you handle the stock once you have bought it. As Livermore said, "It is the uncommon man who can sit tight and be right." So sitting with and properly handling a meaningful position in a big, winning stock through the bulk of its upside price move is a big part of how O'Neill makes big money in the stock market. This necessitates adhering to a basic principle that Livermore stipulated when he said, "As long as a stock is acting right and the market is right, do not be in a hurry to take a profit." How to Trade in Stocks, Greenville, Traders Press, 1991, 21. You can't make big money in stocks if you don't give them a chance to make big money for you. O'Neill recommends take your losses quickly and your profits slowly, because your objective is not just to be right but to make big money when you are right. How to Make Money in Stocks, 4th ed. New York, McGraw-Hill, 2009, 247-272. Trading for quick profits requires that one be constantly active and thinking about the next trade. It is a notoriously busy way to approach the market, and is entirely out of sync with the ideal that O'Neill-style investing tends toward. In our experience, there is nothing easier than making big money in the market once you have latched onto a big winner, because at that point, all you are doing is sitting more and thinking less. When your stocks are trending nicely to the upside and you are fully invested, there is, from a practical standpoint, very little to do. You are simply letting your winners run. This is what we like to call being in the zone, a mental space that derives from Livermore's principle. It never is your thinking that makes big money. It's the sitting Edwin Lefevre, Reminiscences of a Stock Operator, New York, John Wiley and Sons, 1994, 68. Richard Wyckoff had his own unique perspective on the idea of cutting losses quickly and letting winners run when he wrote in Stock Market Technique Number 1, "Are you getting rich backwards? Then you are taking 2 points profit on your speculative trades and letting your losses run. Why not reverse this rule? Limit your risk to 1, 2 or 3 points and let your profits run." 1933-52. Position concentration. A big part of handling a winning stock correctly is properly scaling one's position size. If you only want to make average market returns, then scale your positions to a very small size, and your portfolio will act very much like a market index. Having scores of positions is nothing more than closet indexing. Most mutual fund managers take positions that make up 1 to 2% of their portfolio equity or less, and they may have 100 to 200 positions or more. To O'Neill, this is anathema. If you want to make big returns, then you absolutely must concentrate your capital in a strongly trending stock, and position sizes of 1 to 2% of one's total portfolio equity are, to put it bluntly, quite wimpy from an O'Neill perspective. The O'Neill method of pyramiding into strongly acting positions while weeding out weaker ones generally gets an investor concentrated in the right stocks during a bull market cycle. At times, your authors have been fully invested in as few as 2 stocks, using full 200% margin, so that each position represents 100% of the account's gross equity. This is how you make big money in the market, and it is the essence of handling one's stocks properly to achieve maximum effect. For this reason, O'Neill eschews diversification and cites the wisdom of Gerald Loeb, who declared that diversification was a hedge for ignorance. O'Neill's solution was to be very specific about what stocks one owned in any bull market cycle, suggesting, the more you diversify, the less you know about any one area. Many investors over-diversify. The best results are achieved through concentration, putting all your eggs in just a few baskets that you know a great deal about and continuing to watch those baskets very carefully. How to Make Money in Stocks, 4th ed. New York, McGraw-Hill, 2009, 274. The purpose of position concentration from an O'Neill perspective is twofold. On the one hand, it allows an investor to fully capitalize on a big price move in a winning stock, while on the other it allows the investor to focus his or her attention on fewer eggs, which O'Neill views as a safer mental approach than trying to keep track of too many positions at once. Even Livermore himself thought that it is dangerous to start spreading out all over the market. By this I mean, do not have an interest in too many stocks at one time. It is much easier to watch a few than many. How to Trade in Stocks, Greenville, Traders Press, 1991, 33. To O'Neill, it is not necessary to own every stock in the market, to have a need to kiss all the babies, as he is fond of saying. He whittles it all down to one basic concept. The winning investor's objective should be to have 1 or 2 big winners rather than dozens of very small profits. How to Make Money in Stocks, 4th ed. New York, McGraw-Hill, 2009, 274. Dealing in Big Stocks and Institutional Sponsorship. Owning the biggest winners in the market means owning the stocks that institutions are piling into, and O'Neill sees modern-day mutual funds, hedge funds and pension funds, and other members of the institutional investor zoo as akin to the pools and trusts of Jesse Livermore's and Richard Wyckoff's era. It is the accumulation of stock by large institutions that produces the huge price moves upon which O'Neill methodologies seek to capitalize. And the smart institutions, such as those with the better research and stock selection skills, are the ones in whose footsteps you want to follow. O'Neill asserts, it takes big demand to push up prices, and by far the biggest source of demand for stocks is institutional investors, such as mutual funds, pension funds, hedge funds, insurance companies, etc. A winning stock doesn't need a huge number of institutional owners, but it should have several at a minimum. O'Neill continues, diligent investors look for stocks that are held by at least 1 or 2 of the more savvy portfolio managers who have the best performance records. How to Make Money in Stocks, 4th ed. New York, McGraw-Hill, 2009, 193-194. Knowing where the smart money is moving is central to O'Neill's methodology, and understanding the quality of institutional sponsorship coming into a stock is no different from what Richard Wyckoff advised when he wrote, "It is important to know whether large operators, inside interests, pools, or the public dominate the market for a certain security or group." Wyckoff went on to explain, "The reason this is so important is as follows. A combination of bankers will seldom be found on the long side of the market unless they expect a pronounced change in security market conditions in the near future. Their own purchases, therefore, are an indication of probable betterment. When a pool takes hold, it is usually in a certain one or a few issues which are likely to be favorably affected by developments known to a few but not generally known. How I Trade and Invest in Stocks and Bonds, New York, The Magazine of Wall Street, 1924, 183. O'Neill's unique and deep understanding of the institutional investor and the implications of institutional sponsorship is founded in the experience he has had advising some of the largest and most successful institutional investors on the planet. It is this understanding that generates what we have dubbed the big stock principle that drove O'Neill's thinking in any market cycle. Knowing which stocks represented the cutting edge of developments driving any particular economic, and hence market, cycle means knowing where institutional investors have to be with respect to positioning their portfolios. When institutional investors start shoveling money into stocks that they have to be invested in, this fuels tremendous upside price moves in those stocks, and it is what makes them big stocks. It is a central tenet of O'Neill-style investing. Chart patterns. Books like How I Made $2 Million in the Stock Market by the famous ballroom dancer Nicholas Darvas figure into O'Neill's concepts of bases, which Darvas termed boxes. O'Neill, however, took it quite a bit further with his colorful, descriptive cataloging of consolidation patterns or bases that he termed ascending. Cup with handle, double bottom, square box, flat base, and high, tight flag, among others. The chart patterns from which, as O'Neill observed, big, winning stocks emerged as they started their huge upside price romps. As well, these patterns represented the continuation that patterns hugely performing stocks form on the way up as they naturally and normally pause and digest their gains during an overall intermediate to longer-term price run before proceeding higher. Like O'Neill and his bases, Darvas's box theory emerged from his own direct observation and study of stock charts and tables. I started to realize that stock movements were not completely haphazard. Stocks did not fly like balloons in any direction. As if attracted by a magnet, they had a defined upward or downward trend which, once established, tended to continue. Within this trend, stocks moved in a series of frames, or what I began to call boxes. They would oscillate fairly consistently between a low and a high point. The area which enclosed this up and down movement represented the box or frame. These boxes began to exist very clearly for me. Nicholas Darvas, How I Made $2 Million in the Stock Market, New York, Carroll Publishing Group, 1998, 51. O'Neill is far more specific, however, about the precise structure of these boxes or bases, and his work goes into much detail about the exact shapes, durations, and magnitudes of these various price consolidation structures. But like Darvas, O'Neill recognizes, chart patterns are simply areas of price correction and consolidation, usually after an earlier price advance. The primary challenge in analyzing price consolidation structures is to diagnose if the price and volume movements are normal or, instead, signal significant weakness or distribution. How to Make Money in Stocks, 2nd ed. New York, McGraw-Hill, 1995, 161. It is, however, important to understand that Darvas's box theory is nothing more than a very rudimentary initial version of O'Neill's chart pattern zoo. Darvas never bothered to measure the minimum durations for his boxes to determine whether a longer duration was preferable to a shorter one. Nor did he measure the magnitude or range of these boxes to determine any meaningful characteristics thereby. As he puts it, I found that a stock sometimes stayed for weeks in one box. I did not care how long it stayed in its box as long as it did, and did not fall below the lower frame figure. How I Made $2 Million in the Stock Market, New York, Carroll Publishing Group, 1998, 52. O'Neill also went way beyond the simplistic box theory by recognizing the importance of applying historical precedent in his work. O'Neill observed that the chart patterns formed by market-leading stocks in one market cycle often repeated themselves in the market leaders of a later cycle. As an example, O'Neill has discussed in public forums how a big pullback by America Online AOL to its 50-day moving average back in 1998 reminded him of another big winner he played, Syntex Corp. in 1965. In this manner, Syntex served as a historical precedent for AOL in 1998 and served as an invaluable guide in helping O'Neill handle the position for what turned out to be massive gains. We know. We were there when it happened. The idea of historical precedents, of course, can be seen as derived from Jesse Livermore, who declared in How to Trade in Stocks, "I absolutely believe that price movement patterns are being repeated. They are recurring patterns that appear over and over, with slight variations. This is because markets are driven by humans, and human nature never changes." Greenville, Traders Press, 1991-96. And as O'Neill says, it's just history repeating itself over and over again, human nature continually on parade. The Successful Investor, 3rd edition. New York, McGraw-Hill, 2004, 84. Wyckoff also observed that, in a certain sense, reading charts is like reading music, in which both endeavor to interpret correctly the composer's ideas and the expression of his art. Just so a chart of the averages, or of a single stock, reflects the ideas, hopes, ambitions, and purposes of the mass mind operating in the market, or of a manipulator handling a single stock. Stock Market Technique No. 2, New York, Richard D. Wyckoff, 1933, 136. O'Neill is often pejoratively dismissed as a chartist, as if this is proof that he should be written off as some sort of investment pariah. We should not forget that, while he was a pioneer in figuring out how to automate the production of printed stock charts, he was not the first to recognize the usefulness of charts in stock forecasting. In Stock Market Technique 2, Richard Wyckoff devoted a short chapter to answering why you should choose charts, and summed up his assessment of the usefulness of consulting stock price charts by writing, "The ticker records stock market history on a long strip of tape. The charts record the same history transposed into another form, more convenient, more valuable for the purpose of studying past performance as an aid in forecasting. I should say invaluable." 1933, 66. For O'Neill, technical analysis and the use of charts is all about determining the actions of institutional investors as they set about systematically accumulating stocks. In this way, O'Neill does not approach the use of charts in a mechanical way, without incorporating any aspects of judgment, but rather as a tool to determine what the big players, the institutions, are doing. In this manner, he is similar to Wyckoff, who advised that investors study charts in order to uncover the motives behind the market action to interpret the behavior of stocks. Charting the Stock Market, The Wyckoff Method, ed. Jack K. Huston, Seattle, Technical Analysis, Inc., 1948, 13-16. Pivotal Points versus Pivot Points. Buying at the exact right point is a key mechanic in the O'Neill methodology, and O'Neill's concept of a pivot point is drawn from Livermore's pivotal point, of which Livermore had a reversal pivotal point and a continuation pivotal point. We might consider O'Neill's pivot point by points in stocks, generally defined by breakouts to new price highs, as more in keeping with Livermore's concept of a continuation pivot point, whereas O'Neill's concept of a follow-through day, as confirming an upturn in the market after a prior correction or bear market, to be similar to Livermore's reversal pivotal point, since it indicates a reversal in the market's trend from bear to bull phase. In How to Trade in Stocks by Jesse Livermore and How to Make Money in Stocks by William O'Neill, both writers share a common regard for such a pivot, or pivotal buy point, as the exact point where the risk/reward equation is most in the investor's favor, where the ducks are lined up in a row, so to speak, and so the stock should be bought once the price reaches this key pivot/pivotal point. Waiting for the pivotal point to present itself requires patience, and Livermore would do his best to avoid taking action until and unless the correct pivotal point signal was given, because this assured his success. As he puts it, "Whenever I had the patience to wait for the market to arrive at what I call a pivotal point before I started to trade, I have always made money in my operations." Why? Because I then commenced my play just at the psychological time at the beginning of a move. How to Trade in Stocks, Greenville, Traders Press, 1991, 43. O'Neill says, the winning individual investor can afford to wait and begin buying at these precise pivot points. This is where the real move starts and all the exciting action originates. How to Make Money in Stocks, 2nd ed. New York, McGraw-Hill, 1995, 164. The correct buy point lies at what both O'Neill and Livermore saw as a line of least resistance, where the stock was in the clear and able to launch higher with little to no impediment. The point of buying right is to enter a stock right at the point where the real move begins, so that if a stock is trading at 50, but the correct pivotal point is at 55, one must still wait for the stock to trade at the higher price if it is determined that this is where the line of least resistance lies. In this way, neither O'Neill nor Livermore were interested in capturing the movement between 50 and 55 as the stock approached the 55 pivotal point, but rather the big move from 55 to 100. As O'Neill says in How to Make Money in Stocks, 2nd edition, your object is never to buy at the cheapest price or near the low, but to begin buying at exactly the right time. This means you have to learn to wait for a stock to move up and trade at your buy point before making an initial commitment. p. 165. In Chapter 6, we take the concept of pivot and pivotal points further. Timing the market, when to be in, when to be out. From the O'Neill/Livermore perspective, waiting for the pivotal point, or the exact right time to enter the markets, means only being in the market when it is ripe for making money. Wait for the trend to develop, and then jump on. A line with which we are all familiar came from something Jesse Livermore wrote in How to Trade in Stocks. Successful traders always follow the line of least resistance. Follow the trend. The trend is your friend. Greenville, Traders Press, 1991, 69. O'Neill and Livermore both maintain that there is a time to be in the market and a time to be out of the market, even though common investment wisdom dictates that one cannot time the market, and therefore should always be fully invested in the market so as not to miss a bull phase and fail to keep up with the market indexes. O'Neill vigorously disagrees with such mindless orthodoxy when he writes, "Don't ever let anyone tell you that you can't time the market." This is a giant myth passed on mainly by Wall Street, the media, and those who have never been able to do it, so they think it's impossible. According to O'Neill, the erroneous belief that you can't time the market, that it's simply impossible, that no one can do it, evolved more than 40 years ago after a few mutual fund managers tried it unsuccessfully. They relied on personal judgments and feelings to determine when the market finally hit bottom and turned up for real. At the bottom, the news is all negative. So these managers, being human, hesitated to act. How to Make Money in Stocks, 4th ed. New York, McGraw-Hill, 2009, 200. Indeed, opinions have no place when it comes to stock selection or market timing, and we have sought to implement objectivity to our methods. The Dr. K market direction model, which is discussed in detail in Chapter 7, is a statistical formalization of the price/volume action of the NASDAQ Composite and S&P 500 indexes. The timing model, from its earlier forms to its most evolved form of today, has guided our trading with success since 1991. It was inspired by the M in O'Neill's Slim investment system. More about Dr. K's market direction model and the current market timing signal can be found at the following website, www.virtueofsilfishinvesting.com, and Gil Morales' work with respect to market trend timing can be found at www.gilmoreport.com. Emotions and predictions. Trading the market is a very zen activity, where you stay in the now, not worrying about what the market will do in the future, and not getting upset about a bad trade you may have made in the past. Instead, one should stay focused in the present, reacting in real time to the evidence that the market is constantly presenting. No one has ever been able to predict market direction with any consistent reliability, but that is wholly unnecessary to being a successful investor. Successful investing is about watching the market day to day and acting accordingly. In fact, attempting to predict the market often leads to over-intellectualization, which is usually a recipe for losing money in the market. When the market goes against your own intellectualized conclusions, you may be less likely to reverse your position, even in the face of factual price/volume action that is telling you that you are wrong. Pay less attention to what you think the market should be doing, and more to what the market is actually doing. As Livermore wrote, "Don't try and anticipate what the market will do next. Simply go with the evidence of what the market is telling you, presenting you." Richard Smitten, Trade Like Jesse Livermore, Hoboken and J. John Wiley & Sons, 2005, 13. In the same vein as Livermore, O'Neill preaches that an investor does not need to know what the market is going to do, but only what it is doing right now. O'Neill wrote in How to Make Money in Stocks, 3rd edition, "The key to staying on top of the stock market is not predicting or knowing what the market is going to do. It's knowing and understanding what the market has actually done in the past several weeks and what it is currently doing now." 2002, 75. Even Wyckoff adhered to this concept of remaining in the present at all times as he evaluated fresh evidence from the market in real time. He declared, "I am not one of the many who form opinions as to the future course of the stock market and then insist that the market justify their predictions. It is enough to know that the market tells me what it is probably going to do today and in the near future. I do not expect to be informed very far in advance because the market often changes its course. I must change my position accordingly." Stock Market Technique Number 1, New York, Richard D. Wyckoff, 1933-53. This entire line of thought speaks to the concept of keeping one's emotions out of the equation. To Livermore, the twin evils of fear and hope were the undoing of most investors who operated heavily in the realm of emotion. Perhaps it is not so much that investors fear and then hope, but that they rarely fear or hope at the right time, as Livermore observed. When you inject hope and fear into the business of speculation, you are apt to get the two confused and in reverse positions. How to Trade in Stocks, Greenville, Traders Press, 1991, 20. On the other hand, when it comes to operating without fear and keeping one's emotions in check when taking losses in the market, O'Neill borrows a bit of advice that comes from Richard Wyckoff, suggesting 1. Sell down to the sleeping point. Listening to opinions, news, and tips. When someone asks for a tip, it is best to tell them this: take no tips. Much money is lost by those who listen to tips. The person giving the tip may have an underlying motive, or he just may not have all the facts even though he thinks he does. As Jesse Livermore wrote in How to Trade in Stocks, markets are never wrong, opinions often are. 1991, 18. Markets are the final arbiter of all news known up to that point in time. At least that is what the big auction known as the stock market does. It prices the stock relative to its peers, so it is best to believe the market's assessment. O'Neill wrote in How to Make Money in Stocks, 4th edition, "Many people are too willing to risk their hard-earned money on the basis of what someone else says, rather than taking the time to study, learn, and know for sure what they're doing. As a result, they risk losing a lot of money. Most rumors and tips you hear simply aren't true." 2009, 305. The same could be said of opinions by experts. O'Neill continued, "Maybe this explains why virtually every analyst appearing on CNBC after September 2000 continually recommended buying high-tech stocks as they were on their way to 80–90% declines." To paraphrase Livermore, opinions are often wrong, but markets never are. Yet much of the investing public prefers the lazy way out. Wyckoff wrote, "Depending on the advice of others is a widespread public weakness," quoted in William O'Neill, How to Make Money in Stocks, 3rd ed. New York, McGraw-Hill, 2002, 253. Many prefer to be handed the answers. Over the years, the question we have heard most frequently is, "What are you buying?" The person asking the question usually has little understanding of the market and even less confidence in her own judgment, since she has not done the necessary preparation. Diligent study is the antidote. Wyckoff wrote, "When you understand stock market science, you have no concern about important developments in your morning newspaper, because the news is not a factor in your operations." An experienced judge of the market regards the whole story that appears on the tape as though it were the expression of a single mind. That is, the composite mind of all traders, investors, bankers, pools, institutions, and others who are participating in the transactions. Stock market technique number 2. New York, Richard D. Wyckoff, 139. Overtrading. Once an investor becomes seasoned and has developed a winning strategy that he has executed successfully for a number of years, he is still not immune to overtrading. Overtrading seems to plague both novice and expert alike, both in terms of trading when one should just be sitting in cash, and in terms of selling a position too soon, only to buy it back a few days later, then repeating this pattern of buying and selling. Jesse Livermore wrote of an investor who lived in the mountains and received quotes that were 3 days old. Only a few times a year would this investor call his broker to place trades. This man was quite detached from the markets, so it came as a total surprise when people learned of his remarkable long-term success in the markets. When asked about his success, the man replied, "Well, I make speculation a business. I would be a failure if I were in the confusion of things and let myself be distracted by minor changes. I like to be away where I can think. Real movements do not end the day they start. It takes time to complete the end of a genuine movement. By being up in the mountains, I am in a position to give these movements all the time they need." How to Trade in Stocks, Greenville, Traders Press, 1991, 32. Wyckoff echoed this sentiment when he wrote, "When in doubt, do nothing. Don't enter the market on half convictions. Wait till the convictions are fully matured." Wyckoff continued, "And so, whenever we feel these elements of uncertainty, either in our conclusions or in the positions we hold, let us clean house and become observers until, as that eminent trader Dixon G. Watts wrote, the mind is clear, the judgment trustworthy." Stock Market Technique Number 1, New York, Richard D. Wyckoff, 1933, 51-108. O'Neill acknowledges that there is a time when doing nothing is the best thing to do, and he is more specific about the symptoms. It isn't that bases, breakouts, or the method isn't working anymore. It's that the timing and the stocks are simply all wrong. The price and volume patterns are phony, faulty, and unsound. The general market is turning negative. Be patient, keep studying, and be 100% prepared. How to Make Money in Stocks, 4th ed. New York, McGraw-Hill, 2009, 151. Indeed, patience exercised wisely by staying out of the market when conditions are not right can save an investor a huge sum of money. The O'Neill Approach, Techno-fundamentalism. O'Neill is often chided for being a technician. But anyone who truly understands the O'Neill methodology understands that it is in reality a techno-fundamental approach that combines the use of technical analysis to determine when a stock is under accumulation within a chart pattern, and where the proper pivot buy point is on the one hand with essential fundamental characteristics of historically big, winning stocks on the other hand. Nicholas Darvas coined the term techno-fundamental to describe his system for investing in stocks, which combined monitoring the price action of a stock to determine that it was acting correctly within its boxes, as well as to define buy points as a stock emerged from the top of a box, with earnings growth as Darvas describes. I saw that it is true that stocks are the slaves of earning power. Consequently, I decided that while there may be many reasons behind any stock movement, I would look only for one: improving earnings power or anticipation of it. To do that, I would marry my technical approach to the fundamental one. I would select stocks on their technical action in the market, but I would only buy them when I could give improving earnings power as my fundamental reason for doing so. How I Made $2 Million in the Stock Market, New York, Carroll Publishing Group, 1998, 79. O'Neill doesn't just buy a stock just because it has a pretty chart. It must also exhibit the proper fundamental characteristics typical of winning stocks throughout history, according to O'Neill's own studies of historical precedent. Conclusion: After intensive study of multitudes of market cycles spanning over 100 years, it is clear that O'Neill carries on and refines the conversation that Jesse Livermore, Richard Wyckoff, and Nicholas Darvas started. Human nature does not change, so we carry on the conversation, voicing our successes, failures, and findings, all of which carry deep learning both on analytical and psychological levels. This is not rocket science, and almost anyone can apply these methodologies to become successful in their own right, but the technique does require long-term focus and dedication. While we do not pretend to be equal to the stature of any of these gentlemen, we do believe that as former O'Neill portfolio managers, and as successful investors in our own right, using the O'Neill methodologies, we have something of value to add to the conversation. Certainly, as the markets continue to evolve, certain mechanics and applications of O'Neill methodologies will evolve as well, and it will be left up to traders like us to continue to evolve and improve our methods. But the basic philosophical foundation, the ethos, of the O'Neill methodologies will remain the same. Chapter 2. How Chris Casher made over 18,000% in the stock market over 7 years. It's one thing to learn an investment system with the idea that you should be able to use it to make reasonable profits in the stock market over time, perhaps having a triple-digit annual gain from time to time. But it's another thing to see how it is all put into practice. It's also interesting to hear how some individuals have made big money in the stock market, achieving unheard of gains in excess of, say, 1,000% in a single year, or some other ridiculous number like 18,000% over 7 years. Most investors, however, have not seen what it looks like from the driver's seat, and when they hear of someone who has produced such performance numbers, it begs the question, exactly how was that done? In this chapter and the next, we will give some insight into how we achieved big gains in the stock market, the stocks we bought, the market conditions under which they were bought, and our thought processes and decisions as we maneuvered through it all in real time. By following along with us as we go through the experience of making big gains in the market, you may find that it is not as complicated as you might think. In the end, it is about working hard to put yourself in the position of being in the right place at the right time. That is, when a leading stock is just starting a huge upside price run. There is skill involved, and there is also some luck, but it is luck that you have to create for yourself by being in the right place at the right time. Once a position in a big leader has been taken and fully sized within your portfolio, the process becomes even simpler as you think less and sit more. Find the wave, catch the wave, and ride the wave for as long as it will take you. In this manner, investing is a lot like surfing, and when done properly, it can be just as exhilarating. The rest of this chapter and the next will take the reader through periods in our separate trading careers where we made our biggest gains. Using annotated charts to illustrate what we were experiencing and thinking at the time, we get as close as we can to giving the reader a sense of what it was like to operate in real time during significant bull markets and windows of opportunity, and to come away with huge profits that enabled us to achieve financial independence. Gaining a foothold in the business, a journey of 1,000 miles begins with a single step. Lao Tzu, Chinese philosopher, 604 BC, 531 BC, The Way of Lao Tzu. I had always wanted to work for William O'Neill after learning that he and his protege David Ryan had produced exceptional long-term investment track records that outperformed the markets over multiple market cycles. When I read William O'Neill's book, How to Make Money in Stocks back in 1989, it revolutionized my way of thinking about the market. O'Neill's hybrid method of applying both fundamental and technical analysis, as well as the M-in-can-slim, a technique that enables one to stay on the right side of the market, resonated deeply within me. So began my journey. From 1989 onward, I devoted many hours to the pursuit of making sense of the markets. In these early years, I created all sorts of econometric timing models based on a myriad of economic indicators that seemed to have predictive value. However, I later found that most of these indicators only worked over a period of less than 15 years. Thus, should markets change, these indicators would lose their ability to predict. I realized that studying 15 years' worth of data was insufficient. Not surprisingly, in the years ahead, my market direction model kept returning to the purity of price/volume action of the major indices. As I developed my skills at reading charts, price/volume action in timing the markets eventually became the most important variable. I also spent much time poring over individual stock and stock market data so that I could learn what variables and situations drove stocks higher. All these research studies not only put my trading account on track, but years later when I was hired at William O'Neill + Co., Inc. O'Neill noticed the breadth and depth of my market knowledge, so during the 6 years I was at O'Neill's firm, I was given the freedom to use all of the company's resources to carry out my studies. In some cases, I worked directly with O'Neill and took the helm of some of his pet research projects, including the 1998 model book study. Naturally, being his right-hand stock market research man, I shared my research findings with him, sometimes calling him late at night, as he said I could call him anytime no matter how late it was if I felt I had made a significant discovery. Here was someone who clearly shared my passion for the markets. My decision to switch out of nuclear physics into the world of investments had been exactly the right thing to do. I always say once one finds one's true passion in life and takes the necessary steps to make the dream a reality, circumstances tend to align in one's favor. The 1998 model book project examined top-performing stocks from 1992 to 1998, and to date, I've gone through nearly 20 market cycles going all the way back to the 1920s to study the stocks that made huge gains in each cycle. I have carefully studied each stock in detail to determine which fundamental and technical variables predicted success with the highest probability, and I came up with a set of variables that the winning stocks shared. I also created and then refined a market direction model, discussed in full in Chapter 7, so that I would be on the right side of the market whether we were in an uptrend or a downtrend. The model has never missed a bull or bear market, and I have used it under fire and in real time since 1991, my first successful year in the market. In back tests, it has well outperformed the major averages, returning an average of plus 33.1% per year since 1974, the first year of thorough back testing. To ensure the robust nature of the model, I have also spot-tested the model in the 1920s and 1930s, which produced results that handily outperformed the leading market averages. The systematic portion of the model is a statistical formalization of price/volume action within the major indices. The discretionary portion of the model observes other factors such as behavior of leading stocks, sentiment/psychological indicators, and involves exchange-traded fund ETF selection, position sizing, and degree of leverage, depending on the strength of the signal. Years after I had formulated my model, a salesperson who was retiring in 1999 and had been with William O'Neill + Company, Inc. since the late 1960s came to my office and gave me a large stack of original William O'Neill + Company, Inc. market calls that were dated from 1968 to 1999. I went carefully through each one and charted William O'Neill's buy and sell signals on the market. I saw that O'Neill never missed a bull or bear market. This further confirmed the validity of O'Neill's method in using price/volume of the major indices to time markets, and further underscored the importance of my statistically formalizing price/volume action of the major indices. Prudent market timing by moving to the sidelines when the market was weak, and buying leading stocks in leading industry groups when the market was in an uptrend, resulted in a return of 18,241.2%, which works out to 110.5% on an annualized basis over the 7-year period from January 1996 to December 2002. The rules I formulated are not my rules nor Wall Street's rules, but rules that are based on how the market actually works and how top stocks actually behave. Let's delve deeper by examining each year up close. 1996. Y2K stocks put me over the top. I made only minor headway with my personal account PA during the first quarter of 1996, as the market was what we might call sideways, or mostly trendless. Over the years, I have found such trendless, choppy, and sideways markets to be the most challenging because it is easy to get nickeled and dimed as the market whips you in and out, forcing you to take many small losses that begin to add up over time. While getting nickeled and dimed, one must avoid being drawn and quartered. In mid-March of 1996, I noticed a few high-quality stocks breaking out such as IOM Corp. IOM, shown in Figure 2.1. IOM had a natural monopoly on portable storage in the form of portable hard drives. They were the first company to effectively market the portability of their hard drives, and so enjoyed this first-mover advantage in a space that had little competition at the time. At the time of the breakout, IOM had a 700% increase in earnings to 16 cents per share in its most recent quarter, and a 287% increase in sales. In the prior quarter of September 1995, they had shown only 3 cents of profit per share, so 16 cents represented a huge acceleration into profitability. Additionally, sales accelerated over the prior 6 quarters from 2%, 16%, 60%, 138%, to 287%. IOM's base served as a beautiful launchpad for the stock. I put the usual 25% of my trading account into IOM on March 18 as it gapped up to new highs, even though very few stocks were still consolidating due to the sideways action in the general market. When buying a stock breaking out of a base, you want the base to have strong, constructive, and proper characteristics to help ensure that your stock possesses the best chance of a successful breakout. I used to carry around a hard copy of the William O'Neill Plus Company, Inc. daily graphs, so that I could mark it up and learn the difference between constructive and defective bases, and I recommend this old-fashioned technique to anyone who wishes to improve his chart reading abilities. General market action was a key variable. For example, in a weak downtrending market, the strongest stocks would often form the left-hand side of what would eventually become a constructive cup and handle or double bottom base. The strongest stocks act like springs. Once the weight of the market comes off, they spring forward, breaking out of sound bases they had formed during the market correction, and doing what they wanted to do all along: go higher. As more leading stocks broke out of sound bases in April, I began to increase the number of positions I had. I quickly found myself on full margin by mid-April, enjoying the rally from late March into June, and sitting in my typical 12 to 18 positions. Incidentally, I've noticed that my trading style in terms of position sizing, number of positions, and risk levels has not changed over the years. It is independent of account size, such that whether I was running a small account in 1996 or running big money for Bill O'Neill in 1999 onward, I still tend to hold 12 to 18 positions in any uptrending market. I will typically put 15 to 25% of my trading account into each stock, then either add to the initial position a second, third, and even a fourth time provided the stock sets up logical buy points as it presses higher. Otherwise, I will sell at least half the position if the stock hits my mental sell alert, or will sell to free up capital for new buys in fundamentally strong and potentially faster stocks breaking out of sound bases. In June 1996, my account peaked at plus 72% year to date by the time the market topped that summer. Over the next several days, each stock I owned then began to hit my sell alerts, so I sold. With IOM, I used the 10-day moving average to guide my mental sell alert, as Figure 2.2 shows, and thus placed my mental stop slightly under the 10-day. After IOM peaked on May 22, it sliced through the 10-day moving average on big volume on May 28. I put my mental stop 1/16th under the low of that trading day, or 36.31, and so I sold my position the next day as the stock reached my mental sell stop. That said, it could be argued that a climax top occurred in those 3-up days on high volume at the peak. Back in 1996, I did not understand climax tops well enough to sell into them, and found that I preferred to sell on weakness instead of strength, as it more suited my trading personality. Incidentally, I use the 10-day as a sell guide for the fastest names, as they tend to get support around the 10-day as they move higher. For slower stocks, or for stocks that trade with more volatility, I use the 50-day moving average as my guide on where to sell. Should the stock penetrate the 50-day, I will then put the stock on standby sell to see whether it should be sold or held. We cover this selling strategy in detail in Chapter 6. I eventually found myself 100% in cash by mid-June. I had no idea the market was going to have a mini crash, but I always stick to my rules. Here is a key but obvious point that ensures that you will not fall in love with your stock and hold it past its prime. Buy based on both fundamentals and technicals, but sell purely on technicals. Technical action should always be the final judge when selling a stock. The Nasdaq Composite proceeded to drop 19.6% from its peak set on June 6, as Figure 2.3 shows. Many of the high-growth stocks I owned suffered far more severe corrections, since such stocks tend to be more volatile. But I was protected, because I was in cash. The market continued its correction until it finally found a bottom in July. Shortly thereafter, my timing model issued a buy signal on August 1, 1996, as we see in Figure 2.4. I also noticed stronger leading names just starting to break out of sound bases, always a good sign as it signals that a potential new bull phase in the market is emerging. Stronger names are often the first to break out, and when this occurs in synchronicity with a buy signal, it is highly constructive. So, listening to these stocks shouting to be bought, I began to buy in earnest once again. By December 1996, one of the big buzzes in the market was the impending year 2000, or Y2K crisis. Companies that were coming up with solutions to help computer systems to cope with the date change from a 19 prefix to a 20 prefix were garnering interest from investors. It is one thing to buy into a big story on the basis of the buzz alone, but in this case, certain Y2K stocks like the year 2000 stocks TSR Inc., TSRI, Zittel Inc., Zittel and Accelerate Inc., Acly had been discussed at length on how they could avert potential disaster as the clocks ticked over to January 1, 2000. I took notice of these stocks, which were the major players in this subsector as they broke out of proper bases. So I bought. The buys put me over the 100% mark in my personal account, and I finished the year up plus 121.57%. All it takes is one or two good home runs in any given year to make up for all the small losses. As a general rule, following the method of buying fundamentally strong stocks at the right pivot points, then moving to cash when the market is weak puts the odds greatly in your favor so that you will achieve that golden 100% return in a given year, provided you are in a bull market environment. If you are in a bearish environment, you still might be able to hit one or two home runs, which will counteract any small losses. 1997. Keeping profits during the Asian contagion. During the first quarter of 1997, the market was in a downtrend. By April, some portfolio managers with whom I was speaking were ready to throw in the towel for the year as frustration ran high. I had stayed mostly in cash during this period as my timing model had been on a sell signal, and there were almost no stocks worth buying. Then on April 22, my timing model gave a buy signal, shown in Figure 2.5, the first buy signal since early January, and I noticed fundamentally strong stocks in sound bases starting to break out. I bought the strongest of stocks, then as the rally continued, I would sell the weakest names to make room for any new strong names breaking out. I was effectively force-feeding any available buying power into the strongest names. The market continued on its uptrend into October. I then was surprised to see that just over a few days, by October 17, most all of my stocks suddenly hit their sell alerts, just a few days before the market imploded. The massive sell-off was caused by the Asian currency crisis, shown in Figure 2.6. I had no idea this crisis was going to occur when it did, nor that the market would sell off so hard. But as I had always done before, I sold when my stocks hit their sell alerts. Thus, I was safely in cash a few days before the markets got slammed. My drawdown off the peak was just 6.5%, compared to the 16.2% drawdown in the Nasdaq. Incidentally, my success-to-failure rate in 1997 was one of the lowest ever, with the number of my losing trades outnumbering my winning trades by roughly 41, or a success rate of just over 20%. And I was able to achieve a triple-digit return, just barely 102% according to my accounting, 98% according to KPMG, because the home runs made all the difference. I point this out to illustrate that the number of profitable trades is perhaps the least important variable with this investment methodology. The percent gained on a trade is a far more important variable. That said, in other bull market years, my success rate is usually closer to 50%. 1998, demoralization sets in just before the market takes off. While the first quarter of 1998 was highly profitable, the months from July through early October were some of the most challenging. Shortly after the market peaked in mid-July, my stocks hit their sell alerts, so I ended up back in cash just several days after the peak. The market then staged a feeble rally in September. Very few high-quality stocks were breaking out of sound bases, thus there was little to buy that month. I remember, however, many investors buying that month eager to assume the rally was continuing. But when October came around, the market sold off very hard, absolutely demoralizing many investors. Many had year-to-date losses by that point. Figure 2.7 shows the big market bounce on October 8 that led a few days later to my timing model issuing a buy signal on October 14. I also noticed a few high-quality stocks breaking out of sound bases in the ensuing days, such as eBay Inc. eBay was a most interesting IPO. It had one of the best business models and had first-mover advantage in its space, much like Yahoo! Inc., Yahoo! For search engines, and Amazon.com Amazon for online retail. eBay came public on September 24, but despite its brilliant business model proceeded to lose more than half of its value due to the nasty bear market that caused the Nasdaq to lose 33.1%. So even though eBay had one of the strongest business models, it sold off hard with the rest of the market, thus neatly illustrating why fundamentals are only half the story. No matter how great a stock's fundamentals, a serious bear market will usually drag a stock down. When my timing model signaled a buy shortly after the market bottomed, it only took a few days for eBay to hit its buy alert. On October 26, eBay gapped up out of what I call a U-pattern, or what Gil Morales refers to as an IPO U-turn, as we see in figure 2.8. These rare U-patterns can be seen in the strongest of stocks. The stock is so strong that it is not going to wait to form a handle, and the length of the base is often for weeks or less. I bought my first position in eBay on the gap up, and then bought a second position as the stock bounced off its 10-day moving average. I have found that the strongest stocks often constructively trade around their 10-day moving average, using it as support to rest briefly before continuing their move higher. Meanwhile, many investors had been so demoralized by the brutal bear market that began in July, and thus were skeptical as the market bounced in October. I remember some stayed short the market into November as the market rose like a rocket. And as the market continued to rally, it forced those who were reluctant to buy to either cover their short positions or admit their error and start buying. However, they were late buyers, and so they missed some of the most compelling breakouts. The best stocks are sometimes the first ones to break out shortly after a new uptrend begins, as they often offer the best gains. eBay was an excellent example of this. The fourth quarter of 1998 turned out to be a highly profitable quarter. As the technology sector led the way higher, stocks that had first-mover advantages in their space often well outperformed their peers, making them true market leaders. I screened for stocks with top fundamentals, which included having great business models, and then investigated whether any had a first-mover advantage. I then pruned the list further by investigating each stock in detail. Of the few stocks that made the cut, I put mental buy alerts on each, so that when the stock traded through its buy alert, my software would immediately alert me. The fourth quarter of 1998 presented what I call a high-class problem. So many great stocks were breaking out of sound bases that buying power quickly became exhausted, and it became a challenge to figure out which stock or stocks to sell out of my roughly 14 to 17 positions during this period to make room for potentially faster stocks breaking out. I reduced the weakest positions by half or sold them in full on the basis that their relative strength was not as high and or their fundamentals were not quite as strong. I was then able to force feed capital into the strongest names at all times while the market was advancing, which gave me a huge edge. This ensured that, being fully on margin, 200% of my capital was being deployed strategically. 1999. The bubble expands. Part of successful investing is knowing when a fundamental part of the market changes, even though the market may have never behaved this way in the past. In the late 1990s, it was the earnings metric. Some internet stocks that made huge gains had little to no earnings. While earnings are one of the most important variables I use to gauge the potential of a stock, I realized that sales growth was a useful metric for stocks with no earnings. Understanding the fundamental story behind the stock together, with understanding how Wall Street perceived the story behind the stock, proved beneficial, because it is the institutional money from mutual, hedge, and pension funds that cause a stock to make huge advances. Because of this fundamental change in the market, I learned that markets sometimes change in subtle and not so subtle ways. While certain key fundamental and technical variables continue to work cycle after cycle and form the core of my strategy, other variables have a limited life. It is up to investors to follow the markets closely so they can see when new variables can be used to enhance profits as well as when such variables lose their predictive value. Be wary of black box methodologies that claim to be profitable without having to be fine-tuned. They may work for 1 or 2 market cycles, but must be fine-tuned to keep up with changes in the markets. In the first quarter of 1999, most of the stocks that triggered buy alerts were technology stocks since the internet was touching so many aspects of technology. I always do what the stocks and general markets tell me to do, so I was fully margined during the uptrend that led to the April 13 reversal day in the SIBO Internet Index, INX, shown in Figure 2.9, an index that is a good measure of performance in the internet space. I noticed many internet stocks had staged or were staging reversals after making huge gains. Also, the day before, on April 12, some stocks announced they were going to attach COM to their name. Some more than doubled in price on the announcement. This extreme buying struck me as some sort of temporary climax top for the internet group. Then on April 14, before the market opened, I noticed many of the stocks in my portfolio were going to gap slightly down from the prior close they had set the day before. After the first few minutes of trade, they were unable to rally from their lower opening price. Noticing this, and taking into account the prior action that led up to this day, I gave my trader a shopping list of stocks to sell just several minutes after the market opened. This shopping list was 14 out of the 16 stocks that I held. Thus, I was effectively reducing my market exposure from 200% down to about 35%. The SIBO Internet Index, Figure 2.9, proceeded to tank about 20 minutes after I gave my sell orders, taking the stocks down with it that I had finished selling only minutes earlier. The SIBO Internet Index overall finished the day down 9.6%. That day, some of the best performing stocks were down twice the decline in the SIBO Internet Index. In Phosphase, Inc., INSP in Figure 2.10 gives a sense of just how fast some of these stocks fell. It took just 6 days for INSP to get sawed in half, as it fell almost 50% from peak to trough. Timing is everything, especially when it comes to handling high-octane names. Like dynamite, they must be handled with care, especially if you decide to concentrate your portfolio in one sector. Had I not acted quickly when I saw the warning signs, I would have given back a much larger portion of the profits I had made during the first quarter of 1999. Being able to sell most of my positions within 20 minutes was also key. I had a rule back then by which I would hold no more than 10% of the average daily trade in a stock. Today, times have changed, so here in the year 2010, I would put no more than 5% of the average daily trade into any one position, and also focus more on the mid to larger cap names that are less subject to noise. While the first quarter of 1999 was a gift, the second and third quarters of 1999, as shown in Figure 2.11, were the most treacherous I had experienced since 1991. A year that marked the first time I was able to beat the major market averages. 1999 also represented the largest drawdown for my timing model of 15.7% and the largest for my personal account of nearly 50%. While the KPMG verification shows my drawdown was about 30%, my real drawdown was larger at nearly 50%, because I was intentionally not trading a sizable portion of the account that was earmarked for taxes. Thus, the base of capital I was trading was substantially smaller than what was actually in my account. This resulted in larger drawdowns than reported by KPMG, but also resulted in larger annualized gains than reported by KPMG. Of course, KPMG follows regular accounting standards, so it had no way of accounting for this. At any rate, the high level of volatility in a trendless market exhausted many traders. It was not until October that the market resumed its uptrend in earnest. I'm glad to say that periods such as the second and third quarters of 1999 are rare. That said, it is important to stick with a winning strategy in good times and bad. I have lived with my strategy since 1991. This gave me the confidence to stick with it even during the treacherous second and third quarters of 1999. I never lost sleep during this period, nor have I ever lost sleep over the market. The key is to always understand why one is making or losing money. My timing model sheds much light on the character of the market. If the model is struggling to make profits, such as it did during the second and third quarters of 1999, it helps me realize that we are in an unusual environment. In this case, the market was both volatile and relatively trendless, the Achilles heel of trend following. Fortunately, as demonstrated clearly in Michael Koval's book Trend Following, which I highly recommend to any investor, markets tend to trend more often than not. Thus, highly successful portfolio managers such as Bill Dunn and John Henry can remain successfully in business with exemplary 25-plus-year long-term track records and continue to thrive to this day. That said, periods of steep drawdowns are part and parcel of trend following. It is critical to stick with the strategy in both good times and bad. As shown by Dunn, Henry, O'Neill, and other successful trend followers, the profits made during the good times more than make up for the losses during difficult, trendless periods. 2000. The bubble bursts. Celera Genomics CRA, shown in Figure 2.12, had made a critical announcement about their mapping of the human genome in late 1999, sending biotechnology stocks soaring. The group continued to make huge price advances in early 2000. As with the internet sector, many of which had no earnings, market perception played an important role in the biotechs, many of which not only had no earnings but also had no revenues. So, with none of the classic fundamental variables on which to measure the company, I applied to the biotechnology sector what I had learned about market perception with the internet sector. If market perception was highly positive due to a belief held by institutional funds that the company had huge potential, this could be seen in the price/volume action of the stock, as it was the signature of significant, big money institutional buying. This was key to my making a triple-digit return in 2000 on the long side, a year when the market averages such as the Nasdaq Composite were down nearly 40%. The biotechnology sector topped in late February, shortly before the general market topped. The general market then put in a top on March 10, as shown in Figure 2.13. I was quick to take my account off margin and move into cash as each one of my stocks hit its sell alert in the ensuing days. For the rest of the year, I did some infrequent, light buying, and so I was able to preserve most of the profits I had made that first quarter. It is critical not to overtrade, and perhaps it is often best to do nothing and just sit in cash when the market is not acting right. That said, overtrading is one of the most difficult issues to overcome even for the most seasoned investors. The market will tempt the trader to jump back in by making things look almost right, and most traders would rather remain active than dormant. But it is often best just to sit and do nothing if the market is not acting just right. In my experience, I have observed that this is easier said than done. Here is another argument for staying on the sidelines if the market is not acting just right. If one only trades 10 optimal buy situations in a given year and makes an average of 10% on each trade, one's entire account would be up 159% in that year if one invested one's whole account each time such an optimal buy point arose. In practice, due to risk management reasons, even if one invested 25% of one's account in each trade, one's whole account would still be up about 40% for the year. Of course, ample experience is required to know that the odds are greatly on your side and that there are no guarantees. However, if we take the period of 2006-2009 as one example, the latter part of 2006 and 2007 were just right for buying, and big money could be made during such windows of opportunity. Then, in early September 2009, GLD had a perfect setup and gold stocks could be bought, as they correlate highly with GLD. Of course, there were other picture-perfect plays during these years, giving one further opportunity to do well. I am not saying this in hindsight, but am basing this on my actual profits during these picture-perfect, albeit brief periods. My mistake was overtrading during the less optimal periods. Incidentally, I noticed that O'Neill does little when the market is not acting right. You can make a fortune just by being long the right stocks at the right times when the window of opportunity is open. My market direction model is almost always on a buy signal during such times, and if not, it has always switched to a buy signal within days after the first few leading stocks break out of sound bases. You can further enhance your performance by learning short selling techniques, which are discussed in Chapter 6. 2001, a lesson in shorting. In February, I pyramided a short position in the PowerShares QQQ Trust, QQQQ. I remember as profits were building, I started calling this my Modena trade. A Ferrari Modena back then was the hottest new model and cost about $250,000 with the markup. Thus, a profit of $500,000 on a trade would pay for the car after federal, state, and miscellaneous taxes were paid. I finished the trade at a profit of over $600,000, but I never bought the car. I learned that even though I had always wanted to own a Ferrari, I did not buy it because it was not the act of possessing the car that was important. Psychologically, it was the idea that I could easily possess it, so buying it became unnecessary. It brought me greater pleasure to keep the capital on hand to invest in the markets. As I learned from O'Neill in the years I worked with him, one should never make the market pay for one's luxuries. Then in March, I reshorted my QQQQ position. I pyramided the position as before, and profits eventually amounted to over $1 million. The problem was that greed got the best of me, and I thought the market was going to crack wide open, and my profit of over $1 million would turn into $2 million or more in the event of a market crash. I was heavily leveraged on the short side and failed to consider the more likely outcome that the market could bounce big after having sold off so hard. On April 5, the market gapped up fiercely and rallied the rest of the day, figure 2.14. I finally closed my position at the end of the day. I lost just over a cool million in one day. My profits on the trade shrank from over $1 million to about $100,000. Gil Morales came into my office, shook my hand, and told me that's one hell of a ride, and that he had enjoyed the vicarious thrill by watching me make the trade. I then recalled the Victor Sperandeo interview in Jack Schwager's book, Market Wizards, where he talks about going into a bar and telling the bartender, "I just made $100,000 today. I really need a drink." So the bartender asks, "Why the down face? Shouldn't you be celebrating?" Sperandeo replied, "The problem is, I was up $800,000 earlier today." The rest of 2001 was uneventful with just a few losing trades. The window of opportunity was clearly shut, so I stayed mostly on the sidelines as my timing model was usually either on a sell or a neutral signal. 2002. To present, choppy, sideways markets and the birth of the pocket pivot. The year 2002 was also uneventful and I stayed mostly in cash. I remember many funds closing their doors. While 2001 was a massacre, 2002 was equally brutal. Few were left standing. Once the Nasdaq Composite was off more than 70%, the market seemed to be excessively oversold. So I decided to take a small position in the QQQQs for a long-term play. I reasoned that the market could go lower, but historically had always resumed a strong rally after being so oversold. This was true after the panic of 1907, after the Great Depression when the market lost almost 90% of its value, and after other serious market setbacks dating back to the 19th century. So 2002 was profitable by a hair due to this one trade, which reversed my small losses. My losses had been small because I remained mostly on the sidelines, safely in cash. That said, I would have been nicely profitable had I shorted indices on any sell signals issued by my timing model. This was also true in other years. Thus, this bias I had toward staying in cash during bear markets was replaced starting in 2009 with the action of shorting major indices on sell signals. 2008 was a wake-up call to start shorting the major indices, as 2008 was a good year for my timing model, as shown in figure 2.15, due to the collapse in the general markets. The return of plus 31.1% is good, but under the model's long-term average annualized returns of plus 33.1%. But when accounting for optimization of the follow-through day threshold, which I discuss in Chapter 7, the return increases to plus 38.8% for 2008. I prefer to err on the side of absolute caution, so I show the worst-case situation of plus 31.1%. Note, the timing model's back-tested historical average of plus 33.1%/year from 1974 to 2006 was achieved by going 100% long the Nasdaq Composite on a buy signal B, 100% short the Nasdaq Composite on a sell signal S, and 100% cash on a neutral signal N. In working with my model in real time since 1991, the returns in my personal and institutional accounts were larger because I was buying individual stocks during periods when my model was on a buy signal. The toughest year for my model was 2007, as it was one of the only 2 years when the model was down in its entire 36-year run. Its negative return of 10.9% was due to a large number of false price/volume signals. That year, distribution day clusters often did not lead to a falling market, as the market continued to grind higher. This may have been due to the many one-time confluences of cross-currents, including the end of the housing bubble, the early stages of a breakdown of financials as seen in the XLF index, and the beginning of the recession. Fortunately, years such as 2007 are extremely rare. On balance, my timing model continues to keep me on the right side of the market cycle after cycle. For historical interest, figure 2.16 shows my timing model in action during the crash of 1987 and its aftermath. In the current decade, the compressed, sideways markets observed from January 2004 to August 2006 brought new trading challenges, as shown in figure 2.17, and my market direction model's returns, while still ahead of the major averages, have been under its historical returns of plus 33.1%/year. But whatever doesn't kill you makes you stronger. In late 2005, I came up with a major refinement to my strategy, which enabled me to make my initial buy in a stock's base just before it broke out, a method I call buying in the pocket, which will be discussed in detail in Chapter 6. Not only does this refinement work today, but also worked beautifully in prior 1970s, 1980s, and 1990s markets. Those of you who subscribe to the Gilmo report will note that we have discussed them in some detail in prior reports, which can be found at www.gilmoreport.com. This technique will improve your investment performance should the market encounter choppy, sideways action that grinds higher, such as during much of 2004-2007, or during windows of opportunity such as the brief uptrends of September to November 2006 and September to October 2007. Looking back, as the saying goes, if I only had known in the 1990s what I know now, my returns would have been higher. We are all students of the market, always learning, always optimizing, and hopefully always evolving. It certainly keeps the journey alive and well. Chapter 3. How Gil Morales made over 11,000% in the stock market. Do not be concerned with the fruit of your action, just give attention to the action itself. The fruit will come of its own accord. This is a powerful spiritual practice. Eckhart Tolle, practicing the power of now. I didn't get into the investment business until June of 1991, when I got a job as a financial consultant trainee at Merrill Lynch's Beverly Hills branch. At the time, I was making $2,000 a month, which wasn't enough to live anywhere in Los Angeles where you didn't risk getting hit by stray bullets. So I had to suck it up and live with my parents while I gave my nascent brokerage career a chance to gain traction. In the end, it wasn't so bad. Living with my parents as an adult was not much different from living with other adult housemates, which I had done many times before during my post-college existence, except that these housemates didn't stay up all night partying, and they didn't stick you with the phone bill. Beverly Hills is also a surreal place to work. Where else can you, while driving your 1991 Dodge Colt, almost end up running over the actress Jamie Lee Curtis as she jaywalks across Rodeo Drive? Even better, the Beverly Hills Merrill Lynch office occupied the top 2 floors of a building that housed a Sharper Image store on the ground floor. One afternoon, I headed down 6 floors to the 3rd and bottom level of the building's underground parking garage, only to find my car blocked by a large limousine. I went up to the limo door, which was ajar, to ask the occupant if they could move, only to find that the occupant was Michael Jackson, who had sent a small entourage up to the Sharper Image to buy some items. He could not move the limo, he said in his trademark soft, plaintive tone. I went back upstairs, a bit disgruntled that I couldn't get my car free, whereupon my assistant inquired. "I thought you were leaving," I said. "I would, but Michael Jackson's limo is blocking my car." At that point, a gaggle of office assistants ran screaming downstairs to harass Mr. Jackson, which did not help my cause with respect to getting my car out of the parking garage. In any case, such was life working in Beverly Hills, and it added an entertaining aspect to my early days as a stockbroker. I could not complain, however, as I found the business fascinating and I was having fun, despite the grueling task of enduring life as a rookie broker trying to drum up new accounts and obtain a foothold in the business. Most trainees didn't survive their first 2 years, but fortunately, I was not going to be one of them. In 1991, I didn't have any money to invest myself, but I remember having some initial success with the O'Neill methodologies when I bought stocks like Solctron SLR in 1991 and Pyxis PIX in 1993 for some of my clients. At that time, I was just getting my feet wet, and I was so green that I can remember my hands shaking when I wrote out my first buy ticket for a client order of 200 shares of SLR stock at the market. It wasn't until 1993, when my maternal grandmother passed on and left me $3,000, that I finally had my grub stake. Over the next couple of years, I grew it a little bit, and added to it through savings and bonuses I made as a broker when I moved over to Payne Weber, Inc. in mid-1994. By 1995, I had a few more thousands to play with, and I began investing when the market began to turn in late 1994, specifically when it staged a textbook O'Neill follow-through day to confirm a new market uptrend on December 14, 1994. A rocky start turns golden. Despite the new market uptrend, I got off to a wretched start. By April 1995, I was down over 30% in my account, and the market had been in a confirmed rally that had been in force for nearly 5 months. I could see the river running before me, but every time I got into it with my boat it promptly tipped over, and I was starting to get frustrated. Fortunately for me, I tend to focus most when I am ticked off, and so I began working harder, going through my weekly printed daily graphs books with an even more discerning eye. To this day, I can still smell the fresh ink on those books when I used to go directly down to the O'Neill offices in Marina del Rey, where I would later be employed in 1997 to pick up my books every Saturday morning when they came off the press. To me, it was pure aromatherapy. My intensified efforts were soon rewarded when I came across a company that was developing MPEG encoder, decoder, and codec products that enabled video to be compressed so that it could be viewed on computers and transmitted over the newly emerging Internet. At the time, this was a key enabling technology, and the company producing it was C-Cube Microsystems Cube in 1995. At the time, Cube was showing 3 big quarters of earnings growth at 700%, 1100%, and 375%, respectively. Sales were up 101% in the most recent quarter, and after-tax quarterly margins were at a peak of 18.6%. Cube return on equity was a healthy, peak number of 15.7%, and its group rank was a strong 13. From a fundamental perspective, the stock fit the characteristics that I was looking for. Back in those days, I was not very picky about my buy points. If a stock came out of a big consolidation to new highs, I would simply buy it, as I did with Cube as it moved to new highs on May 16, 1995. Figure 3.1 shows Cube weekly chart from 1995 to 1996, and you can see that the base formation was a bit unclear in this particular time frame. In Figure 3.2, the daily chart of Cube from that period, you can make out a cup with handle formation, but this is not evident on the weekly chart. However, since I was using O'Neill's daily graphs product every week, I was looking at nothing but daily charts at the time, so I bought what I thought was a cup with handle breakout. Once the stock cleared what I saw as the peak of the handle at around 24 and change, I assumed I was buying a proper cup with handle pivot point, climbing on board the rocket ride. If you refer to Figure 3.2 and Figure 3.3 simultaneously, you can follow the buy points in the pattern. On Figure 3.3, we see the initial breakout to new highs that I bought at the cup with handle pivot point. The stock then spent the next 5 weeks or so pulling back to the breakout point and the inching up before it launched again at buy point 2 on the chart. In hindsight, this was also a test of the 10-week moving average as the weekly chart of Figure 3.1 shows. At the time, I didn't see that because I was looking exclusively at daily charts, but to me, it looked like a breakout from a miniature cup with handle formation, and so I considered the stock buyable at that point. And today, I now know that in fact the action at buy point 2 constituted a pocket pivot buy point, something we will cover in detail in Chapter 4. Cube then stair-stepped its way to around 49. Note on the weekly chart, Figure 3.1. The prices are split adjusted 2-for-1, hence are halved, before it pulled back sharply toward its 50-day moving average in late September into early October. I remember my clients calling me, upset that I hadn't sold them out of their Cube close to the 49 high. But as I saw it, the stock was pulling right back to its 50-day moving average for the first time since it originally broke out in mid-May, and this was a place to add. We had to buy, I told my clients. At this point, I was running low on funds in my account since I was already loaded up with Cube stock, so I bought a bunch of November 50 calls at about 11/2, or about $1.50 in today's decimalized terms, when the stock was at around 37. From that point, as Figure 3.3 shows, the stock rocketed higher as it went parabolic, and by November the stock was at a split-adjusted 95, and the calls were worth $45. I had sold the calls on the way up, as the profits were getting to be ridiculous and I didn't want to be a pig. But I made enough to be up over 500% at that point in my personal account. Instead of a few tens of thousands of dollars, I had a few hundreds of thousands, and with just one stock, I had turned my account around from being down over 30% to being up over 500% by year-end. Getting out of Cube wasn't all that difficult, since it started to act very erratically as it moved into the end of the year, and while I did not sell at the exact top, I sold close enough to make big money in the stock. Ultimately, Cube went on to form a classic head and shoulders topping formation with a neckline as I've drawn in on figure 3.4, from which it broke down in earnest in the summer of 1996, but we'll save that topic for a more detailed discussion in Chapter 4. When I look back at this first love of mine, at least in the stock market, I wonder if I would have played it so well today. Back then, I knew enough about chart patterns to think I knew when I was looking at a cup with handle and cube, at least enough to buy the stock on that breakout. By following some simple rules and keeping my cool when the stock made that hectic break from a peak of 49 down to 37, just below its 50-day moving average, I stepped up and loaded up on cube calls and stock. In a way, given my relative inexperience, I was fearless, and this is what allowed me to capitalize on Cube's huge move. As well, I became very acquainted with the stock's business story, and I considered the fact that Cube had critical enabling technology for transmitting and viewing videos on PCs, and the internet to be a big reason to own the stock. One of the lessons I take away from my Cube experience is that companies that have such key enabling technologies for an area that was experiencing rapid growth, such as personal computers and the internet, were in 1999, often have the key ingredient for a big price move. Another critical lesson, something that has a very visceral meaning for me, is the fact that by remaining persistent and not giving up, even when I was down over 30% in 1995, I eventually achieved a result in excess of 500% by year-end. This gave me the confidence that came from knowing that I had the ability to recover from any short-term setback in the market, and has served me well since then. All traders will, from time to time, experience cold spells when they feel as though they can't do anything right. And as Bill O'Neill once told me, what makes a trader great is not the positive results she achieves, but the ability to bounce back from difficult times when one has been kicked around pretty good. Joining the 1000% club. When you hear about the great dot-com bubble market of 1999, you get the idea that it was just one big, year-long party for stock investors. Nothing could be further from the truth. As figure 3.5 shows, the first 9 months of the year saw the Nasdaq index chop and slop its way higher in a slow, grinding rally that took the market to new highs in early October 1999. During these difficult months of 1999, the Nasdaq would consistently make new highs and then promptly roll over again. It was very difficult to make progress, and every time a stock began to work it would just as quickly reverse course and shake you out. By mid-October of 1999, the market was not looking all that promising. While the Nasdaq was at least floundering its way higher in broken stair-step fashion, the Dow Jones Industrials were, by September 1999, making lower lows as they struggled to hold their 200-day moving average in October 1999, as figure 3.6 reveals. Both Chris Casher and I had our share of difficulties during that whipsaw environment, and it would be an understatement to say that we had become fairly exasperated with the market by that point. Because of this, our tendency was to think that it was likely headed lower. Given the level of frustration we were experiencing as we had been whipsawed to death since early February, it was not hard to take a discouraged point of view. However, if you compare the chart of the Nasdaq, figure 3.5, to that of the Dow Jones Industrials, figure 3.6, you will notice the interesting divergence between the two. The steady upside progress of the Nasdaq index, as evident in the grinding uptrend channel outlined in figure 3.5, was a critical divergence and a key clue that the next upside move in the market would be led by the smaller technology-oriented stocks, the bread and butter of the Nasdaq index. The Nasdaq's choppy uptrend divergence in 1999 was nothing less than the bubbling cauldron of the soon-to-be unleashed dot-com mania that was slowly but steadily coming to a boil under the surface of the market's difficult action. Oracle bubbles up. Sure enough, on October 28, just 7 days after we had thought that big-cap stocks were about to be destroyed, and the market with them, a massive upside follow-through day occurred, signaling that the market was beginning a new uptrend. At that point, whatever we had thought before about the market was tossed right out the window as we immediately shifted into buy mode. There were no ifs, ands, or buts. The market had given its verdict with the follow-through day, and when the market turned, we turned with it. Of course, at the time, we had no idea that we were about to get the bullish tidal wave ride of our careers, a literal rocket ride that Figure 3.5 shows in all its upside glory. My buy watch list had already been simmering on the stove for several weeks, and I was ready to act. One of the stocks I had been watching was Oracle Corp. Oracle, which had already broken out of a cup with handle base in September 1999, well before the late October general market follow-through, as Figure 3.7 shows. Note that in all these charts, Oracle's price is split-adjusted, so that $10 on the charts I'm using here is actually $40 in 1999 pre-split terms. The daily chart of Oracle Figure 3.8 gives better detail of this early breakout, which was, for all practical purposes, a clear textbook pivot point buy signal as it came popping up out of the top of the 6-week consolidation that was in fact the handle within the overall cup with handle formation. Volume was brisk and above average, which is what you would want to see on this type of breakout. While I saw Oracle break out at the time, I took no action since I was negatively fixated on Oracle's quarterly earnings numbers, which showed that earnings growth was actually decelerating. The sequence over the immediately prior 4 quarters was 58%, 43%, 33%, and the most current quarter's earnings growth at the time of 23%. Sales growth during the most recent quarter was 13%. Normally, you would want to see sales growth of 20% or more with respect to a more orthodox, slim type of stock. For these reasons, as well as the fact that the general market was still correcting and had not yet signaled a follow-through day to the upside, I initially ignored this breakout in Oracle, but there was more going on here than met the eye. Oracle's CEO, Larry Ellison, had first come up with the idea of net computing in 1995, and in 1997, Oracle created Network Computer, Inc., as a wholly owned subsidiary. Ellison was a big advocate of web-based applications, which users accessed via the web from a central network server rather than having the applications installed and housed on their own personal computers. What Ellison and Oracle were onto was an early idea of an information appliance. This was a radical idea at the time, but one that the rapidly growing internet was making more and more feasible. Today, we see the offshoots of Oracle's original concept in things like cloud computing, as well as in handheld internet appliances like Apple Inc.'s iPhone and Research in Motion's BlackBerry devices. Conceptually, Oracle was considered a leader in the development of applications based on the facility provided by the emergence of the internet. The 1999 bull market was a highly liquidity-driven market thanks to the Fed's easy money policy that arose to address the long-term capital crisis in 1998, as well as the upcoming Y2K crisis that was allegedly set to turn the world's computer systems on their heads when they would all have to deal with a year that started with 20 instead of the 19 that they had all originally been created to handle. Institutions were awash in liquidity, and this money had to be put to work. Liquidity often seeks liquidity, and so a lot of it was put right into liquid, high-quality, large-cap names that were perceived as potentially huge beneficiaries of the rapidly growing internet. Oracle was one of these, and while the earnings growth was decelerating, the company was still a very profitable enterprise showing a very high return on equity of 38.8%. Institutional investors often favor established companies with a long-term record of strong profitability, of which return on equity is a strong measure, as it is generally a sign of a well-managed company capable of producing steady, dependable, and material earnings growth. In this sense, Oracle fit the bill perfectly, but it took me nearly 2 months to slowly evolve my view of the company within a more accurate big-picture context to the point where I was comfortable buying it. Patience and a watchful eye. Because Oracle had originally broken out in early September 1999, well before the market had bottomed and turned to the upside again in late October. It was too early to buy the stock on that first breakout, and so it ended up backing and filling for another 6 weeks as it formed another consolidation or base on top of the prior handle from which it broke out in early September. I considered this lack of upside thrust as confirmation of my earlier assessment that the stock just wasn't showing the kind of earnings acceleration that I considered optimal at the time. Nevertheless, I kept the stock on my watch list as it built this second 6-week base on top of the prior handle consolidation, essentially forming a very powerful base-on-base formation. A base-on-base formation is often a powerful formation because it is visually showing you a stock that has broken out and really wants to move higher. But because the general market environment is not ready yet, for instance, is not in an uptrending bull phase, the stock simply goes about its business setting up in another consolidation or base just above the prior breakout point, as you can see in Figure 3.9, as it coils in anticipation of springing higher once the weight of the general market lifts. Oracle also flashed a volume clue in this second base as it pulled back sharply right after breaking out of the first base in early September. As I've labeled on the chart, you can see that this sharp pullback was very much like a little shakeout that saw volume pick up sharply as the stock bounced right off the top of the prior base and closed that day in the upper part of its daily trading range, a clear sign of support on the pullback. This was a critical clue that institutions used that pullback as a clear opportunity to accumulate Oracle stock in size. Oracle then spent the next 6 weeks, for the most part, moving sideways, even attempting to make one early breakout through the $12 price level that resulted in the stock backing down again and retesting its 50-day moving average. There was nothing wrong with Oracle stock on this initial breakout attempt that failed. It was simply that the market was not ready. This illustrates a strong concept of Livermore's that one must wait for the line of least resistance to be penetrated, and in Oracle's case, it meant that not only did the stock itself need to be set up properly, but also that Oracle had to be cleared for takeoff by the general market environment. Cleared for takeoff. Once the general market followed through in late October, Oracle broke out of this second base, as Figure 3.9 shows, and this was the correct time to make the trade. All the conditions had lined up properly so that the line of least resistance was properly penetrated, and the stock was free to begin its price climb. The weekly chart of Oracle in Figure 3.10 shows the volume support on the first week down in the second base of the base-on-base formation, as I've labeled. This is the type of volume support clue that can show up on the weekly and daily charts and which should always be watched for. This clue, combined with the strong base-on-base formation that essentially hugged the 10-week or 50-day moving average, was highly constructive as I saw it, and I began taking a partial position as the stock was working on the 6th week of this second base. When the market followed through and Oracle broke out through the top of this second base, the stock was off to the races. By mid-November 1999, Oracle had just about doubled, and I was riding a nice wave at the time. The daily candlestick chart of Oracle in Figure 3.11 shows this move in November. The small black triangles that start showing up on the chart indicate days where the stock was, at those points, trading up 12 out of 15 days in a row. And you will notice that Oracle showed this indicator for 12 days in a row before it finally started its first decent pullback and consolidation. The key here is that when a stock is up 12 out of 15 days in a row or better, it is showing exceptional upside thrust, and once the stock begins to consolidate this sharp upside move after breaking out of a proper base, it must be watched for another move and breakout to new highs, as this is a point where one should be willing to add to the position aggressively. In addition to the 12 out of 15 days in a row or better in the initial uptrend off the late October breakout, the stock had also dipped below its 10-day moving average, where it found support at its 20-day moving average. When Oracle cleared this little 3-week consolidation, it flashed a second major buy point, and so at this point, it was possible to add stock aggressively, which enabled me to ride the ensuing move through December right up into the year-end peak. VeriSign, the spice in the soup. We see in the Oracle example the idea that stocks that try to break out before the general market has finished correcting and turned back to the upside are often your strongest buy candidates once the market actually does begin a new uptrend. Given that I was long a quality big cap name in Oracle, I wanted to balance my portfolio with a hotter, newer name that I felt had huge potential given its exposure to the rapidly growing internet. One thing that Chris Casher and I had picked up on in 1999 is that earnings were becoming less a driver of stock price movement in an entire raft of recent new issues with business related to the internet, and many stocks with little to no earnings had been showing strength throughout the year. We discovered that the key metric in most of the sounder cases was not earnings growth, but sales growth. In a sense, this seemed logical since the internet was a rapidly emerging phenomenon, and the market accurately sensed that this would likely change the entire paradigm of how business was done, how society's vast libraries and sources of data and information would become easily accessible and hence readily integrated into the day-to-day activities of the average citizen, and how individuals would then conduct their personal lives and business with respect to online banking, shopping, networking, and more. In a sense, the market was trying to find a metric with which to measure those companies with the best potential to capitalize on this emerging phenomenon. And since many of these had very little to offer in the way of earnings growth, sales growth became the default metric. Among the stocks that had been trying to move higher before the market turned in late October 1999, VeriSign (VRSN) was one I was watching closely. In late August, it had shown signs of strong upside thrust and strength as it had cleared to new highs, and it subsequently began showing the little black triangles that indicate the stock is up 12 out of 15 days up or better as it was making those new highs, as we see in Figure 3.12. VeriSign offered a very compelling internet-related concept as a company that offered electronic verification and security products that enabled safe, secure online transactions to take place. This was a basic enabling technology of the coming wave of e-commerce stocks that were coming public, and from which big stock leaders like Amazon.com (Amazon) and Priceline.com (PCLN) emerged as survivors and de facto e-commerce industry group leaders. While VeriSign was barely profitable, given that it wasn't until the September 1999 that the company finally reported a profit of 2 cents a share after losing money since inception, it had logged 11 straight quarters of at least triple-digit sales growth. Here we find the sales growth metric coming into play over earnings. VeriSign was a dot-com mania play, no doubt about it, but institutional money was flowing into stocks like VeriSign, which appeared to me to be the leader in the brand new and rapidly growing field of online e-commerce security. Annual estimates for VRSN in 2000 called for earnings of 25 cents a share, which gave the stock a forward P/E ratio somewhere around 240. And by the time VRSN topped out in March of 2000, it was trading over 963 times 2000 estimates. This may appear nonsensical based on the 2000 annual earnings estimate of 25 cents. But when all the beans were finally counted after 2000 ended, VeriSign had earned 72 cents a share in 2000, nearly twice as much as analysts were diligently figuring in 1999. VeriSign's first breakout actually occurred in early October 1999, as Figure 3.12 shows, and the stock immediately sold off down to its 50-day moving average, where it found support and held. Obviously, if you had bought the stock on the first breakout, you would have been stopped out fairly quickly. But the key point here is that the first breakout on the chart occurred before the general market had logged a follow-through day and commenced a technical upturn and new market uptrend. The second breakout, which occurred in sync with the general market follow-through on October 28th shown in Figure 3.13, was the one to buy, because Livermore's line of least resistance had finally been pierced. Not only was VeriSign breaking out again through the 60 price level, but this time volume was even higher, and the general market was also moving into a confirmed rally, so that the market's tide was with VeriSign. Again, we see that the line of least resistance is not necessarily a rote technical concept relating to stocks breaking out to new highs, but also one of having all the conditions in place to raise the odds of success. You might say this is nothing more than waiting for all the ducks to be lined up in a row, and the general market turning to the upside was one such duck that was lining up in VeriSign's favor. VeriSign ran up very quickly, and like Oracle, was up over 20% in the first 2 weeks since breaking out in late October. This made things rather simple, since we operated on a basic rule taught by O'Neill that if you buy a stock as it breaks out at the pivot point, and it moves up 20% in 3 weeks or less, then it must be held for 8 weeks unless you are stopped out. Essentially, this meant that I was holding VeriSign for the rest of the year. I could breathe easy, because the only thing that could push me out of VeriSign at that point would have been a total and complete breakdown back through its original buy point at around the 60 price level. There was nothing left to do but sit and not think at the time, as I tried to live up to Livermore's idea of the uncommon man who can sit tight and be right. Sitting not thinking. At this point, I more or less let the trend run its course as VeriSign climbed higher, hugging its 10-day moving average all the way up, until it made a sharp move higher up toward the 140 price level, as we see in figure 3.14, a daily chart of VeriSign showing the insane move from a split, adjusted $60 at the initial breakout to over $200 in 2 months. While VeriSign held its 10-day moving average throughout its uptrend, and not that in some strongly acting stocks it is possible to consistently add bits to your position, as the stock trends up along the 10-day line. It did have one short spin out that occurred after the stock rapidly ran up from just below 100 to 140, a move of over 40% in 5 days. Note the reversal off the 140 price level, which occurs on less than average weekly volume. Given that VeriSign had started its move at 60, it was logical that this sort of short-term climax type of move would result in at least what Livermore would call a normal reaction and pullback. Perhaps most investors would have considered a move from 60 to 140 as enough, and thereby taken their profits, not wanting to be pigs. The situation here was not that VeriSign had gone up enough, but that it had done so in only about 5 weeks, and I was still holding the stock based on the 8-week rule for stocks that go up 20% in 3 weeks or less of breaking out. My rules said that the stock had to be held until at least year-end, to be, for lack of a better term, simply dumb and long. I've long been a fan of candlestick charts, simply because they represent another tool from which one can garner critical clues. In the case of VeriSign's pullback in the first half of December 1999, shown in figure 3.15, we can see that the stock, after reversing off the 140 price peak, then continued to pull back down for the next 4 days. On the 5th day down, the stock gapped lower on the opening, breaching the 10-day moving average for the first time since its late October breakout at the 60 price level. Note, however, that the stock held well above its 20-day moving average. The very next day, VeriSign gapped up on the open, completing what was quite clearly a morning star formation where the tiny little candle on the 5th day down represented the star in the pattern, and the long upside candle on the 6th day completed and confirmed the formation. The morning star setup is a very bullish candlestick pattern, and in a strongly trending stock like VeriSign was a clear point at which to add to the stock, even aggressively so. From there, it was simply a matter of letting the stock run right up to its year-end closing high, closing in on the top. VeriSign and Oracle continued to move higher in the first quarter of 2000, but there were enough warning signs to signal that it was perhaps time to exit the stocks, particularly as we moved into March 2000 when many big leaders were showing climactic types of upside price action typical of Climax tops. Oracle, shown in figure 3.16, built a short double bottom type of formation in January 2000 and bounced off its 50-day moving average on the second low of the double bottom, which was in fact the very first time the stock pulled back to that key moving average since it broke out and began its price move in late October 1999. This was a textbook secondary buy point, and the stock moved up off the moving average and into new high ground in February 2000. In March, the stock began to swing erratically, pulling down over 30% in late March, and then swinging right back up to its highs, volatility that was out of character for the stock. VeriSign, meanwhile, shown in figure 3.17, formed an improper double bottom base where the midpoint of the W comprising the double bottom base was higher than the peak on the left side of the base. In a proper double bottom, the midpoint will be below the peak on the left side, and this is often a flaw, particularly in a base that forms after a significant prior upside price move that can lead to imminent failure. In VeriSign's case, we see that after breaking out from this improper double bottom base, the stock rallied another 25% before rolling over and topping for good. In most cases, the big gap down move off the peak in early March on huge volume was enough to tell you that the move was likely over. The theme of success. In the process of making over 1,000% in 1999, some clear themes are evident. The first theme that I believe is most important for investors to understand is the idea that it was not necessarily my thinking that made me so much money. It was, rather frankly, the size of the wave I was riding, and the dot-com bubble bull market of October 1999 to March 2000 was a wave of epic proportion. Just before this massive upside wave appeared, you can see that neither I nor Bill O'Neill, nor perhaps anyone else in the market, had any inkling of what we were about to experience. But when the market turned, despite the fact that we were fairly discouraged and fed up with the market in mid-October 1999, we simply followed our rules and turned with it, buying stocks showing what we believed were driving characteristics that would attract institutional buyers. I didn't make 1,009%. That was the exact number because I was some sort of genius. I simply saw a wave coming and got on with absolutely no idea how long or how big the ride would be. Some simple rules, such as holding a stock for a minimum of 8 weeks if it moves up 20% within 3 weeks or less of initially breaking out, provided a simple collar that forced me to hold my positions. In a sense, the rule was proven to be quite valid. Like a surfer who simply jumps on the wave and lets it run its course until it closes out and forces him or her to exit, you simply exercise all your basic rules and techniques to identify, monitor, and then buy a leading stock just as it breaks through the line of least resistance, where all conditions are lined up like ducks in a neat little row. To a large extent, I think you can chalk up my 1,009% performance to being at the right place at the right time. Two hot, fast-moving stocks during one of the biggest bubble bull markets in history. Of course, as Bill O'Neill used to tell me, sure, there is an element of luck in that you rely on the magnitude and duration of the bull market to keep your stocks moving higher, but you have to put yourself in those stocks at the right time. In essence, you must work hard to create your own luck. Making 1,009% also did not require that I be diversified in a number of names. I only needed Oracle and VeriSign, and in any real bull market, this will always be the case. Find 1 or 2 big winners, and you will put yourself in the position of making big money in any bull market if you handle them correctly. Oracle and VeriSign also did not have picture-perfect fundamentals, but understanding their respective roles within the internet boom was critical in understanding that they would be big stocks. In other words, that institutions would have to buy them. This is critical, and it is what Livermore meant when he advised investors to stay in the strongest stocks within the strongest groups. Another point is that it was necessary to understand that the performance of stocks like VeriSign, which was making a mere 2 cents a share in the September quarter of 1999, were being measured and evaluated on the basis of a metric not within the standard, slim fundamental template. In order to capitalize on VeriSign, I had to figure out that it wasn't earnings growth that was the driver, but sales growth instead. This was decisive in determining the potential for VeriSign. Also, VeriSign is a clear example of why P/E ratios are quite simply a non-determinant for potential price performance in a stock. P/E ratios don't matter because the facts prove that they don't. What I consider to be the most fascinating lesson of my experience as an investor in the dot-com bubble market move that occurred in the last 2 months of 1999 is that absolutely nobody saw it coming. 1999 proves that a big bull market generally will come when nobody is expecting it. So you must never assume that you can completely ignore the market just because you think it isn't right at any particular point in time. Things can change very quickly in the stock market, and you must absolutely remain attentive and flexible in order to capitalize on what can become opportunities of a lifetime. The final lesson here is that the basic principles I employed in 1995 and 1999 are easily accessible to any investor who is willing to spend the time and effort to learn them. There is no real magic, since to me successful investing is simply about finding a way to get on board a market-leading big stock and then hanging on for as much of the ride as I can. In my view, if I can do it, anyone can. I didn't set out to make 1,009% in 1999. I simply put myself in position to capitalize on the biggest bull market of my career at a moment when the ultimate result was unclear and certainly unknowable at the time. But all the conditions were ripe for pushing through the line of least resistance. It was simply a matter of being there when that line was pierced, and then letting the market's trend take care of the rest. The secret ingredients. The past 2 chapters have given you a first-hand view of how big money is made in the market. You may have been surprised to find out that it is not rocket science. The most important ingredients are a decent bull market trend and sound buy and sell rules. There is no need to out-trade the market, staying ahead of every wiggle in the general averages. This only puts one in the position of having to be right far too often. It is better to figure out where you are right, and then sit tight. So once one has latched onto a big, winning stock, sitting more and thinking less are the 2 most critical ingredients when it comes to making big money in the market. Hopefully, you have gained some insight into where one should focus one's attention. Most big, winning stocks, if you use any of the O'Neill tools to screen the market for stocks, will be in your face in a bona fide bull market. So it is not as if strong, leading stocks will be hard to find in a bull market. In most cases, it is simply a matter of finding a proper, low-risk entry point, paying close attention to and watching for proper secondary buy and add points as you build and concentrate your position, and then letting the market take care of the rest. Ironically, we find that when we are making big money and our decision-making is flowing well as we trade in the zone, it begins to feel effortless. The key is getting to that point, which is what the rest of this book is about. Chapter 4, Failing Forward. There have been many times when I, like many other speculators, have not had the patience to await the sure thing. I wanted to have an interest at all times. You may say, with all your experience, why did you allow yourself to do so? The answer to that is that I am human and subject to human weakness. Jesse Livermore, How to Trade in Stocks. As long as the human element is involved in the investment process, then mistakes can be relied upon to litter the landscape of that process. Why do we screw up? Because we're human, a simple answer to a complex problem and perhaps the most difficult aspect of investing to contend with. Failure can result from a single mistake, or even a series of mistakes, whether big or small, which often take on a snowballing effect that reaches a final, painful, and climactic conclusion. When failure sets in, and the full extent of the damage inflicted thereby can be assessed, it can be a rather mind-wrenching affair. In the end, however, it can serve as a highly constructive cleansing process, and only by understanding the genesis of our mistakes can we begin to correct them. In this chapter, we examine some of our biggest mistakes, analyzing through them step by step, as we discuss our thinking and decisions in real time during these periods when we ran into difficulty. More importantly, we show how we gained knowledge by treating our mistakes as useful market feedback, which was then put to profitable use by forcing us to devise solutions and evolve our methods in order to ensure that such mistakes did not occur again. Oftentimes, the mistakes themselves led to the creation of entirely new trading methods or techniques, such as the pocket pivot, or the broader understanding of concepts, such as what we refer to as the big stock principle. In this way, we are able to demonstrate how mistakes are not the bane of traders, but rather the way in which the market lets traders know how and where they need to adjust, correct, and adapt. By accepting our mistakes as part of the market's greater feedback system, we are able to use them to our advantage over the longer term rather than letting them destroy us. As a trader and investor, you will make mistakes. That is perhaps the only thing we can guarantee about investing. You may make money in the markets, you may even make your fortune in the markets, and you might even find investing rewarding on a number of non-financial levels. But in the process, you will make mistakes. The mistakes may be isolated, or they may pile up as you drift into the realm of a trader's slump. Such slumps are characterized by periods where you may actually start to believe you have no idea what you are doing. Nothing works, and every trade you put on is like a boomerang that immediately circles back and whacks you on the head, or perhaps some other, more vulnerable part of your anatomy. When this happens, it feels very much like what Bill O'Neill used to describe to us as getting kicked around real good. We have both experienced such periods, and we believe strongly that what distinguishes great traders from average traders is the ability to recover and rebound strongly from a single mistake or a full-blown trader's slump. Trading in the markets requires courage, resilience, and persistence, and it is these traits that will serve traders and investors best whenever they run into those inevitable periods of screwing it all up. We've all done it, whether we are considered expert investors or not, and that is because, as Livermore observed, we all remain, in the end, quite human. As a trader and investor, insulating yourself from your humanness will likely remain the biggest challenge you will face throughout your trading career or avocation. The psychology of success lies in taming the ego. Ironically, one of the biggest causes of failure can be success itself. This may sound strange, but big initial success in the stock market, as defined by achieving a return well into triple-digit percentages, can easily give one a false sense of investment omniscience and omnipotence. However, it is an extremely destructive illusion rooted in the ego. As a trader, your ego is always your enemy, because, as Eckhart Tolle wrote, the ego is always on guard against any kind of perceived diminishment. It is much more interested in self-preservation than in the truth. Bill O'Neill warned us, as we have recorded in our trading diaries, that we should never let the truth become your enemy, and traders who operate within the realm of their egos set themselves up for exactly that. This inflated sense of all-knowing invincibility was rampant in many investors during the dot-com mania of the late 1990s, and it eventually led to the demise of various colleagues of ours who had made piles of money during the bubble market and had sold out reasonably well near the top. However, some began to believe that it was due entirely to their brilliance and that they could make it happen with a wave of their newly found magic investment wand. Thinking that this Midas touch of theirs would last forever, many bought monuments to their investment genius, such as fast cars, second homes, and NetJets memberships. All of this was then reinforced by their own projections of how much they would be worth in 5, 10, 15 years at their current rates of ROI, or return on investment. Some quit their jobs at William O'Neill Plus Company, Inc., where we were working, to open up their own shops or go off as independent portfolio managers in 1999 and 2000. Such career moves were made by these traders on the premise that they had completely figured out the markets, even though they had only traded through one brief market cycle, let alone not having had at least 10 years of trading experience in the market. In a way, big success in the market can become like Mickey Mouse's enchanted broom in the classic animated movie The Sorcerer's Apprentice. In this classic Disney allegory, Mickey is able to use his rudimentary magical skills to induce a broom to do his work for him, but soon finds that his control of the broom is not as complete as he was led to initially believe, given his success in casting the initial spell over the broom. Ultimately, the broom ends up causing a great deal of damage because Mickey doesn't have sufficient knowledge to control it. In the same way, a little success in the stock market can be a dangerous thing. As Bill O'Neill once told one of us, you start making big money in the market and you think you know something. You don't know anything. It's the market that knows something, not you. This is a fundamental truth of investing. It's the market that knows something, not you. Your job is just to learn how to read and follow the market. The problem is that once you start making big money in the market, you begin to think you've figured out the market and that it's you and not the market that knows something. And so you start telling the market what to do and where you think it should go, which only serves to take you away from the correct, pure approach of watching the market day to day, simply striving to listen to what it is telling you. Ultimately, All you are setting yourself up for is the opportunity to be taught a brutal lesson by the market, which will be more than willing to show you who the boss is. All the intellectualization in the world has never been shown to accurately predict the future of the market. For example, Alan Greenspan's famous irrational exuberance speech in 1997 was 3 years short of the actual bursting of the dot-com bubble. Many lost big, and much opportunity cost was born attempting to call the top of that market based on what one thought should occur, and that the market's rallying tendencies were unjustified and based on irrational exuberance. The more successful you are as a trader, the greater the tendency over time to try to impose on the market that which you think should occur. The other problem with making big money in the market is that we live in a society that measures success by material acquisitions. Therefore, becoming a servant of your ego after experiencing a period of great success in the markets is a trap that is quite easy for a trader to fall into, given that our modern, materialistic culture encourages such behavior. Anybody who has read Trader magazine gets a front-cover view of the shallow standard of conspicuous consumption and materialism that allegedly drives the trader psyche. Big houses, fast cars, private jets, fine wines, expensive watches, and more are worshipped as signs of success among traders, and are offered up as the ideal of what successful traders should aspire to. We could not disagree more. In our view, material self-gratification should never be one's motive for trading. The best traders generally find that their greatest sense of satisfaction, those moments when they are most at peace, occurs when they are simply trading in the zone. In this sense, being a successful trader is nothing more than seeking bliss through practicing one's craft well. Ultimately, it is not about the money, although it is true that being a successful trader can make one wealthy, just as being successful in a variety of other vocations can make you wealthy as well. We, however, would urge traders and investors to focus on the joy of practicing their craft and to seek that as their fulfillment. Success and making big money in the market will flow from that ethic. And when you do make big money, as much as possible seek to use your wealth to simplify your life, not to make it more complicated by encumbering yourself with a portfolio of excess materialism. In our view, Henry David Thoreau expressed an ultimate truth when he wrote, "A man is rich in proportion to the number of things he can afford to let alone." Walden, or Life in the Woods, Boston, Ticknor and Fields, 1854. So, as you realize your destiny as a successful trader making millions in the market, ask yourself whether it is worth using your wealth for the purpose of acquiring so many things that in the end, they may end up owning you more than you own them. By seeking to maintain such O'Neill-style ethics, you lay the groundwork for successful trading over the long term that will not result in your ultimate demise, as you avoid the materialistic ego traps that suck in not just traders, but many other members of our society in any number of walks of life. Preoccupation with trading and investing as a way to satisfy the needs of the ego is a recipe for disaster. This materialistic ethic stems from a basic lack of understanding of what investing is when distilled down to its essential reality. Like surfers who ride the momentous mass of ocean waves, we must realize that we are not the wave, we only ride the wave, and our skill is in assessing the size and duration of the wave in order to maximize the ride we are able to sustain, and this is the only factor we can control. Ultimately, it is up to the wave to decide just how big and how long a ride we get. The best ocean wave surfers in the world carry with them a sense of humility based on their experience, which has led to the respect and the deep understanding they have for the power of the ocean and the immense natural forces that drive its movements. In the same way, as traders, we must develop a respect for the power of the markets and the immense natural forces that drive them. The market is simply Wyckoff's mass mind, and by understanding the message in the market's movements we can maximize our ride. Like a surfer, misjudging or losing perspective of these forces as we instead emphasize service to the ego can result in a trader being swept away by these same forces and smashed upon the rocks of bad, ego-based investment decisions. As traders, we must remain mindful of these forces, and hence develop a strong sense of humility as we operate in the face of such forces. Bill O'Neill used to tell us that nothing destroys a trader faster than an inflated ego. In observing Bill, we noticed he never let his winnings or his losses affect his judgment, and he never got excited when he was making big money. Even if you called him during a big-up day in the markets when you were excited, such as in late 1998 when we owned the big leaders in the market and they were all running like mad to the upside, he was fairly blass about it all. After expressing your excitement to him about how fast these stocks were moving to the upside and how much money we were making, Bill would, after listening quietly, let out a long, whooshing sigh, the sigh of exasperation, and respond with a curt, "Don't talk about your stocks," before abruptly hanging up. It was his own way of saying what Gordon Gekko, the lead character in the movie Wall Street, meant when he said, "First rule of investing is never get excited about stocks, clouds the judgment." To eliminate the ego, you must move beyond your thinking mind to observe how you feel and how your emotions are affecting your physiology. Is your breathing shallow or swift? Is your heart beating faster? Are your palms sweating? You feel powerful? Do you feel frustration? You feel elation? You feel hope? Or do you feel a sense of dread? Maintaining awareness of these emotional factors keeps you from becoming wrapped up in them. Eckhart Tolle's books, starting with Practicing the Power of Now, deal with this topic in greater detail, which we will also discuss more fully in Chapter 10. He explains that emotional states are simply traps that we allow our thinking mind to fall into. By remaining in the present and aware of when we are falling into one of these emotional traps, whether a negative emotion like frustration or a positive one like excitement, we simply act and flow in the moment, unencumbered by the ego mind. Eliminating the ego also means understanding what your motives for trading and investing are. If you look at trading as solely a means to an end that is primarily materialistic, then you may be more vulnerable to expressions of ego. There is certainly nothing wrong with enjoying the fruits of your labor, but it is necessary to keep it all in perspective. Bill O'Neill would put it in very simple terms. Now don't start getting carried away with yourself. Finally, always maintain a healthy sense of humility and respect for the markets. They operate according to forces that are far larger and far more powerful than we are, and our only task is to try to profitably synchronize our investment decisions to the movements of these immense forces. We ourselves are not the forces, and likewise we do not control them. Like the fishes in the sea, we can only move with them, avoiding the devastation that resistance inevitably brings. Learning from our mistakes. Having both invested in the markets for just about 19 years now, we have logged a sizable blotter of mistakes, some bigger than others. Some mistakes have to do with the macro view of trading, while some are more specifically related to trading mechanics. In some cases, mistakes have led to significant new developments in our trading methods. In this section, we will examine some of the more significant mistakes from 19 years of investing in the markets and the solutions or lessons that were derived from these experiences. A case study in overconfidence, Gil Morales after I made big money in 1995. As I discussed in detail in Chapter 3, I was on top of the world. For the first time in my life, I had a significant amount of money to my name, well into six figures, and to quote Gordon Gekko in the movie Wall Street, at the time it seemed like all the money in the world. That money alone would have been enough to get carried away with, but another force was working to help inflate my ego. As a broker at Payne Weber, Inc., now part of UBS Financial Services, my success in the market was also spilling over into my business, which was taking off as well. And as an emerging big producer, I was given a big, new office with floor-to-ceiling windows on the 30th floor of the Twin Towers in Century City. A city only in name that is essentially a posh cluster of high-rises wedged between Beverly Hills and Santa Monica, California. In many ways, Century City serves as a stylish urban setting, away from the grime of downtown Los Angeles some 8 miles to the east, that houses the financial, legal, and talent businesses that serve the entertainment industry wealth that resides in the hills separating West Los Angeles from the Valley of San Fernando. It is, as some might say, a preferred venue. If there is any single industry where egoistic materialism and self-indulgence are acceptable, even glorified traits, the retail brokerage business is it. Where else is one likely to witness two brokers getting into a steamy feud over who has a real Mercedes-Benz? And of course, there was what I dubbed the peacock syndrome, or the tendency for retail brokers to strut around in their well-tailored raiment. Many brokers took serious, perhaps far too serious, pride in their suits, shirts, ties, and shoes. How you folded your handkerchief and placed it in your suit jacket breast pocket, whether you used a single or double knot on your necktie, whether your cufflinks were sterling silver, and other pointless fashion details were given special regard. You might often find a small group of 3 or 4 brokers in the office admiring each other's tailored suits. Those who did not conform were scorned. I recall one broker who fancied himself as a broker to the stars, making fun of my eyeglasses. This struck me as odd, because up until that time, I had taken a rather utilitarian view toward my ophthalmologic needs, and had no idea my eyeglasses would become criteria by which to judge my fashion worthiness, and hence worth to society, at least by the standards of retail brokers. Such was the culture of consultative sales in the financial industry. When I was new in the business, one of my sales managers admitted to me that he wanted new FCs, financial consultants, to buy a big house and an expensive car, and to get heavily into debt doing so. That way they would be highly motivated to work hard and sell in order to afford their lifestyle. The need for things and more things provided the essential Pavlovian stimulus necessary to inspire brokers to push the sales process along. It seemed that this basic premise provided the foundation for the retail broker culture that I was in at the time. The need to express one's worth through mindless materialism forced brokers to sell, and it was management's desire, if not its unstated goal, to have their brokers, their sales force, out there selling with such material needs in mind. All of these factors were stewing together in a toxic brew that caused my ego to mutate into a large, bulbous mass. I now fancied myself an expert investor of Livermorian stature, and I began to believe that I could employ my hunches on top of my investment system. The fact that I had made over 500% in one stock, see Cube Microsystems, Cube, the year before had confirmed my skill, had it not. Reading through O'Neill's book, How to Make Money in Stocks, one can find mentions of investors making 100% or 200%, but I knew of nobody who had ever made over 500% in 1 year, and so I was sure that this made me special. Unfortunately, I neglected to inform the market of my specialness, as it was getting ready to inflict some painful lessons on my inflated ego. The Lumacies lesson, in November of 1995, a new company named Lumacies, Inc. Lumi came public, and at the time I was very impressed with its business, which consisted of technology used to digitize images for the medical industry. I saw this as revolutionary stuff, similar to what C-Cube Microsystems had done with their technology compressed video images for transmission over the internet and on personal computers. To me, Lumacies represented another company utilizing another type of image-related technology to create innovative new products that changed and made far more efficient the way physicians and medical staff used and accessed medical images such as X-rays. It had to be a winner. I was sure of it. When Lumacies came public in November of 1995, I was still busy with C-Cube, and so it was easy to remain disciplined and wait for Lumacies to form its first base. This did not occur during April 1996, and by then, I had been out of C-Cube for a few months and dabbling here and there with new stock ideas that were not altogether working too well. In 1996, I was relying primarily on daily graphs for my charts, and so was focused mostly on the dailies. Figure 4.1 shows the daily chart of Lumacies in April 1996 when it came flying out of what looked like a 5-week base to me at the time. And because I was already in love with the company's products, I didn't need too much persuading to buy what I saw as a perfect massive volume breakout. However, it did not turn out as perfectly as I thought it would. In Figure 4.1, the daily chart of Lumices from April 1996, the trendline breakout looks quite impressive as it occurs on the largest daily volume spike in the entire chart going back to the November IPO date. The breakout also occurs after a shakeout below the 50-day moving average on increasing volume, which I saw as setting up a shakeout +3 type of buy signal where the stock drops out below the prior lows of the base at around 18 or so, and then turns back to the upside. This constitutes the shakeout, and adding 3 points to the support low at 18 gives you a buy point at 21, so that when the stock comes through that 21 price level, it is generating a buy signal. In the case of Lumices, I had a trendline breakout and a shakeout +3 buy signal. In my mind, this made the breakout even more powerful. Given that I already had a prior bias, and that I was already in love with the company's products, I bought this breakout hand over fist in a sheer fit of overconfidence. One mistake breeds more mistakes. The first mistake I made here was having a prior bias in that I already believed that the company's products made it a sure win-win situation now that the technicals look to be falling into place. While you can use your knowledge of a company's business and product line to help develop conviction in a potential winner, such conviction should never be allowed to override your basic system of stock selection and management. Your reasons for buying a stock should first be based on how well it fits the criteria for you to take action on it, based on your particular investment. What you are able to learn about the company should then help you develop the conviction necessary to fully capitalize on a potential big, winning stock. However, such knowledge should never get in the way of operating solely by your investment methodology. It should not work the other way around. Don't fall in love with a company's business unless and until your system is telling you to buy the stock for the right reasons first. I was doomed from the start by being in love with Lumices before I had ever bought a share of the stock. This was a classic case of getting the cart before the horse. My overconfidence was further encouraged by the fact that I thought that 2 buy signals, the trendline breakout and the shakeout +3 buy setup, somehow gave added power to the stock's big volume move run for new highs. On this basis, I bought the stock aggressively. When I think back on this, my IVE amazes me, and studying old charts of Lumices makes that fact even more apparent. Probably the most painful thing about reviewing one's past mistakes is seeing just how much capacity one can have for making incredibly stupid investment decisions. Figure 4.2. Another daily chart of Lumices breakout shows some other flaws I did not consider in the stock's chart back then. The first was the depth of its base, and the fact that the stock came up straight off the bottom of the base without taking any time to digest some very rapid gains as it motored back up through the 50-day moving average and toward new high-price ground. The second mistake was getting aggressive, that is, buying a large position in a stock that traded only 120,000 shares a day on average. The price move that followed the breakout was very playable as a short-term trade actually, and if one had recognized the flaws in the breakout, one could have sold and taken a profit. Instead, I was convinced I had another C-Cube Microsystems on my hands, and since I was convinced of this, it was only a matter of holding the stock long enough to realize the huge upside price move. The weekly chart of Lumices, figure 4.3, also reveals that the 5-week base I thought I saw on the daily chart was only a 3-week base. The first 2 weeks of the base, as I saw it, were actually up weeks, and it is only on the first week down that we begin counting weeks in a base. Also notice that those 2 weeks had very wide weekly ranges and closed mid-range. The base itself was not long enough to properly consolidate the move the stock had made from the time it went public in November 1995 to April 1996. That move was a threefold move, and it is likely the stock should have built a longer, more constructive base of at least 6 weeks in order to properly digest the prior upside move. On top of it all, even if Lumices' base had been 5 weeks in length, this still would have been too short for a first stage base. Generally, second stage base breakouts can have a base length of 5 weeks minimum, but a first stage breakout should likely put in more time in order to properly set up a big intermediate term price move, particularly if the stock has had a big upside move prior to building its first base. Once Lumices had broken out, it ran up more than 20% in only 3 weeks, thus causing me to invoke the 8-week rule, whereby a stock that is able to break out and move up that far that quickly must be held for at least 8 weeks. As you can see in figure 4.3, sitting with the stock for 8 weeks resulted in getting blown out of the position as it broke down below its original breakout point and headed back to its original IPO price. Lumices leads to broader understanding of O'Neill methods. While Lumices was a painful lesson, it did help me refine my technique a bit. The first thing I did was stop falling in love with and trying to figure out great company concepts before the stocks themselves showed up on my radar screen. Unless and until the stocks showed up in my weekly scans of the printed daily graphs books, they were not to be bothered with. From then on, I would never buy a stock without consulting a weekly chart to make sure I was buying a stock that has built a proper base of at least 6 weeks in length. Also, first stage bases had to be a minimum of 6 weeks in length. Second stage bases of shorter 5-week durations would be acceptable, but for first stage bases, the stock should be coming out of a longer consolidation and certainly no less than 6 weeks in length. I did not address the problems created for me by the 8-week hold rule, since I believed that had I paid attention to the initial factors, such as the improperly short base, I would not have been placed in the situation of invoking the 8-week hold rule to begin with. Based on the difficulty I had in selling the stock because it was so thin, I established a rule of never buying stocks that traded less than 300,000 shares a day. I recall quite clearly when Lumices was breaking down and how I was frantically trying to sell the stock. For me, the situation was exacerbated since I had a number of clients in the stock as well, and I had to get them out first. Every time we entered an order to sell, it took several minutes to get filled since we had to go to outside market makers in Lumices and bids were scarce. I was so shell-shocked by that experience that I vowed to never buy another thinly traded stock. Back in 1996, 300,000 was a reasonable minimum average daily trading volume requirement number. But these days, I use a minimum of 350,000 to 500,000 shares in average daily volume when screening for stocks on the long side, and prefer to buy stocks that trade into the millions of shares of stock a day. When I conducted my post-analysis on my Lumices mistakes, I looked at other historical big winners that started out as thinly traded stocks, and I noticed that while they would start out as thinly traded stocks, once they asserted their roles as serious market leaders, their average daily trading volume would increase substantially. In general, average daily volume is a sign of the types of investors trafficking in any particular stock. Stocks with heavy institutional participation tend to be highly liquid and relatively actively traded. Thus, the higher the average daily trading volume in a stock, the more likely it has strong institutional participation and sponsorship. As well, I determined that waiting for an IPO's average daily trading volume to mature as institutional interest and participation in the stock increased over time was a good way to determine when a stock was approaching big stock status. For instance, one that was gaining a strong institutional following, and hence could be nearing a strong upside inflection point. This was a key discovery that resulted from my Lumices experience, and in the end likely made it worth the high tuition that I was charged for the education. To illustrate this concept of average daily trading volume maturing as a stock gains leadership status and a larger institutional following, we can observe the weekly chart of Crocs, Inc. Crocs from 2006 through 2007, figure 4.4. Note that the small gray line running through the volume bars, the 10-week moving average of volume, steadily moves higher as institutional investors flock to Crocs. In this case, the significantly expanding volume reached a critical mass in April of 2007, when Crocs assumed the role of a major market leader in the 2007 bull market and began to move sharply to the upside. The big stock principle is born. My experience with Lumices served as the genesis for what eventually became my big stock principle, a basic underlying principle of O'Neill methodologies that slowly dawned on me over the next couple of years. The essence of the big stock principle is that in any economic and market cycle, certain companies appear on the scene that represent the leading edge of what is happening in the economy with respect to the new industries, new economic developments, and other themes that serve as essential drivers for the economy at any given point in time. In turn, because of their status as key companies representing the niches of growth, whether broad or narrow in any given economic cycle, institutions have no choice but to own these stocks, and once they do, they tend to be a staple of institutional portfolios through many market cycles, even when they aren't bona fide leaders. In the 1970s, these were stocks like Pick and Save and Tandy Corp. In the 1980s, they were stocks like Intel Corp., Inc. and Microsoft MSFT. In the 1990s, America Online, AOL, and Cisco Systems, Cisco. In the 2000s, names like Amazon.com, Amazon, Apple Inc., Apple, Google Inc., Goog, Baidu.com, Baidu, and Research in Motion, RIM, to name just a few from each cycle out of many, many more. These are the stocks to own in any bull market cycle, as they represent the areas to which institutional research will direct money flows and in the process create huge upside price moves. As well, because of the broad, committed institutional sponsorship in these stocks, you have a sort of insurance policy when these stocks sell off, since there are usually logical pullback areas where institutions will naturally come in to support their positions. One of the key characteristics of big stocks is that they don't trade 120,000 shares a day on average. They trade several million. Unless there is a cartel of grandmothers out there who, instead of buying 2 shares each of Microsoft and AT&T, are buying large blocks of leading stocks, it is institutional money that drives the market, and it is in this river of money flow where you want to set yourself right into the middle. And the only way you can do that is by striving to own the big stocks in any market cycle. My horrendous experience in Lumices led me on the path to discovering for myself this big stock principle, as I realized thinly traded stocks cannot possibly be big stocks. It was not until December of 1998, when I was long a huge position in Charles Schwab and Company, Schwa, as it was rocketing to the upside figure 4.5, that I received a quick call from Bill O'Neill, who liked the look of American Online, AOL, another fast-moving winner in the late 1998 bull market. The funny thing about AOL was that during workshops that we also presented at, albeit in a supporting role, Bill would sometimes get moving very fast as he discussed with the audience various leading stocks from many different historical market periods, rapidly pulling up data from his memory. He would refer to AOL as American Online instead of America Online, which is the correct name. If you understood how Bill's mind works, which is essentially a vast database of stock market history and information, you realize that this was due to a wire in his brain that was crossing over another wire that was remembering when American Airlines was a huge winner back in 1962, 1963, when the market started a big rally right in the midst of the Cuban Missile Crisis. I answered the phone, and Bill said one thing, AOL, now that's a big stock. At that point I had an epiphany, complete with trumpets trumpeting and angels heralding, as the skies opened up and the big stock principle suddenly became clear to me. I also found that the big stock principle is also at work in short selling, since the best short sale targets in a bear market are precisely those stocks that were the big leaders in the immediately preceding bull market phase. Institutions that have loaded up on big leaders will in turn create a wave of selling that continues to wash over the stock in a sustained downtrend during a bear market, and we will have more to say about short selling when we get to Chapter 8. Missing the move in solar stocks, Gil Morales. One of the primary pitfalls, at least for me, of managing money in the public realm and with other partners in your money management firm is that you will be subject to outside influences from clients and business associates who have their own sets of emotions and opinions. Not that this is necessarily bad, but you have to insulate yourself from these influences, in spite of how difficult it may be in real time, particularly if such individuals and influences come from an academic point of view that is outside one's investment methodologies, epistemology, so to speak. In September-October 2007, I went long a number of solar stock names at exact, perfect buy points. One of my biggest positions was in First Solar, FSLR, which I had correctly identified as one of the big stock solars, and which was forming a jagged cup with handle formation similar to what America Online AOL had formed in October 1998, just before it launched on a 67-week, 460% price run to the upside. The weekly chart of First Solar, FSLR, in figure 4.6 shows the jagged cup with handle formation. I had noticed this pattern setting up before the breakout, and the 3 weeks that closed tight around the 10-week 50-day moving average looked very constructive. I also put together the idea of AOL as a precedent for a jagged, V-shaped cup with handle formation that worked quite well in late 1998 to early 1999. The similarity of FSLR's chart, figure 4.6, to AOL's from 1998, figure 4.7, was very compelling, and the solar group as a whole was also starting to set up technically, with a number of strong patterns in several other potential solar leaders. FSLR also had an interesting, lower-cost technology that did not use the more common polysilicon in its solar cells. In 2007, shortages of polysilicon gave FSLR's non-silicon, thin film technology an advantage over its polysilicon-dependent competitors. This was my big solar stock, and I was playing it big, buying shares along and around the 50-day moving average and the $100 price level before the stock began to break out. On September 21st, volume in FSLR began to pick up early in the trading days, so I began adding to my position, as I intended to get very heavy in the stock on the breakout. You could not ask for a better buy situation, both in FSLR and the group at large, which was breaking out en masse. With such group confirmation, it was clear that a major group move was taking place. As a group, the solar stocks offered a compelling, buyable group opportunity since the 1999 move in .com, internet-related stocks. Cup with handle bases were seen in stocks like Suntech Power Holdings Co., Limited, SDP shown in figure 4.8 as well as Jaso Corp., Jaso, shown in figure 4.9. On Friday, October 17, 2007, my business partner wrote me the first of what became a long chain of emails on Friday and continuing into the weekend, where he insisted that the market was not acting right and that I should lock in gains of around 10% that I had as of Friday's close. To understand how far away this type of thinking is from my style, I should point out that movements and hence gains of 10% are actually quite minuscule relative to the normal volatility and movement I experience given my specific investment approach within my overall methodology, which dictates that one let one's winners run. One email, which was written with a tone of supercilious authority, in my view, argued against my view that we were in a window of opportunity. I've gone back to 1985 looking at periods when a NASDAQ rally has occurred on conspicuously light volume, including a dearth of major accumulation days. The only NASDAQ advance that even comes close to the present one, when measured by either light volume or major accumulation days, was the July 16, 1996 move, which showed only one major accumulation day in the first 8 weeks, but then showed a bunch of them from that point on. As you know, light volume reflects uncertainty among market participants. My big mistake was in entertaining such drivel. The fact is that I was taught by Bill O'Neill to watch my stocks first and the action of the indexes second. Indexes can weaken, sometimes having intermediate corrections of 7–12% with leading stocks holding in tight and building normal, constructive bases. To unload your holdings on the basis of what the indexes are doing is ridiculous given this basic concept. I replied to my partner by citing this exact principle. I received the following response. At different times, yes, I believe the leaders do provide subtle hints and are more important, e.g., dozens breaking out while the averages languish following a correction. However, the leaders can only go so far amid shoddy demand in the general market. What makes this exchange so comical is that the immediate week before the weekend, when this email exchange took place, I had told my trader and director of trading, Bill Griffith, that the move in solars was significant, and that we were in the middle of a perfect window of opportunity to make some decent profits going into year-end. I also felt that the mass, group breakout in solars, with so many of them simultaneously forming perfect base formations such as we see in the charts of FSLR, SDP, JASO, and Espira figures 4.8 through 4.10, was signaling a significant move was underway, and hence a fantastic profit opportunity. Given my experience and the fact that I know the market always tries to buck you off your positions, I told my trader, Bill Griffith, that we would have one hairy pullback before these things launched, and that we must do everything we could do to hold our positions in solar stocks given some basic parameters that gave the stocks room for a shakeout. During that trading week, I had also taken a position in another solar that had broken out and was in the middle of an upside run, Sun Power Corp. Espira shown in figure 4.10. On October 18th, Espira staged a big outside reversal to the upside on huge volume. Given that the solar group was on fire, I viewed this big volume turnaround as quite positive and took a position in Espira in one of my funds in the mid-90 price area. In hindsight, I am amazed at just how perfectly the ducks lined up in September-October 2007. Unfortunately, the barrage of bearish emails from my partner over the weekend of October 17-19, worried about locking in profits, as well as numerous stories in the media over that particular weekend about the market's resemblance to October of 1987, the infamous Black Monday crash, started to unnerve me and essentially threw me off track. On Monday, October 22nd, the big shakeout that I had told my trader was coming and through which we must strive to hold our solar stock positions, finally came. Because I had allowed the influences of the bearish media and a bearish business partner within my money management firm to shake me off my predetermined path, I veered from my plan. I had already laid out the parameters of how I would handle a nasty market shakeout, which I was fully expecting sometime in October, and I had complete conviction in the solar stocks given the evidence of all the ducks lining up in a row in the group and the window of opportunity that was opening in the market. The lesson here is clear, and I want to make it plain that I do not blame my former partner or the media. I blame myself because I violated a simple premise of trading, and that is to plan your trade and trade your plan, alone and free of distractions from the emotions and opinions of others. Despite the fact that I knew I was in all the right stocks at the right time, on Monday, October 22nd, I dumped my FSLR and other solar stocks, overcome by the fears induced upon me by external influences. As figure 4.11 shows, FSLR simply shook out below its 20-day moving average, closed up on the day, and never looked back. I had a huge position in that stock, and I dumped it all that day. I tried to come back into the stock later on over the next few days after dumping it, but being so shell-shocked by the initial mistake, I never got my position back. The irony is that on the same day FSLR reversed and closed back in the black and above the 20-day moving average. This is in fact a pocket pivot buy point. I could have simply recognized this and bought all my FSLR back, and then some on the very same day I sold it all. In addition to having the pocket pivot point weapon I didn't have in 2007, today I also use a rule of letting a stock close before selling on any break of the 20-day moving average, as stocks often will reverse intraday to close back above the moving average. If I had this rule then, I would have held FSLR on October 22, 2007. Rather than using a moving average, such as the 20-day or 50-day line, as an absolute barrier, I now view moving averages as the median of a zone, and instead watch how a stock acts around a moving average. Stocks can frequently venture below a key moving average on a short, intraday basis, or even for a day or two or more, before climbing back above the moving average. It is likely that so many traders are conditioned to sell on breaches of perceived absolute support, such as right at a moving average line, that this naturally carries a stock past a moving average as the momentum of selling, as the stock breaks the line, carries it downward temporarily. This creates price/volume action around the moving average that should be monitored to ensure that the move below the moving average line does not shake one out of one's position. Today, my view of moving average lines and support levels encompasses the idea that they actually represent the medians or midpoints of zones around which stocks find support or resistance. In addition, once a stock breaks a key moving average, such as the 20-day moving average for the first time, it must also confirm the violation of the moving average by moving below the intraday low of that first day where it breaches the 20-day line. This can be applied to any moving average by defining this as a clear violation if and only if the stock moves below the intraday low of the first day under the moving average, so that one day's action is not enough to confirm such a violation. The last quarter of 2007 also proved the principle that you must watch your stocks first and the market indexes second, as the Nasdaq chart in Figure 4.12 shows. While the Nasdaq topped out in early November, those very solar stocks whose action I had insisted to my partner that I should be watching instead of getting caught up in the minutiae of the indexes, well, they just continued on higher. In the end, traders must insist that they trade alone, free from distractions and interference from the outside world, whether such distractions come from business partners, the media, or any other source of external input that can throw you off your path. Remember this rule: trade your plan and plan your trade, and do it all with a minimum of outside influence or input, preferably remaining in the Livermorian ideal of trader's isolation. Too short for too long, Gil Morales. My biggest losses have always come on the short side of the market. Since I consider the size of a mistake to be directly correlated to the size of the loss resulting from the mistake, these are then, by definition, big mistakes. In 2002, I took some serious heat by staying too short too long off the bottom in October of that year. By the second year of the most brutal bear market in 70 years, everyone and everything was negative, and there were plenty of compelling and logical reasons why things were likely to get worse. I remember giving a presentation to a group of institutional investors in a very nice high-rise office building in downtown Los Angeles. During the presentation, we let one eager institutional technician come up and give his view on why the Dow and the S&P 500 had to come down further because they had not yet caught up to the Nasdaq on the downside. There were nods all around the room, and I was one of those nodding heads. After all, the year before, 2001, I had been up over 170%, mostly on the short side, and I was still intoxicated by the taste of blood playing the short side of the market. By the time the bottom in 2002 came around, everyone had become so conditioned to the bear market that nobody could see their way through to the possibility that the market had bottomed. By this time, all of us at William O'Neill Plus Company, Inc., were so tired of looking for a bottom that we were starting to feel as if we would never see a bottom, and if we did, none of our indicators would help us find it. After a discussion with Bill O'Neill on September 9, 2002, I wrote in my trading diary, "On a supercycle basis, it may be that the market has come into a once every 20 years, once in every 5 cycles phenomenon. That's why all the indicators and methods don't work in finding the bottom. This last bull cycle has an extraordinary number of excesses, like a two-headed monster." As late as September 23, 2002, the market was still suffering from the overhang of gloom and doom, and the following entry from my trading diary gives some idea of how Bill O'Neill perceived the muck of a long, 2.5-year bear market. Bill feels the administration's emphasis is all on Iraq, where it should be, but he thinks there should be some emphasis as well on the economy. The failed Japanese bond offering is very bad, but also due to the fact that the Japanese have failed to let bad debt fail and allow their system to clean itself out via the creative destruction process that is the hallmark of our system. Weakness in Japan and in Europe is significant, will have an effect on our markets. By the end of September, the market was breaking to fresh lows, and at this point, I was very short the market going into October 2002. I could feel my saliva glands working overtime as the expectation of tasting blood on the short side again overcame me. Figure 4.13 shows the Nasdaq Composite Index breaking to new lows in late September into early October. The market was certainly not looking too happy. If you were already as morose about the market as I was, this move to new lows was a sign to get aggressive on the short side. Even Bill O'Neill was looking for more downside, as he called me around October 4th to tell me he was looking at shorting a big cap tech leader from the 2000 bull market. That's how bad it was looking. Bill told me he believed this particular big cap tech company has a big problem in that they have bought too many companies. In business, you don't want to put yourself in the position of having to manage too much. If you buy 50 companies, you then have 50 managements to straighten out. It's just too daunting. We didn't know it at that time, but we were in for a big surprise. On October 10th, the market bottomed and began to move sharply to the upside, with the Nasdaq Composite Index posting a 4.42% move off what would be its final lows in the 2000-2002 bear market. 3 days later, the Nasdaq put in a fourth-day follow-through, gapping up and rallying a total of 5.06% on the day with volume up big. If you were short those first 4 days off the bottom, you felt some serious blast heat as the market launched off the lows. Being heavily short, I was one of those lucky investors standing in the way of this freight train. The follow-through day smacked me good, but the next day the market gapped down, although on lower volume, enticing me to stay short. But the second day after the follow-through gapped back to the upside, and the market began to grind higher over the next 12 days before gapping up again. After that initial gap up, the market pulled in hard over the next several days, with the Nasdaq pulling down from the high of 1420 that was hit the day after the election to a low 5 days later at 1319.06. All of the erratic movements in the indexes kept me trying to short the market, as I could not find any traction on the long side. I still could not see how the market could continue to rally. Then, on November 20th, Bill O'Neill called me on my cell phone while I was teeing off at the 11th hole at the country club. Golf outings are far and few between for me, and Bill had never called me on the golf course before, so I knew something was up. He sounded pretty excited, as he discussed the Bush administration's announcement earlier in the day that it would be implementing broad economic stimulus measures, including tax cuts, in their pending economic stimulus plan. At that point, Bill told me he thought the firm's institutional advisory group, which I was managing at the time, and which was responsible for advising over 500 institutional investor clients of William J. O'Neill Plus Company, Inc., should be aggressive on the idea that the market environment is getting more constructive, and that October was likely a permanent bottom. One of the names Bill had identified as a potential, re-emerging type of leader from the prior dot-com bubble market in 1999 was eBay. As well, he felt that some new, underplayed names have a good shot at working. I made a note, Bill likes eBay, and left it at that. Slowly, however, it dawned on me that, unlike Bill, I was not sensing the flow of the market at that stage. In early October, Bill O'Neill was thinking about shorting stocks, and I was shorting stocks as well. By November, Bill was probably buying eBay, and I was still shorting the market. I had missed the boat by a long shot. Sure, Bill O'Neill could consider shorting stocks near a market bottom, but the difference is that, unlike me, he recognized that this was incorrect and simply and decisively turned with the market when it counted. Buying eBay in mid-November 2002 was typical of his ability to smell the big stock when the market began to turn. Watching him do this was a big lesson for me in the wake of my stupidity and stubborn persistence in shorting a market that was bottoming and starting a new bull market. I was so blinded by my negativity that I could not see anything positive at the very moment when the market was turning positive. To confuse matters even more, by December, the market was beginning to roll over again as the market's recovery remained uneven, at best. Even Bill O'Neill was feeling a little frustrated, despite owning eBay, which was still acting well as it continued to track sideways. As my trading diary entry of December 5, 2002, indicates, Bill says it is difficult to stick with the system. The Dow could pull back to 80,200, 8,400, and the Nasdaq to 1250, 1350. The market won't come out of this very well unless the government does something dramatic. The next day, a quick call from Bill yielded the following short trading diary entry on December 6, 2002. The market is just reacting to news, has no rudder, but the real problem remains the post-bubble economy. At this time, gold was beginning a new move to the upside, and Bill O'Neill observed on December 13, 2002. The move in gold is concerning. It's telling you something. To me, the market's action in December 2002 got me negative enough to start looking at the short side of the market again. The move in gold was offering another cautionary clue, as I saw it, and on December 20, 2002, I logged in my trading diary the following comment from Bill O'Neill. Gold responds to fear, but there is some fundamental basis to the recent move in gold. We must get through the next couple of months before we can see where the market is going. The key point here is that despite the fact that the market's recovery off the October low was uneven and choppy, this was not necessarily indicating that the market was about to go into a bear phase and a new leg to the downside. I learned here that markets are not always black or white. Sometimes they can be gray and uncertain, and the smartest position to take is no position at all. Just let the market work itself out. Bill O'Neill understood that, while the market was still having a tough go of it, it was more a matter of waiting for the window of opportunity to open wide than taking one side or the other, bull or bear, with respect to the market. On January 8th, the Bush administration announced a stimulus plan that included accelerated reduction of income tax rates for individuals and the elimination of taxes on dividends for individual investors. On January 23rd, Bill O'Neill conveyed what is an essential stock market truth, and the final lesson of my late 2002 punishment in the markets, which I logged in my trading diary as, regardless of how bad things get in the market, don't underestimate the power of the government to do something. Accommodating Fed monetary policy combined with a newly elected Bush administration's ability to push through an agenda of tax cuts to stimulate the economy, given the Republican majorities in Congress at the time, meant that the government was going to have its way. By the time the regime of Saddam Hussein collapsed in March 2003, the new bull market was in full swing. The main theme underlying all of my mistakes that resulted from persistently trying to short a market bottom was that I failed to understand that after a long, brutal bear market, the major market indexes can put in a final, permanent low, but that doesn't mean they have to immediately shift into bull mode. The market is not always black or white, bullish or bearish, and because it was difficult to make upside progress after the October follow-through, that is, was not strongly bullish, I came to the conclusion that the market must then be bearish. Jesse Livermore himself said that he preferred to avoid using terms like bull or bear to describe a market, since he believed that prevented him from being objective about what the market was telling him in real time. My need to label the market a bear or a bull led me to do so deductively, so that if it wasn't definitively bullish, then I deduced that it must be bearish. In reality, the market was still in a phase where it was, despite the strong follow-through on October 15 that marked the final low of the great 2000-2002 bear market, not in a bull or bear phase, but more accurately in a recovery phase. This was a valuable lesson at the time, and helped me avoid getting raked to death on the short side for many years. Then the bear market of 2008-2009 came. The bear market of 2008-2009 was without question the most unnerving I have ever experienced. Other bear markets were simple affairs for me. I was either in cash or I was selling short. In March of 2008, the end of the first leg down in the 2008-2009 bear market set in with the panic that occurred when Bear Stearns, for all practical purposes, went out of business over the weekend of March 15-16. It likely would have just been another panic low experience for me, but this time something was quite different, because I was now personally involved in the financial crisis. Bear Stearns was the prime broker for both of the private funds I was running at the time, and the funds were domiciled with Bear Stearns. I was staring at the possibility of having my funds lost in a potential Bear Stearns insolvency. Although our Bear Stearns representatives assured us our funds were safe, I didn't assume that I could trust them, as they were only telling us what somebody else higher up was telling them to tell us. The uncertainty of the entire situation over that weekend was quite unsettling. Needless to say, that was not a pleasant weekend for me. Sure, I can handle losing money in the market, but watching money evaporate into thin air because your prime broker went belly up was just too much for me to take. When you find yourself in the grip of an exogenous event that is beyond your control, it is a very uncomfortable feeling. As a trader, I like to think that at least I am in control of my own destiny. In this case, I was in a situation not of my making and quite out of the realm of my control. It was, quite frankly, a frightening experience that left me somewhat shell-shocked and with a strange sense of insecurity and foreboding. The crisis of March 2008 was averted when J.P. Morgan stepped in and bought out Bear Stearns at $10 a share. J.P. Morgan also took over as prime broker of the private funds I was managing at the time, which was ironic since the House of Morgan was considered the safest place to be at the time. And here we were, prime brokered with Bear Stearns, which was going to be saved via a J.P. Morgan acquisition. While we were out of the woods with respect to the possibility of seeing our funds evaporate in a Bear Stearns insolvency, the entire affair left me with a sense of distrust and mistrust, something similar to what people might experience the first time they are in an earthquake. That solid ground you thought you were standing on is now perceived as not being as solid as it used to seem, and so your sense of security is diminished. I suffered from a sort of financial stress disorder syndrome for several months after that. As I regained my composure, I played the short bear market rally that lasted roughly from March to the beginning of June 2008 successfully. By the end of summer, another leg down in the bear market was brewing, and by September the market began to split wide open. I was again playing the market on the short side, but not as aggressively as I should have. While I did make money on the short side in 2008, finishing up a few percent for the year after posting a deficit in the first 3 quarters of the year, I felt that I could have been up much more, perhaps 50% or more, based on my post-analysis. I was far too timid and missed what was essentially the sweet spot of a severe leg down within an overall bear market that was shaping up to be quite brutal. Again, however, I was letting the opinions of a business partner unduly influence me, as he insisted with professorial superciliousness and authority that nobody can make money on the short side. I came to realize that making about 10–15% on the short side in the last quarter of 2008 represented a very poor showing given the extent and velocity of the downdraft in September–October 2008. I had essentially allowed myself to be influenced by outside forces that led me to become overly cautious and timid in my approach to the short side. Because I had difficulty making money on the short side earlier in the year, I allowed others to influence me into believing that my short techniques were deficient, and that shorting is simply too difficult to execute. What I have learned since then is that the methods detailed in the book I co-wrote with William J. O'Neill, How to Make Money Selling Stocks Short, are perfectly sound. But the key is to wait for the exact moment when the line of least resistance has been broken and the optimal window for short selling is opening. As you can see in figure 4.15, the sweet spot for short sellers was essentially a sharply accelerating 3-week downside break. If you sat there with your finger in your ear, you missed the sweet spot. If you caught the sweet spot, that's all you needed, and you could have taken the rest of October through December 2008 off. My colleague Chris Casher has confirmed that the patterns and methods outlined in How to Make Money Selling Stocks Short are deadly accurate when the proper window of opportunity opens, as we will see in Chapter 8, and that this is the key to fully and optimally exploiting a downside break in the market during a bona fide bear market leg down. You must wait for your opportunity. As Livermore said, there have been many times when I, like many other speculators, have not had the patience to await the sure thing. When it comes to shorting, avoiding danger is best achieved by having the patience to wait for the sure thing. That window in September–October 2008 was that sure thing, and I played it meekly as I had allowed myself to be talked into the idea that nobody can make money on the short side. Frustrated by not fully exploiting a massive downside break in September-October 2008, despite being up in a year when the markets were down some 50-odd%. Toward the end of 2008, I became fascinated with the situation in the banking sector, which represented ground zero of the bear market. I had already had a visceral experience with the chaos that was engulfing the financial sector with my Bear Stearns experience in March of 2008. And when I began to research the situation, it was evident to me that the situation was quite dire. I concluded that the bear market of 2008 would not end until we had seen at least 2 or 3 major money center banks go under, such as Citigroup C, Wells Fargo WFC, or Bank of America, BAC. At that time, I felt that if one could add 2 plus 2, one could comprehend that the big banks were all insolvent, and it was only a matter of time before the final house cleaning would arrive, and that it would be marked by one or more of these money center banks being taken over by the government. At that point, the excesses in the system would begin to be allowed to be wrung out of the system, and the market and the economy could go about the process of recovery and rebuilding again. What I didn't realize was that the excesses were going to be propped up instead, and I severely underestimated the ability of the U.S. government and the Federal Reserve, in concert with central banks and sovereigns across the globe, to orchestrate it so successfully. This was a major mistake, and it was fostered by my belief that by March 2009 the Fed had no traction and that you could fight the Fed. I had surmised that since preemptive rate cuts throughout 2007 and 2008, combined with $1.8 trillion in bailouts by the end of September 2008, did nothing to prevent the market's sharp break in September-October 2008. The excesses of the financial establishment were going to be washed away in a final break to new lows. In addition, an uncharacteristic reliance on examining the financial statements. The fundamentals of the financial stocks reinforced such dire conclusions to the point that I allowed it to override my basic price/volume approach to the markets. This reliance on fundamentals coincided with my reading of doom and gloom investment newsletters, detailing all that was wrong with the world. My research into the financial crisis took me to all kinds of websites with their own version of why the crisis would drag down and destroy the global financial system. While their prognostications of Armageddon may yet turn out to be correct, they have little to do with what is going on in the stock market at any particular moment. Unfortunately, given my shell-shocked memories of the Bear Stearns meltdown in March 2008, I was easily persuaded that the worst was yet to come. 3 major factors in my psychology were coming together to create a perfect storm. 1. Frustration over not fully exploiting the September-October 2008 short-selling window of opportunity. 2. Allowing myself to be influenced by outside sources. And 3. Allowing fundamentals and my sense of dread, as a result of my experience with Bear Stearns in March 2008, to override my normal reliance on price/volume action. By March of 2009, newspaper headlines were regularly featuring the word depression. Given that I have 19 years of experience as a professional investor, this was one time when I could not see the forest for the trees. When everyone is talking depression and all looks lost, historically, this is when markets bottom. But I could not see it, and so I kept fighting the market. Some of the rebounds off their lows in financial stocks, such as American International Group AIG, shown in Figure 4.16, were absolutely insane, or at least I thought so at the time. It flew in the face of the fundamentals. AIG had collapsed to a low of $6.60 a share by March 9, 2009, and 8 trading days later hit $40 a share intraday. As you can see on the chart, on an intraday basis, the stock doubled on one day alone, the 5th day up off the bottom and the 2nd day of a sharp move off the lows that took the stock right up into the 50-day moving average. Notice the long candle wick, indicating that the stock was hitting some serious resistance at the 50-day line. The next day showed a small hanging man type of formation, which is a cautionary sign at the end of a sharp move to the upside, and so I decided AIG could be shorted in size right here. The next day, the stock ran to the upside, nearly 50%. Given what I knew about the financial state of financial stocks, I considered these moves to be preposterous, and I was certain that they would immediately reverse course to the downside, despite the fact that there was absolutely no price/volume evidence to indicate that such an occurrence was imminent. As I saw it, the only thing to do was to short the stock again as it got above the 25 price level. Of course, from there, the stock gapped up another 10-15 points, finally kissing the 40 price level. Shorts in AIG, even persistent shorts that kept shorting and covering as the stock ran up, got hurt badly. These types of moves off the lows were typical for most of the financials, as the daily chart of the Financial Select Sector SPDR ETF, known as the XLF, in Figure 4.17 shows. For short sellers like myself who just wouldn't take no for an answer, the XLF offered a couple of teases when it broke below its 50-day moving average on heavy volume twice during the latter part of March 2009, gapping down the second time, before launching again to the upside. They say that wood ticks wait up in the branches of trees, and when an animal passes below, the scent of the animal triggers a response in the wood tick, whereupon it drops down, presumably onto the subject animal, where it then digs in and proceeds with taking a warm meal from its unsuspecting host. If by chance the animal passes before the tick drops down and gets to it, and the tick instead lands on the ground, perhaps, say on a decent-sized rock, it will attempt to dig into the rock until it kills itself, literally grinding itself into the rock. I now refer to this as tick syndrome in traders when they persist in digging into a rock, essentially continuing with the same strategy or trade that the market continues to punish. Watch out for tick syndrome, which I define as a situation that can occur whenever you find yourself stopped out of the same trade twice or more. What I was doing in March of 2009 was entirely opposite to my normal methods of flowing with the market. I was in fact fighting the market instead, and this alone was a sign that I was on the wrong track. Today, I ask myself a key question from time to time: am I flowing with or fighting with the market? The answer is often useful in getting back on the right track. In my post-analysis, it is clear that the mistakes I made were primarily psychological, and a chain of events and situations served to fuel excessive reliance on what I thought I knew, as well as what I feared, about the instability and potential for further crisis in the global financial system. The events of March 2008 set me off on a psychology of dread and insecurity that had fueled rising concern on my part regarding the trustworthiness of the financial establishment. And this led to my delving into the fundamentals of the situation, to the point where I was certain it would all be over only when some of the big money center banks began to topple. I also began subscribing to and reading a number of gloom and doom newsletters, which also reinforced my negative views on the market. Also, as a result of missing an opportunity in September 2008 to make big money on the short side by playing what was the true short-selling sweet spot too lightly, and given that I knew the financials were going down, I was primed to make big money shorting banks, brokers, insurers, commercial rates, whatever else I was certain was about to collapse as a result of the final solution in the 2008-2009 financial crisis. While all of this doom and gloom made sense from an intellectual level, it doesn't mean the market is going to follow any preset path as a result of its sensibility and logic. Remember this basic principle: the market is going to do what the market is going to do at any point in time, not what you think it should do. Therefore, do not ever allow yourself to get into a state of mind where you begin interpreting the market's action in terms of what you think should occur, but rather learn to remain in the present and allow the market to tell you what it is actually doing. Had I adhered to this principle, I could have avoided most of my troubles. As a trader, there will be many times when you will be thrown by the market. Basically, it fools you by throwing you into a situation that is unfamiliar or cluttered with other exogenous factors. When this happens, you are most susceptible to deviating from your normal rules, and it is precisely such simple, and often minor, deviations that are the cause of most investment mistakes. If you find yourself thrown in this manner, and put into a position where the market is not making any sense to you, then the best course of action is to simply back away and wait for the market to return to a state where you are able to make sense of it. Ask yourself at any time, is the market making me want to operate outside of my normal methods? If so, this may be telling you that it is a good time to back away from the market, a practice Livermore himself admitted he failed at doing many times, which is to insist on always having an interest in the market. Not simply backing off to wait for the sure thing to develop can be costly. One of the big lessons for me after my debacle of March 2009 was that, like Livermore, I did not always have to be in the market to have an interest at all times. But this need to always be doing something in the market is fed by the fact that since 2005, I have been running money in the public realm for private, high-net-worth investors, and this is quite a bit different from managing money in the cocoon of William O'Neill Plus Company, Inc., where I did very well. In the public realm, particularly the hedge fund world, monthly performance is ridiculously overemphasized. At O'Neill, this was never a factor, and for the most part you were left alone to manage your portion of the internal account in isolation, in keeping with the Livermorian ideal of trading in solitude. Bill O'Neill might saunter into your office once or twice a year, but usually this was for the purpose of going over mistakes, particularly if you were in a trading slump, in the interests of helping you get out of the ditch. In the public realm, some investors are constantly calling, asking how are we doing, over and over again, like Bart and Lisa Simpson in the back of Homer's car incessantly parroting, "Are we there yet? Are we there yet?" With people trying to look over your shoulder constantly, and wondering how we're doing at every twist and turn in the market, this begins to affect your psychology, which is a very fragile thing, particularly for O'Neill-style investing. Professional portfolio managers who are reading this book will likely understand what I am talking about, especially the way that overly skittish investor clients can affect one's psychology. For me, it kept me trading far too long and during periods when I should have been doing nothing, rather than pushing to do something in order to meet the unrealistic expectations of investor clients who overly emphasize short-term monthly performance. Today, I have adopted Ed Seikota's policy of allowing his investors one phone call a year, any more than that, and he sends their money back. There is nothing more distracting or damaging to one's fragile psychology than nervous and emotional investor clients. Ed Seikota understands this better than anybody. So rather than entertaining their emotion with soothing comments, he simply amputates the distraction entirely by eliminating the client. I call this the Seikota standard, and I now adhere to it. Another thematic lesson that I learned in September-October 2008 and March 2009 was that I was wrong to lose faith in my short-selling investment methodologies in the spring-summer of 2008. Instead, I did not recognize an important principle of short selling, which is that my short selling methods work quite well when implemented at the proper stage of a market decline, but lose their effectiveness at certain stages of a bear market. Tick syndrome kept me trying to make money in March 2009 on the short side that I felt I should have made in September-October 2008. Unfortunately, I foolishly failed to recognize that March 2009 was not September-October 2008 because the market was in a much different stage of the bear market decline, and that it was in fact reaching a full court press panic low in March 2009. There are many academics who will give you hundreds of reasons why you cannot do something, or why something cannot work. If you surround yourself with such individuals, you will never even attempt to accomplish anything for fear of failing. In my view, it is best to limit outside influences when it comes to one's investment thinking, whether that is related to a current market view or perceived opportunity in a particular stock, or whether it is related to your methodology. If you choose to converse or consort with other investors, then do so with like-minded investors who will reinforce your investment epistemology. But for the most part, strive to trade independently at all times. Jesse Livermore preferred to ensconce himself in the solitude of his special trading office with no opportunity for disturbance. At William O'Neill Plus Company, we used to joke that we should all trade from a room where we would remain cocooned from all outside influences, and only our chart books would be allowed to be passed under the door, along with 3 squares meals a day. Whenever I had a major cable financial channel on the TV that was mounted on the wall of my office at William O'Neill Plus Co., Inc., and Bill O'Neill walked in, the first thing he would say is, "Turn that thing off." Richard Wyckoff wrote, "When you understand stock market science, you have no concern about important developments in your morning newspaper." I believe this is the ethic all traders and investors should strive for, and in my view, it cannot be emphasized enough. Avoid the sensationalism of the news, of cable financial TV, of the pundits and commentators, because the market will always tell you all you need to know. Many investors concern themselves with positioning ahead of major news announcements such as the monthly employment report of the Bureau of Labor Statistics. In my view, there is no need to position one's portfolio for a news event, as all the market evidence up to that point should already have you positioned on the basis of what the market is actually doing, not what you think it might do based on any number of news event scenarios that have not occurred yet. On its face, this is a silly way to invest, but it is exactly what I was doing in March 2009, and as we have seen, it was caused by a confluence of malodorous factors. As traders, we must always remain objective and focused on what the market is telling us in real time, and the best way to do this is to check yourself by constantly stepping outside of your head and questioning the motives of any trade. Justify the trade in your head according to the rules of your methodology and system, not according to scenarios you think might happen or how you are currently feeling, whether that is characterized by fear or elation. Make every trade measure up to the criteria that your investment methodology dictates, and if it does not, nix the trade. By focusing on the criteria of the trade and the market's action, you will also trade with less stress, which is caused by trading in a manner that tries to anticipate rather than flow with the market and individual stocks. For the record, I should mention that my March debacle in 2009 occurred in only one of the 2 funds I was managing at the time, and the second, less aggressive fund was left unscathed by the mistakes I made, which were for the most part isolated in the first, far more aggressively managed fund. Both funds were up in 2008, a year when the market was down big, so it was not as if there was any hint of what was to come by year-end 2008 or a pattern of continuous bumbling. During my career, I have had several periods where I have drawn down close to 50% in aggressively managed portfolios, but such drawdowns have, based on my long-term track record, always been made up over time, sometimes quickly, sometimes not so quickly. When base breakouts fail during a bull market, birth of the pocket pivot, Chris Casher. The first decade of the new millennium, 2000-2009, has created a whole host of new challenges for traders and investors. While the major market averages in the United States enjoyed steep uptrends and downtrends throughout the 1980s and 1990s, they changed their character after 2003. From January 2004 to mid-2006, the U.S. market tended to move in a lackluster, sideways to slightly upwardly grinding sloppy market where most textbook, technical breakouts in individual stocks failed. Figure 4.18 shows the grinding nature of this reluctant bull. In such an environment, it was often difficult to gain an edge, so in mid-2005, I explored other possible trading avenues. My research led me to some useful conclusions, and the pocket pivot point concept was born, which we discuss in greater detail in Chapter 5. That said, even after 14 years of trading success based upon capitalizing on upside moves in the market while sidestepping every significant market downturn since 1992, including the mother of all Nasdaq bear markets from 2000 to 2002, see Figure 4.19, I began to think on some subconscious level that the markets will always trend, either up or down. I did not stop to think that the major U.S. market indices could behave in a prolonged, sloppy, reluctant sideways move that would persist for years. So this grinding market action caught me by surprise. That said, certain developing, emerging markets like China and India, as well as commodities in general, were leading, and their bull market was much stronger than the general U.S. market averages. However, outside these specific groups, the environment was considerably challenging. I came to understand that the tone of the markets had changed into something I had not experienced in the 14 years I had traded. It is essential during such challenging periods that traders keep a clear head and not let their emotions control their actions, so they will find the best solution. My pocket pivot buy point discovery in mid-2005 helped to turn my 2005 performance around so that I was able to turn it into a winning year. Armed with the pocket pivot, in 2006, I was able to achieve triple-digit returns in excess of 100%. However, 2007 brought new challenges. Price/volume action in the major market indices misled me through much of 2007, an extremely rare situation. This resulted in a negative return for my market timing model that year, the only other year in 35 years that it had a negative return. During 2007, my timing model produced numerous false signals, as can be seen in Figure 4.20. As it turned out, the fact that the model was generating so many false signals was a big clue that 2007 was indeed a highly unusual year. While 2007 was the only other year besides 1993 where I logged a negative return for my timing model in its 35-year run, the unusual behavior of the model was helpful in shining a light down these dark and treacherous trading corridors. Numerous distribution days naturally led to sell signals issued by my timing model. However, these sell signals led not to a falling market, but to a market that stubbornly continued to grind higher, and was the first time this had persisted for as long as it did looking back over many decades of price/volume market action. But by capitalizing on the window of opportunity that presented itself in late 2007, and by making full use of pocket pivot points, I was able to reverse my drawdowns that had occurred in my own trading account up until August 2007 and finish the year up plus 30.6% despite my timing model being down for the year. Overtrading. Chris Casher. Since I always let the stocks have the final say on exactly what degree of market exposure I will take in any environment, I ended up with solid returns for 2007 by buying the fundamentally strongest stocks at proper pivot points and staying heavily invested through September and October of 2007, as the brief window of opportunity was clearly open during those months. Had I invested only during such periods, when the window was clearly open as measured by a buy signal from my timing model together, with a confluence of strong, fundamentally sound stocks hitting proper buy points more so than at any other time that year, I would have limited my market exposure and kept more of my profits. One might ask how to tell when the window is truly open versus only being partially open. The general answer is experience. Traders develop a feel for the market by running their screens each day. Over a period of many months, one will develop sensitivity as to when enough good stocks are starting to hit their pivot points, whether a pocket pivot or a breakout pivot. For example, in August 2006, the general averages turned a corner and began heading back up. By late August 2006, many stocks with strong fundamentals began to hit my buy screens. Constructive pocket pivot points started showing up all over the place for the first time since October 2005. I began buying the best ones and found myself on full margin within just a few days. The other times when this occurred, launching the beginning of a bull run, were as follows with the length of window of opportunity in parenthesis: April 2003, 6 months, October 2004, 3 months, October 2005, 2 months, August 2006, 3 months, September 2007, 2 months, and March 2008, 1 month as shown in Figure 4.21. From 2005 onward, I found myself well into margin rather quickly during each of these windows of opportunity, and thus was able to more fully capitalize on the bull run, which typically lasted 3 months or less, a short period compared to the 1980s or 1990s, and is one big reason why this decade has been far more challenging. I believe overtrading is one of the toughest challenges for any trader, whether a novice or a deeply experienced professional. It is often far too tempting to let one's prior successes in the market cloud one's judgment. Being trigger-happy in the markets when they are only acting half right can create losses, especially in the difficult decade of the 2000s. Problems, situations, and solutions. We have been trading for the past 2 decades. While any trader knows not to make rookie mistakes such as averaging down, the adventurous ride we have had in the markets has given us a deep perspective on what are often overlooked and unexpected reasons why traders get off track. This ride has not come without tuition costs, which we might better understand as the price of learning. Such tuition costs have continued to be exacted by the markets since some of our mistakes have occurred even after many years of success in the markets, and should be considered postgraduate tuition costs. What follows is a smorgasbord of our mistakes or mistakes we have observed other experienced traders make. We mention the problem, provide a situational example, and then discuss the solution. Your trading strategy stops working. Problem: your strategy stops working for more than a few months, which tests your patience. You start to question your strategy and may make changes to it that are detrimental in the long run, or abandon it altogether. Situation: in 2004 and 2005, base breakouts were not working. The strategy that had always worked in the past, that is, buying the best stocks on base breakouts during bull markets then going to cash during market corrections, was not working as it once had. My business partner, who had many years of experience and was an exceptional trader in his own right, believed base breakouts would no longer work from here on out because the market had fundamentally changed. Solution: I only briefly believed this because the base breakout strategy is based on human nature, and until human nature changes, markets will generally behave in similar ways. Mark Twain once said, "History never repeats, but it often rhymes." So, knowing that, I was not about to abandon my strategy but instead started looking for a way to deal with the markets, which were behaving differently than they had in the 1990s. Consequently, the pocket pivot was born. That said, the base breakout strategy is still perfectly valid but tends to be much more effective during uptrending markets that are in a clear uptrend as opposed to the much more noisy sideways markets that typified the market's action in 2004-2007. During this period, however, pocket pivot buy points helped build a position in a stock earlier, which in turn gave me more of a cushion in the event the market should have a brief yet normal pullback. Pocket pivots will be discussed in far greater detail in Chapter 6. Personal setbacks can derail your trading. Problem: you suffer a personal setback unrelated to the markets, but continue to trade the markets despite your focus being temporarily derailed by the setback. Situation: a loved one passes away, or you get some sort of other dire news. Solution: whether it be the death of or breakup with a significant other or other close family member or friend, or one of life's inevitable pitfalls, pratfalls, or personal tragedies. One should take a big step back from trading, should such events occur, in order to deal with them in a manner that allows one to maintain an even psychology as a trader. In 2 of the biographies that have been written about Jesse Livermore, Jesse Livermore Speculator King by Paul Sarnoff, and The Amazing Life of Jesse Livermore by Richard Smitten, mention is made of a period when Jesse Livermore had to contend with a death threat against his son, Jesse Jr., as well as the particularly nasty aftershocks of a bad marriage, yet he continued to trade. He ended up giving back the $100 million, or so he made, going short the market during the early 1930s, equivalent to billions in today's dollars, and became destitute by the late 1930s. Had he maintained his perspective to just not trade while his personal life was in turmoil, he would have kept most of his wealth instead of blowing out his account yet again, as shown in Figure 4.22. New trading strategies can derail your trading. Problem: new strategies sound tempting to try because some well-known investor has used the strategy with success. You decide to include this newfound knowledge in your own trading strategy. But you run the risk of it either taking your focus away from your own strategy that has brought you much success, or the new modification is not in harmony with your trading personality. A successful trader knows his strategy must always correspond to his trading personality. For example, the risk/reward characteristics of your strategy must always stay in line with what your trading personality can accept. Otherwise, you are more than likely to abandon your position prematurely when it moves against you. Or worse, you may get caught holding a particularly volatile position too long if it suddenly slips well beyond your mental stop alerts, thus psychologically trapping you, as you now are put in the position of hoping the position moves higher so you can recover part of your loss before selling it. A dangerous psychological trap. Those who are particularly vulnerable to this problem may be going through a weak spell due to a specific market period that does not work well with their strategy, such as the way choppy, trendless periods can cross up trend followers. Situation: this is potentially dangerous because the new strategy may only work for a brief period or may not suit your trading personality. Solution: if you add in a new strategy to your existing strategy, you should make sure you place it in proper context. Ask yourself the following questions. Will this strategy only work briefly because the change in the markets is just temporary? Will this strategy blend well with my existing strategy such that it will still suit my trading personality, psychology, risk/reward profile, and so forth? If I incorporate it into my strategy, and my strategy eventually stops working some months later, is the problem due to the addition of this new strategy? Or is the problem that the market has changed in some fundamental manner, yet again? There have been times when changes in the market were only temporary, but lasted just long enough for many investors to adjust their strategy. The best investors were able to accommodate this change into their own strategies, and then remove this modification when the markets returned to normal. Investors who ran into trouble did not notice that the markets had returned to normal, and thus when their strategy started to underperform as a result of some change they had made to their strategy, they suffered much frustration. Some eventually abandoned their strategy altogether, thinking the markets had changed for good. For example, there have been several periods throughout the past 30 years when it has been declared that trend following was dead. Yet the best traders with exemplary 25-plus-year track records such as Bill Dunn and John Henry, as interviewed in Trend Following by Michael Koval, prove that a consistent trend following approach works brilliantly. These traders are the rare few who continue to trade their strategy even during difficult times when the market is trendless, rather than abandoning their strategy and succumbing to the "this time is different" view. The belief that this time is different has cost traders much money. Using our trend following example, the many siren calls over the past few decades that trend following is dead has derailed many a trend following, and thus can be quite damaging as the markets have always returned to their trending nature. While 2004, 2007 were rather lackluster and absent of strong trends, good money could still be made by being invested when the few trending windows of opportunity opened during those challenging years. My timing model, which has averaged just over plus 33%/year since 1974, averaged less than half of that return during 2004-2007 due to the lack of strong trends. That said, money was still made over this period by simply going long or short the QQQQ, an exchange-traded fund that serves as a proxy for the Nasdaq 100 index. Additional gains could have been made by focusing on the fundamentally and technically strongest stocks when the market was trending, coupled with when the windows of opportunity were clearly open, as discussed in the prior section on overtrading. At any rate, the best trend followers such as Dunn and Henry may lose more than half of their accounts during the most difficult trendless periods as their account audits show drawdowns beyond 50%. Yet they always more than make up for these losses when the market begins to trend again, and thus have always been able to well outperform the general markets in any given market cycle. That said, it is easy to see why most traders would abandon their trend following strategy. It takes great patience and confidence in one's trading strategy to withstand 50% drawdowns in their account without abandoning or changing their strategy. Of course, there are times when certain aspects of the market legitimately change. It is up to the investor to take note of this and make changes accordingly to ensure optimal returns. It is good practice to watch the market on at least a weekly basis for such changes. For example, in the late 1990s, the metric of emphasizing a stock's earnings and ignoring stocks that had no earnings changed with the onset of the Internet revolution. Some successful Internet stocks had no earnings yet had soaring sales. Such stocks often rose hugely over part or all of the bull market in the late 1990s, including well-known stocks such as Amazon.com ticker, Amazon, and eBay ticker, eBay. Investors who took advantage of this newfound change profited handsomely. I remember telling Bill O'Neill of my finding. He took serious note. He eventually adjusted his rules to accommodate stocks that had no earnings, but this adjustment did not come immediately. He had been conditioned since the early 1960s to only invest in stocks with strong earnings, as such stocks were the cornerstone of his massive success in the markets. This is where experience can work against even the best investors. To O'Neill's great credit, he eventually adjusted his strategy by allowing his in-house portfolio managers to capitalize on such stocks with no earnings, even though he himself continued to invest only in stocks with earnings. Market noise can derail your trading. Problem: you get caught up in the noise. There is now more financial information available to the average investor than ever before. The thousands of financial websites on the internet, financial television channels such as CNBC, and of course, other forms of news media all serve as potential squawk boxes that can take you away from your focus. Those who are considered experts with big reputations who voice their views can scare one out of their positions. Big headline news events can also be destabilizing. Situation 1. I remember on January 13, 1999, it was reported that Brazil had devalued its currency overnight. This sparked speculation that South America was going to have a currency crisis that could be compared to the magnitude of the Asian currency crisis of 1997. Which knocked U.S. and world markets down considerably. On January 13, 1999, the Nasdaq Composite opened down minus 115 points, or minus 5.0%, as shown in Figure 4.23. I was fully invested at 200%, using every available dollar I had to ride the uptrend that began in October 1998. I was a bit shell-shocked to see how much damage my portfolio was about to take shortly before the market opened that morning. My positions consisted of high-alpha stocks that thus tended to move 2 to 3 times the general market averages, so my portfolio was in for a bit of a downdraft at the open. As tempting as it was to sell my positions right when the market opened, I decided to wait and see if the major averages were going to head lower on big volume after gapping down at the open. This would confirm the gravity of the news. If Brazil's currency devaluation was going to result in a crisis for South America, the market would move lower on big volume after gapping down considerably. I decided I would then sell all positions that also fell below their opening lows. Gil Morales and I frequently put our heads together before the opening every day when we worked together at William O'Neill Plus Company, Inc., so I called him to discuss the situation. He quickly replied, "I think we buy." He was not as heavily invested as I was, so from his perspective it was a potential opportunity to increase his long exposure. Fortunately, the market opened at its low of the day and proceeded to rally. I got scared out of 2 of my positions, as I was looking for any excuse to reduce my sizable market exposure, whereby I was on full 200% margin, but held on to everything else. I ended up staying about 160% invested. Instead of being down over minus 20% in one day, my portfolio finished the day down only a couple of percent. It would have finished the day about flat had I not sold anything. Furthermore, I would have finished the day up had I bought stocks such as CRE Inc. CRE at the open that had gapped down well beyond reason. While I normally would never buy any stock that gapped down, This was a special circumstance of panic getting ahead of reason. I could have bought CRE at its open of 35.4 and sold it had it moved lower, otherwise hold it the rest of the day. It finished the day at 47.56, or up plus 34.4% on the day as shown in figure 4.24. Not bad for a day's work, even in the go-go, dynamic 1990s. Solution: it is always better to follow the money, not the news. News can scare one out of a winning position, see figure 4.25. Following the money means paying attention to price/volume action in the stock, which can reveal whether the big, institutional money is flowing into or out of the stock. While you may buy for technical reasons as well as fundamental reasons such as company news, earnings, sales, and return on equity, you should sell solely on the basis of technical reasons and avoid the pitfalls of paying attention to the news. As you can see, it is easy to get knocked off the clean and pure path of effective focus. Deficient research techniques bring wrong conclusions. Problem: the research techniques traders use to refine their strategy are deficient, leading them to the wrong conclusions about how they can improve their existing strategy. They end up modifying their strategy, but when that modification doesn't improve their performance or worse, hampers their performance, they modify it again as they search for the answer to improved performance, but further modification only makes things worse. Situation 1. It is a common mistake to assume that just because something holds true over a long period of time, such as 25 years, that it holds true indefinitely. Using a simple example, it was remarked during Thanksgiving of 2009 that the Friday following Thanksgiving is often an up day for the market on light volume, with down days usually being down just slightly, typically between 0 and 0.5%. While this does indeed hold true going back 25 years and even 50 years, it was not true in a different era, a period known as the Great Depression. In the 1930s, the Dow Jones Industrial Average was down 5 out of 10 times on the Friday following Thanksgiving, minus 1.24% in 1939. Minus 0.73% in 1935, minus 1.16% in 1932, down a big minus 2.76% in 1931, and minus 1.2% in 1930. That said, on the Friday after Thanksgiving in 2009, with 2009 being a truly highly unusual year in the aftermath of the global meltdown of 2008, the Dow lost minus 1.5%. Solution 1. It is important to take the whole picture into context when sizing up a research discovery. A year such as 2009 was often called a black swan since it was a time of highly unusual circumstances. The global market meltdown that occurred in 2008 prompted the U.S. Federal Reserve Bank in 2009 to quantitatively ease and print money that would fuel the market higher. This highly irregular situation rendered impotent market indicators that had worked well in the past. Each time it seemed that the market should sharply correct, the market would just dust itself off after a week or two of weakness, then head to higher ground as shown in figure 4.26. All discoveries one makes when conducting stock market research must account for possible black swan environments. That said, research is the cornerstone of creating an effective trading strategy. Traders must not rely just on what they read, even if they are convinced the idea is sound, but must also thoroughly test out the idea to prove it has worked in the past and will continue to work into the future. This way, one is not just intellectually, but also emotionally secure in knowing the idea is sound. One is then less likely to abandon the idea during brief periods when it stops working by emotionally reacting to its temporary failure. While the Friday following Thanksgiving usually results in a positive day for the general markets, the 1930s were an unusual time just as 2009 was also an unusual year. Putting a research finding into the context of the big picture is essential. Situation 2. With regard to creating timing models that attempt to time going long, short, or neutral the stock market by way of investing in ETFs that mirror the general market averages such as the S&P 500 or NASDAQ composite. It is essential that the pieces that define your timing model are properly defined. For example, even if your model is purely systematic in that a clearly defined set of rules apply to your model, you may find that your model is still not a black box and that it still would not be computer programmable. This is perhaps best explained by way of analogy. In the years I worked with William O'Neill, his uncanny ability to interpret the innate quality of a base is nearly unmatched. I equate this to his decades of experience analyzing charts. For example, the difference between a great base, a good base, a marginal base, and all the degrees in between is contextual, and programming a computer to see the subtle differences would be quite the challenge if not impossible. O'Neill's ability to size up quality is based on his decades of experience in analyzing millions of charts since 1960. Thus, erroneous conclusions have been made with respect to the M in William O'Neill's ConSlim regarding follow-through days, which signal it is time to buy, and distribution day clusters, which signal it is time to sell. For example, some have observed that follow-through days have a low success rate, statistically, and thus are not useful. While follow-through days do indeed have a low success rate, there are ways in which the success rate can be greatly improved by adjusting various parameters such as the threshold level at which the major averages must be up for the day to qualify as a follow-through day. This threshold level should be adjusted based on the average true range over the last X number of trading days, depending on how sensitive one wishes the timing model to behave. Average true range is a measure of volatility. A highly sensitive model would react quickly to changes in the general market's average true range. The upside is that it would be quicker to catch such changes. The downside is that it may catch more false signals. A model that has low sensitivity to changes in average true range would react slowly to changes in the average true range. The upside is that it would catch fewer false signals. The downside is that it would be slower to catch changes in average true range, thus negatively impacting profitability. In addition to adjusting the threshold level, clear rules must be made in terms of when the count must be reset. For example, in Figure 4.27, would your rules include October 6, 2009, as a follow-through day? The Nasdaq Composite had only corrected minus 5.9% from its peak set on September 23. If you defined your rules as having to reset the count whenever the Nasdaq Composite corrects more than minus 5%, then October 6 would not be a follow-through day, assuming you use the rule that follow-through days must occur on the fourth day or later. Of course, you could also create a time limit that says the follow-through day must occur no later than X number of days after the market begins to rally. Besides what has been discussed, there are other variables that can be accounted for in fine-tuning the predictive value of follow-through days. Solution 2. It is important to clearly define your parameters when attempting to time the market using a model. Fuzzy definitions will only lead to confusion and misunderstandings. It is also important to consider other variables that can be used to increase the predictive value of the signal. Situation 2 continued. In terms of distribution days, one could end up making limiting conclusions about distribution day sell signals. In one case that was published on the internet, a set of seemingly logical conditions were assigned to distribution days, but upon deeper examination, the conditions were too restrictive. This led to limiting conclusions about distribution days. I use in this example the parameters found at quantifiableagesblogspot.com/2009/08/distribution days quantified HTML. The following hypothetical conditions were: the S&P closes above the 200-day moving average since we are looking for a top. Sometime within the last 12 days, the S&P closed within 1% of its 200-day high, which would confirm we are near a top. Over the last 12 days, there have been at least 4 distribution days. Now, let's say we short the S&P on the close of the 4th distribution day, using the 3 conditions above where the 4th distribution day occurs within the last 12 days, if it is above the 200-day moving average, and has come within 1% of its 200-day high in the last 12 days. Then we cover the short position 20, 40, or 60 days later. From this, The conclusion was made that distribution days do not lead to market tops or falling markets, but that one would actually be better off buying instead of shorting the market. However, the study has holes. By restricting the S&P 500 to only 4 distribution days that must close within 1% of its 200-day high in the last 12 days, then covering the short, a fixed amount of time of 20, 40, or 60 days, is too restrictive and guilty of overfitting past data. If one were to adjust the number of distribution days to 5 over a period of X number of days, and exclude the rule that the S&P 500 must close within 1% of its 200-day high in the last 12 days, the results would be greatly improved. The internal logic of price/volume action in the major market indices held true 100 years ago and continues to hold true today, outside of a few highly unusual but brief periods such as May, June, and October 2007. A cluster of high-volume down days generally implies that institutions are selling. This often precedes declines in the general market averages. Even in years where there are a high number of false signals where the market moves higher after a sell signal is issued, a proper model should have a failsafe built in to minimize losses during such challenging market periods, such that it can still well outperform the major averages by capitalizing on the times when its signals are correct. It is analogous to letting your winners run and cutting your losses short, a major rule for trend following success. Solution 2 continued. The internal logic in any strategy must hold true. One should identify valid concepts first, and then construct a model around those concepts. Traders should not blindly curve fit their model to data, as this could lead to overfitting. Overfitting often occurs when one's model is overly complex, thus it may have too many degrees of freedom relative to the amount of data available. Such a model will have poor predictive ability, but will show impressive results in hindsight. Also, don't fall prey to making your model overly complex just to feed your ego. I remember being so proud of an econometric timing model I created while I was in graduate school in the early 1990s. I showed Bill O'Neill my timing model when I first met him in 1996, and he nodded and smiled politely and said some of my findings may only hold up during certain cycles, so always strive for simplicity. Wise words indeed, as my timing model, while profitable since 1991, has greatly evolved and simplified since then. As my experience has grown, I have become better at understanding charts, and thus able to put distribution days and follow-through days into proper context. In this way, I have dropped many of the training wheels I used to use. Analogous to this is how I noticed that O'Neill is the quintessential purist when it comes to reading charts. He relies primarily on the price/volume action of daily and weekly charts, the shape of the pattern, the relative strength line, and the 50-day moving average. His decades of contextual experience reading charts allows him to put away almost all other indicators and rely on his vast experience to identify a proper base. Labels may simplify but can oversimplify problem. One finds it easier to fall back on labels such as cup with handle and square box than to put such chart patterns in context with the general market. When I used to give seminars with Bill O'Neill, I would always get questions regarding the shapes of bases. Does this stock base qualify as a cup with handle? Is this handle too deep relative to the overall base? Why is this not an ascending base? The chart is moving higher in textbook fashion as an ascending base should. Situation. While such questions are relevant, I found that investors often end up relying too much on the shape of the chart pattern instead of understanding how the stock's base is playing out relative to the general market. This can lead to misinterpretations and missed opportunities. For example, Figure 4.28a shows a chart of Charles Schwab Corporation, Schwa. The base that formed was called a cup with handle, yet the cup looks rather defective as it is fairly V-shaped, whereas a textbook cup with handle has a rounded bottom. Further, the handle pulled back a steep minus 26.7%, which was huge relative to the depth of the base of minus 39.7%. However, this cup with handle base was buyable since, taken in context of the general market, the base was valid. From August to October 1998, the general market was in the grips of a major bear market as shown in Figure 4.28b. Notice how the general market hit lower lows, Figure 4.28b, between the first bottom on September 1, 1998 and the second bottom on October 8, 1998, yet the second bottom was much higher than its first bottom. This second bottom would normally be a handle had the market not fallen so far. Further, the V bottom would have been rounded had the market not been plummeting. Solution. So you might be asking why use labels if they can be so misleading. The simple answer is that labels are great training wheels for those who are learning how to spot good bases and are generally useful to any investor during normal market conditions. But should the market go into a tailspin, be careful not to rely too much on the shape of the overall base. Always interpret the base pattern within the context of the general market, waiting too long to sell due to unusual circumstances. Problem: I did not sell Cypress Semiconductor (SI) in early 2008 because I was away from my computer screens for 20 minutes while it was resting on its 50-day moving average, as shown in Figure 4.29. When I came back 20 minutes later, it had fallen 7% under my mental sell stop. Situation: I was quite shocked and upset. Instead of selling it, it looked oversold as the level of volume was rather small, and there was no news to account for the sharp sell-off that had occurred over the 20 minutes I had been away. Normally, I never use oversold indicators to guide my selling since oversold often becomes even more oversold. I just sell the stock if the price of the stock hits my mental sell stop and ask questions later. But in this case, I let my emotions get the best of me. I was upset and felt cheated and figured CY would snap back, so I held it. Near the close, it began to bounce back, so I held the position. The next day, it traded higher but only slightly, and then proceeded to sell off another -3.2%. I should have sold the stock, but the volume was lower than the day before, so I figured it was truly oversold at these levels, as there was still no news on the stock. The third day, CY sold off another -2.7%. Now the stock was -12.4% under where I had originally intended to sell it. At this point, it became that much harder to sell. I was psychologically stuck in the position. As has been said, the first sell is the easiest. I had almost always obeyed my mental sell alerts. I was not used to dealing with being stuck in no man's land. CY proceeded to decline an additional -32.8% in the ensuing 10 days, putting it at -41.1% from where I had originally intended to sell it. I finally gave in and sold it a few days later on an anemic bounce on January 29, 2008. Solution: don't let your emotions cloud your judgment. If events stack up against you and you feel cheated, don't let that derail you from your focus of following your rules. Breaking my sell rule cost me money. Introducing new elements into your trading. Problem: when I started managing money for Bill O'Neill, I did not have real-time quotes. My quotes were delayed 20 minutes. Over a 3-month period, having real-time quotes did me more harm than good. I found that real-time quotes brought me too close to the market action, such that I would get scared out of positions on any sharp intraday reactions in the general market. Having real-time quotes temporarily changed the way I normally traded stocks until I learned to adjust. Situation: Bill O'Neill once did an informal study of his portfolio managers and found that there was no edge gained by having more computer monitors to watch during the trading day. In other words, having more computer monitors to watch did not add to performance, and in some cases seemed to cause more harm than good. Sometimes the less information overload you allow to distract you or scare you into making rash moves, the better off you are. One of the best current portfolio managers at William O'Neill Plus Company, Inc., is a woman who comes into the office later in the morning, a couple of hours after the market has opened, which has an insulating effect and also allows the market time to settle in before making any trading decisions. By operating on a longer time frame and not reacting to the opening news and market movement, one may actually block out a lot of the noise that can cause a trader to react in a less than totally objective manner. Solution: having too many monitors can be distracting. It can take traders away from their focus and cause them to miss an optimal buy point or sell point. Further, intraday charts can scare one out of a position prematurely. It is better to use daily and weekly charts until one learns to constructively use intraday charts, much as I had to constructively learn to deal with real-time quotes way back in the day. Opportunities exist when you least expect them. Problem: the market was in a correction, so I was not diligently running my buy screens each day. Situation: just because the market is in a correction is no excuse to not run your buy screens each day. I consequently missed out on some excellent opportunities. Some of the best stocks will offer logical pivot and pocket pivot points during weak markets. Solution: don't skip running your daily buy screens just because the market may be correcting. Do not over-intellectualize. Problem: one enjoys intellectualizing about the market but crosses the line and starts trying to predict where the market will go. I know of no one who has been able to make such predictions with perfect timing. While there are admirable investors such as Jim Rogers who make long-term trend predictions that are often eventually correct, even as Rogers himself admits, his timing can be way off. Situation: the need to be right will eventually end up costing the investor. This is perhaps why I knew of nearly no scientists at Lawrence Berkeley National Laboratory, the complex adjacent to University of California, Berkeley, where I obtained my doctorate degree in nuclear chemistry, who were successful investors. They had massive egos as world-class scientists, so they repeatedly made the mistake of trying to tell the market what to do and where it should go. Over-intellectualization is a big trap. Each time one thinks one has mastered the market, one will soon find there is yet so much more to learn. That said, I have read Edwin Lefever's book Reminiscences of a Stock Operator over 10 times. Each time, I learn new things from reading it. The experiences I have accumulated since I last read the book brings forth new meaning and understanding upon rereading it. Solution: one must watch the market day to day and make investment decisions accordingly. While it may be a seemingly necessary exercise to try to predict where the market will go, one should not let conclusions about the future of the market derail one's focus from the present. Staying in the now means being in tune with the market on a daily basis and will serve to keep one in the focus of quietly listening to what the market is saying. One can then adjust market exposure accordingly. How to deal with trading slumps. Problem: the market damages your psychology repeatedly through a series of losses, causing a deep slump. Situation: while slumps can be difficult to overcome, don't become like the aged prize fighter who has lived past his prime, reliving in his own mind former moments of glory, unable to recover his lost youth. More mature market wizards such as Bill O'Neill and Ed Seykota prove that when it comes to investing, age, whether young or old, has little to do with successful investing. Solution: Chapter 10 will discuss in detail philosophical ways in which you can recover from your slump and repair your damaged psyche. In the meantime, here are ways to come out of trading slumps. Engage your mind in something completely different for a week, such as traveling, playing a musical instrument, doing something artistic, or learning a new skill. The new mental stimulation has a way of switching mental gears so your subconscious mind can begin to repair itself. Use exercise and a proper diet to jumpstart yourself. This will be covered in detail in Chapter 10. Keep an active trading diary, which can help your mind reach logical conclusions about why you're in a slump. You can also review your diary to reinforce the lessons you learn. Always review your trades to spot weaknesses that are caused by a deficient trading technique, misunderstanding the strategy/improper application of the strategy, or emotional issues that are causing losses. Conclusion: as one can see, many pitfalls await even the most experienced traders. Here are some suggestions on how one can keep evolving as a trader. Always keep reading and learning. By 1999, I had read over 200 books on the stock market, having read my first book on investing at age 13. Reading new books even when you think you have learned it all reinforces what you already know, and may even give you new ideas on how to optimize your trading strategy. Reread excellent books. Over the years, we have read books such as Reminiscences of a Stock Operator, William J. O'Neill's How to Make Money in Stocks, and Jack Schwager's 2 books, Market Wizards and New Market Wizards, multiple times. Anytime a book is read again after one has gained new experiences, the book takes on deeper meaning. Feel and embrace the pain of the loss caused by the mistake. Ed Seikota's Trading Tribe Technique, which can be learned at www.tradingtribe.com, is one of the most effective ways to stay on track as a trader. Eckhart Tolle's philosophy of embracing and accepting the pain of loss is equivalent and enormously effective. Both of these techniques will be discussed in Chapter 10. Keep an active trading diary that will highlight your mistakes. The act of writing down your mistakes creates a neural trace in your mind that underscores the mistake, so you are less likely to repeat it. Annotate charts showing your buy and sell points. Carry these charts with you so you drill into your mind proper and improper buy and sell points. Make notes on why you made an error and determine its cause, whether it was simply emotions getting in the way or related to misunderstanding your strategy or misreading clues on a chart. Jesse Livermore often said that there are far more ways a person can lose money than are imaginable. After experiencing 20+ years worth of mistakes, we could not agree more. Experience is an amazing teacher if you embrace your failures. Remember that, in reality, there is no failure, only feedback, and that if we learn from our failures, we are actually failing forward. Chapter 5. Trick of the Trade. Bill O'Neill used to tell us that making big money in the market wasn't about buying the right stocks as much as it was about handling them properly once you've bought them. You can always buy a potential leader as it initially breaks out from a first stage base at the outset of a big price run. But if you sell it after it goes up 10% and it continues up another 190%, you didn't handle it properly. This is a critical component of our methodologies, which include a number of specific techniques that can be used in real time to handle positions in strongly performing stocks. Also, as more and more investors and traders use the same tools and have access to all the same real-time news, charts, data, and market indicators, market participants all see the same things happening at the same time, taking on the characteristics of a herd, or at least a market that to some extent watches itself. It is, therefore, understandable that most investors and traders, regardless of their methodology, would like to find some additional tools or tricks, if you will, that can provide them with an edge, both with respect to finding alternative and early buy points relative to standard new high/base breakout buy points, as well as a coherent system for selling stocks and handling positions in real time, particularly positions in potentially big, winning stocks. If you count yourself among these investors and traders, this chapter will provide some answers and solutions. Pocket pivot buy points, gap up buy points, and selling rules using the 10-day and 50-day moving averages and the 7-week rule are more than tricks, although we like to think of them as such. They are, however, very specific rules-based micro methods that should be relatively easy for investors to grasp and implement in their own trading. Dr. K's Laboratory, the Pocket Pivot Advantage. In the O'Neill literature, you will find many references to new high pivot point buy points, as well as trend line and moving average breakouts, but you will not find any definition of pocket pivot buy points. This is because the concept of the pocket pivot, essentially an early buy point relative to traditional O'Neill techniques, did not exist until it was discovered in Dr. K's laboratory in 2005, as a result of research studies that were performed for the express purpose of finding a solution to the flattish, compressed, and somewhat sideways moving markets of the mid-2000s, see S&P 500 weekly chart from 2004-2005. Such markets contrast with the more strongly trending market environments seen in the 1980s and 1990s. In simple terms, a pocket pivot, or buying in the pocket, is an early base breakout indicator, which is designed to find buyable pivot points within a stock's base shortly before the stock actually breaks out of its chart base or consolidation and emerges into new high price ground. Having met and talked with a broad range of institutional investors through our affiliation with William J. O'Neill Plus Company's Institutional Services Department, as well as at the workshops we presented at for the company, We gained a distinct and unique appreciation for the fact that institutional investors, such as hedge funds, mutual funds, and pension funds, do not like to buy breakouts to new highs. In fact, they generally prefer to buy stocks off of their lows, and sometimes the lower the better. Of course, if we think about this for just 1 second, we realize that it is the institutions that create the bottoms of chart bases, including the volume/accumulation clues along the lows of a constructive base formation. The premise of the pocket pivot is simple. If it is the buying of institutions that carves out the bottom of a constructive base from which a stock may break out to new highs later on, then we can postulate that the clues of their buying and accumulation in the lower parts of a stock's chart base should be evident and could offer optimal, low-risk entry points to begin taking a position, particularly if the stock is a proven market leader. Such evidence will show up in the daily chart as well as the weekly chart. But to determine precise pocket pivot buy points, we make prodigious use of daily charts. The pocket pivot can give an investor a head start on accumulating a leading stock within a base formation. And in markets where standard breakouts are more often fake outs, as the example of Dendrian Corp. DNDN, in Figure 5.1 shows, the pocket pivot buy point technique can get an investor into a stock at a lower risk price point, and thereby make it more possible for the investor to sit through a pullback if the all-too-obvious new high breakout buy point fails initially and the stock retrenches, corrects, or sells off. The pocket pivot was identified after much lab research going back through our individual trades since 1991, and then spot-back testing through prior decades. Finally, the concept was tested again in real time under fire with actual money, and as an early entry point has proven to be a highly exploitable phenomenon. During the mid-2000s, this was especially helpful as many standard new high base breakouts were not working in the shallow and sideways moving markets of 2004-2005. While there were small but sparse windows of opportunity, such as one in late 2004 and two very brief windows that opened in mid to late 2005, many initial buys at standard new high buy points would quickly turn into -7% to -8% losers within a few days. When operating with thinner, less liquid and lower priced stocks, the pocket pivot can provide a useful buy point that is less obvious to the crowd. When thin stocks break out through obvious resistance levels to new highs, the crowd tends to see them and hence is more able to run the stocks up, exacerbating the upside price movement. As well, when such thinner stocks begin to sell off, their lack of trading liquidity will exacerbate their downside velocity, which increases the risk inherent in such stocks. In general, stocks that trade less than $30 million in daily dollar volume or less than 750,000 shares a day fall into this category. There are exceptions to this, of course, but as a general guideline, these parameters suffice for the purpose of judging a stock's liquidity and associated price volatility and risk. Reno International Reno, shown in Figure 5.2, was a relatively thinly traded stock at the time it broke out of a base in late September 2009. Note that the move up through the 15 price area in the latter half of September was fairly sharp, and the stock moved up rather quickly up through the 20 price level before pulling back sharply and finding support at the 10-day moving average. If investors had bought the breakout to new highs, the sharp pullback below the 10-day moving average might have caused them to be shaken out of their position. However, buying on the pocket pivot buy point before the stock rose above the 15 price level would have given investors buying the stock at that point a head start on the stock and put them in a better position to weather any pullback after the stock quickly rallied up through the 17.75 high in the base on the standard new high pivot point. Another example of using a less obvious pocket pivot buy point in a smaller stock is seen in Jazz Pharmaceuticals, Jazz, a thin, low-priced stock with a strong fundamental picture given its strong pipeline of new and existing products at the time. The move up through the 50-day moving average on December 9, 2009, occurred on a material increase in volume after the stock had been exhibiting very tight price action as it drifted into the 7.00 price area on extremely light volume. The fact that the pocket pivot occurs right after this extreme volume dry-up is highly constructive, and while the stock does not launch to the upside, it does build a tight, sideways consolidation with virtually no selling volume in the formation. Once a thin stock like Jazz begins to move higher, its price moves, one way or the other, can be exacerbated by its small size and lack of trading liquidity. Hence, buying a solid, reliable pocket pivot point as the stock acts very quietly provides a strong entry point as one tries to build a position in the stock. Watching for pocket pivot action in smaller, thinner stocks with potentially strong fundamental outlooks can be rewarding, as the examples of Reno and Jazz illustrate. Characteristics of pocket pivots. A pocket pivot point generally occurs within the stock's chart base, before the standard new high breakout buy point appears. Pocket pivots can also appear as continuation buy points as stocks move higher after launching out of a chart base or consolidation. Price/volume action and base formation leading up to a pocket pivot point are of paramount importance in identifying a proper pocket pivot buy point. Pocket pivots are also signs of strength within the base of a leading stock, and as such have some predictive value with respect to the potential of a stock to continue higher. A stock will often break out of its base within a few days or sooner of a proper pocket pivot point, assuming the general markets are also acting bullish or are in a bull trend. When looking for pocket pivot points, limit your universe of potential candidates to fundamentally strong stocks with constructive basing action leading up to the pocket pivot point. This would include characteristics such as tight price closes within the weekly chart, as well as high volume spikes with supporting or upside action on the weekly range, or other evidence of accumulation within the base. We would avoid wide and loose bases, since the premise of accumulation that the pocket pivot concept is based upon is not generally evident on the charts of stocks forming wide and loose bases. Pocket pivots within such faulty patterns are therefore more prone to failure. In addition, it is necessary to compare the overall base formation to the action of the major market averages formations such as the Nasdaq Composite and S&P 500 indexes to see if the stock's base formation is constructive relative to the overall averages. For example, a pocket pivot that occurs within the base of a stock that is acting and holding up much better than the market averages would carry more weight than one that occurs in a stock that is acting much more erratically or negatively than the general market and leading stocks as a whole. Definition of a pocket pivot buy point. Pocket pivot points in fundamentally strong stocks are preferable, and in particular one should constantly monitor the big stock leaders in any bull cycle for potential pocket pivot points. The internet stocks in 1999, Apple and Google in 2004, and solar stocks in 2007 would have been areas to focus on for monitoring pocket pivots during those particular bull market years and cycles. The idea behind a pocket pivot is that one is buying the stock in the pocket, as a less obvious but valid and reliable buy point within the stock's base. While many different buy points in a stock's chart can meet the definition of a pocket pivot, some can be improper, as we will see later in some of the examples. Similar to what you would want to see in a proper base formation, a stock should be showing constructive price/volume action preceding the pocket pivot. Just prior to the pocket pivot, as the stock is moving within its overall base structure, tighter price formations, that is, less volatility should be evident in the stock's price/volume action as viewed on its chart. The stock should have been respecting or obeying the 50-day moving average during the price run that occurred prior to the time the stock began building its current base. This indicates that the stock's character is such that it can be expected to continue to do so. Therefore, you can use the 50-day moving average in such a case as a sell guide if the stock begins to violate its prior character. For instance, its habit of obeying or respecting the 50-day moving average. If the stock's character is such that it tended to obey or respect its 10-day moving average on its prior price run before building its current base, then you might expect to use the 10-day moving average as your guide for selling the stock. the stock's price/volume action will ultimately determine whether you should use the 10-day or 50-day moving average as your guide for selling the stock. Except in very rare cases, such as in the aftermath of the crash of late 2008, pocket pivots should only be bought when they occur above the 50-day moving average. Ideally, the stock's price/volume action should become quiet over the previous several days, which contrasts with the much larger and stronger volume move that comes on the pocket pivot itself. On the pocket pivot, you want to see up volume equal to or greater than the largest down volume day over the prior 10 days. We call this the proper volume signature. If the volume has a habit of being choppy, in other words varying greatly from day to day, then you increase this to 11-15 days. Visually, this means that there should not be a lot of big, spiking down volume bars in the chart over the prior 10 days as well as the stock's overall base formation. Ideally, volume should be relatively consistent over the prior 10 days, preferably drying up, and then should burst higher on the day of the pocket pivot, as is evident, for example, in Jazz Pharmaceuticals, Jazz in Figure 5.3. Pocket pivots and standard breakout by points. Sometimes a pocket pivot will coincide with a standard new high base breakout by point, a classic O'Neill pivot point. If the pocket pivot coincides with a base breakout, then volume does not have to be at least as great as the down volume day over the previous 10 days, but should be acceptable breakout volume. In the example of Baidu, Inc. Baidu, in Figure 5.4, we can see that the volume on the new high breakout of September 4, 2007, which is also a pocket pivot point by definition, was the highest over the prior 10 days, but would not have to be if the volume on the breakout is of sufficient magnitude required for any standard new high pivot point type of breakout by point. In this case, the volume on the breakout was 39% above average, when you would normally want to see volume come in at 50% above average or more. However, given the pocket pivot rule, where volume on the pocket pivot only needs to be the highest compared to any down volume day over the prior 10 days, this breakout was actually buyable as a pocket pivot, even though a 39% volume increase is not necessarily preferable on a standard pivot point breakout. Baidu base on this breakout was V-shaped and somewhat volatile due to the general market sell-off at the time, but the stock did hold its 50-day moving average after dipping below it for 2 days in mid-August. The stock then set up again above the 50-day, 20-day, and 10-day moving averages before staging the pocket pivot on September 4, 2007. We see in the Baidu example how a standard breakout pivot point that does not meet the 50% volume increase preferable for such a classic O'Neill style buy point can still be acceptable if it meets the pocket pivot volume rule, whereby the upside volume on the day of the pocket pivot should exceed any downside volume in the pattern over the prior 10 days. The converse of this example is where the new high breakout has a volume increase of over 50%, meeting the requirement for such standard breakout pivot points, but the volume is less than the highest down volume day in the prior 10 days, which does not meet the requirement for a pocket pivot buy point. With Baidu, the pocket pivot volume requirement was met, but the 50% standard breakout pivot point volume requirement was not, making Baidu buyable only as a pocket pivot buy point. First Solar, FSLR, shown in Figure 5.5, is a good flip-side example of the Baidu situation. In FSLR's case, the stock formed a cup with handle formation and then staged a proper breakout through the top of the handle on September 21, 2007, with volume 52% above average, meeting the volume requirement for a standard breakout pivot point from the handle. However, note that the volume on September 21st was lower than the big downside volume spike we see on the chart that occurred 7 days before the volume spike on the pocket pivot and breakout buy point day on September 21st. In this case, FSLR was buyable as a standard handle breakout pivot point, but not as a pocket pivot, since volume was not higher than the downside volume spike of 7 days prior. Note that on September 28th, FSLR flashed a valid pocket pivot buy point one day, before it also flashed a new high breakout buy point, as the stock pushed through the 123.21 high in the base and into new high price ground. The pocket pivot got you into the stock one day earlier. Yahoo! Inc. Yahoo! In Figure 5.6 illustrates an example where the breakout is both a pocket pivot and a standard O'Neill base breakout type of buy point. After a very quiet period of backing and filling as it drifts just below its 50-day moving average and volume dries up, Yahoo bursts back above the 50-day line on volume that is higher than any down volume day in the prior 10 days. But this is also a breakout from a 7-week flat base that was showing very tight weekly closes, just as the daily chart in Figure 5.6 shows a nearly 1-month-long series of very tight and orderly action in the daily closes just before the pocket pivot occurs. Buying in the pocket. Whether buying pocket pivots in the base or within an uptrend, pocket pivots should ideally occur after consolidation of some sort. Naturally, the length of consolidation of buying within a base will be longer than the length of buying within an uptrend, also known as continuation pocket pivots. That said, some of the strongest price performers may only rest long enough to hit their 10-day moving average briefly before bouncing higher on volume, which, if conditions we have discussed in this chapter are met, would qualify as a proper pocket pivot buy point. This presents the investor with a multitude of possible buy points to get on board top-performing stocks and enables investors to initiate a position in a leader even if they miss the initial base breakout. To better understand the entire concept of buying in the pocket, we will review a short pocket pivot model book of pocket pivots that occur within a stock's base and which often give investors an early entry point in a fundamentally sound, leading stock building a proper base during a bullish market backdrop. We will then discuss buying pocket pivots in an uptrend or continuation pocket pivot points in a subsequent section of this chapter. In March of 2007, NVIDIA Corp. NVDA was rounding out and coming up off the second low of a potential base formed in the first quarter of 2007. This base was roughly 30% deep, and along the lows the stock was picking up some big volume support, as we see in Figure 5.7. The big volume spikes are positive signs off the lows of the potential base, and they provide a constructive backdrop and context to the pocket pivots that occur later on in the formation on May 11th and May 31st. Apple, Inc. Apple pocket pivot on August 25, 2004. Figure 5.8. was the earliest buy point for Apple after the Nasdaq Composite Index had bottomed and turned to the upside on August 13th. Coinciding with this market bottom and follow-through on August 18th, which signaled a new general market rally phase. Apple's August 25th pocket pivot was the first buy point in what became a very strong price advance that lasted into the first quarter of 2005, and during which the stock nearly tripled in price from the pocket pivot buy point. Fundamentally sound stocks staging big upside price moves on heavy volume will always show up on our daily screens, as this is always a meaningful initial flag that a more sustained upside price move is brewing. But because of their extended condition after the run-up, they are often not buyable without taking on greater risk. Following any strong price run-up over several days, however, a stock will inevitably begin to pull back and consolidate. If this pullback and consolidation occur in an orderly and constructive fashion, it is useful to watch carefully for potential pocket pivots to form as the stock finishes up its short consolidation following the sharp price run-up and sets up again. VeriSign, Inc. VRSN, in late 1998 provides a very good example in Figure 5.9. In early November 1998, VeriSign, Inc. VRSN had a sudden, sharp, 3-day upside price burst as it pushed up the right side of a potential cup formation with a cascade of volume increases. As VRSN pulled back and formed a handle to fill out what was shaping up to be a cup with handle base formation, it drifted downward within the handle and then briefly dipped below the 20-day moving average on an intraday basis before closing above the 20-day moving average. The next day, on November 24, 1998, VRSN pushed up off of its 20-day moving average on volume that was higher than any down volume days over the prior 10 days, a pocket pivot buy point. 2 days later, the stock cleared the high of the handle in the cup with handle formation for a standard new high base breakout buy point. VRSN then pulled back sharply for 2 days, but held the 20-day moving average right around the pocket pivot buy point of 5 days earlier. Buying the pocket pivot would have made it easier to sit through the sharp pullback after the new high base breakout. Another interesting example is Riverbed Technology, Inc., RVBD, in May of 2007, figure 5.10. On April 25, 2007, RVBD had a big one-day gap-up move that sent the stock flying up off the lows of a 41/2-month base formation and through its 50-day moving average. Obviously, this move could be considered a pocket pivot buy point, but it became extended very quickly, and so may not have been so easy to buy in real time. In any case, the huge volume gap-up move through the 50-day moving average was an initial flag of strength in the stock, and the ensuing pullback and consolidation of that sharp, one-day price move were relatively orderly as the stock drifted lower, holding the 10-day moving average on a closing basis. Right off the 10-day moving average, there were 2 upside days on May 2 and May 4, 2007, where the volume was higher than any downside volume days over the prior 10 days in the pattern, hence each qualified as a pocket pivot buy point. Notice also that, as the stock pulled down into the 10-day moving average, volume dried up on each of the days just before each of the 2 pocket pivot points, an additional sign of constructive action. Sometimes pocket pivots occur in a base formation just before a stock is about to announce earnings, implying an information leak somewhere as volume picks up during the regular trading day, and the stock stages a pocket pivot type move. As an example, we can look at Intuitive Surgical, Inc. ISUG, on October 25, 2005, the day that the company announced earnings after hours, figure 5.11. Despite the intuitive uncertainty of the earnings announcement, the stock's price/volume action was telling another story as ISUG poked its head up above its 50-day moving average on strong, above average volume. By monitoring the big stock leaders and checking their price/volume action going into an earnings announcement, it is possible to use pocket pivots as a sign that taking a position in the stock just before the earnings announcement is less risky than might otherwise be perceived. If the stock is showing pocket pivot action, including strong volume at the close of the day when the company announces earnings, then a position can be taken near the close of the normal trading session, once it is clear that volume will exceed the highest down volume in the pattern over the prior 10 days. Pocket pivot buy points going into earnings announcements are playable, in our view, and position sizing can be scaled to one's risk tolerance, and whether one is adding to an existing position or initiating one. Pocket pivots are often relatively quiet buy points within a stock's base formation. Amazon.com, Amazon, in the latter half of 1998, was working on a rather choppy base formation as it bounced along its 200-day moving average, figure 5.12. By the time it was starting to work its way back higher up the right side of the base, selling volume was subsiding quite significantly, setting up a pocket pivot buy point on October 29th, as the stock came up off the 10-day moving average on volume that was greater than any down volume day in the pattern over the prior 10 days. Within 3 weeks, the stock was breaking out of the 41/2-month base formation and into new high price ground. Buying quiet pocket pivots can at times require some patience, but being able to sit with a partial position taken on a pocket pivot buy signal, as long as the stock continues to track sideways tightly and constructively within its base formation, can have its rewards. Once an initial position is taken on a pocket pivot buy point that is well in the pocket, it can be doubled up on if a second pocket pivot a little higher in the pattern shows up, or if the stock stages a standard base breakout. We saw one example of this in the Jazz Pharmaceuticals, Jazz, example in figure 5.3 near the beginning of this chapter, and in Phosphase, Inc. INSP, in figure 5.13, is a similar type of situation. INSP sets up a constructive context for its pocket pivot buy point by first staging a shakeout through the lows of the base. It has formed from mid-July into the end of October 1998. Note how the stock undercuts a prior low within its base structure on September 24th, as volume picks up sharply at 123% above average. This appears as a breach of support, and hence is interpreted as a bearish development for the stock. However, this is too obvious, so the crowd is faked out here as the very next day INSP gaps to the upside and moves back up into the base structure on heavier volume than the previous day's gap-down decline and breach of support at the lows of the base. This is a very constructive shakeout, which is simply part of the process of bringing in strong hands and cleaning out weak hands that every stock goes through, as it forms what may later become a basing formation for an eventual successful upside price move. INSP then drifts down slightly over the next several days as volume dries up precipitously, setting up a very favorable context for the ensuing October 7th pocket pivot buy point. INSP holds above all of its moving averages following the pocket pivot as it moves tightly sideways and eventually resolves in a gap-up base breakout at the end of November 1998. Following that standard base breakout in late November, INSP did a little backing and filling, and several pocket pivots occurred in the pattern at that point, but we will leave those to the reader to identify. Blue Coat Systems, BCSI, flashed a pocket pivot buy point in its base on May 15, 2007, figure 5.14. This was followed by a breakout to new highs that came right back in to test the pocket pivot point a couple of times before the stock began moving higher again. Buying the pocket pivot here gives the investors a slightly lower entry point that may make it easier to hold through any of the initial pullbacks to the 10-day moving average that ensued in the stock over the next 7 days following the pocket pivot. Before Charles Schwab Corp. Schwab cleared to new highs in late 1998. It produced a very clear high-volume pocket pivot buy point as it began pushing out of a jagged handle within an overall cup with handle base formation in October of 1998. What makes this particular pocket pivot compelling is that it was also a handle breakout that occurred on the exact same day as the market follow-through on October 15, 1998, that ended the short, sharp 3-month bear market of that year and signaled a new rally phase for the market. Schwab was a big leader in the market rally that began off the October 1998 lows, along with America Online, AOL. A lot of money was eventually made in these stocks when we were managing money for Bill O'Neill back then. But despite this, Schwab did not go galloping right out of the gate following that October 15th pocket pivot buy point. It noodled about the 10-day moving average for another 2 weeks before staging a new high breakout and starting its sharp ascent to the upside. See figure 5.15. Pocket pivot points can sometimes add clarity to the price/volume action in the chart patterns of stocks that are not quite perfect. For example, SunPower Corp. Espira built one base in late February to March of 2007, from which it broke out, as the general market was coming out of a correction, and following through back to the upside, initiating a new general market rally phase. Espira chart formation was a little erratic, figure 5.16, but the pocket pivot point of March 27th provided a clear, early buy signal that came only a few days after the March 21st market follow-through. Espira rallied approximately 38% higher before pausing to build another base, this time a cup formation from which it then proceeded to break out without ever pausing to build a handle, which may have thrown investors trying to buy the stock as they waited for the handle to form. However, all of this could have been avoided by using pocket pivot buy points instead. June 5th was the first pocket pivot buy point, but the stock immediately pulled back, which could have stopped out investors using a tight stop on the pocket pivot buy. However, 1 week later, on June 14th, Espira flashed another pocket pivot buy signal on which the stock could have easily been bought back in time to catch the ensuing price move. The price/volume action along the lows in both of Espira bases was fairly tight, and in the second cup base was extremely tight. This was also confirmed by the weekly chart, figure 5.17, which showed a series of 4 tight weekly closes right along the lows of the base, coinciding with the tight sideways action shown in Figure 5.16 from late May to early June 2007, as well as 3 tight weekly closes at the end of March 2007. Potash Corp. Saskatchewan Pot is a classic bursting type of pocket pivot buy point that occurs as the stock bounces up off the 50-day moving average and through the 10-day and 20-day moving averages on a big spike in volume, and one that is also greater than any down volume in the pattern over the prior 10 days, per our volume rules for defining pocket pivot buy points. This pocket pivot on March 30, 2007, see Figure 5.18, was a low-risk entry point for a roughly fourfold upside price move. Notice how POT was tracking tightly sideways throughout most of March 2007 as it quieted down and volume remained below average. This is exactly the type of action you want to see leading into a pocket pivot buy point, as it sets the proper context for the pocket pivot to have a higher probability of success. Stocks that start out their lives as sizzling hot initial public offerings often begin trading and within a short period of time are moving higher as they break out of chart patterns that on first glance do not appear to be buyable. For example, the big moves in solar energy stocks back in 2007 also resulted in a huge number of IPOs in the group coming to market. These were often hot IPOs right out of the gate, and among these hot IPOs was LDK Solar Co. Limited. LDK, shown on a weekly chart in Figure 5.19. Right after coming public, LDK formed a short 4-week, V-shaped cup formation from which it then broke out of on no discernible volume increase, since the stock had very little history on which to base average daily trading volume. If investors were looking for a sound base off of which to buy LDK after it came public, it was not cooperating as it simply took off to the upside after briefly pulling back from its offering price of $27 a share. Setting the weekly chart aside, however, and focusing on the action in LDK's daily chart right after it came public revealed a slightly different picture, Figure 5.20. On June 22, 2007, LDK bounced up off of its 10-day moving average on volume that was higher than any down volume day in the pattern over the prior 10 days. Interestingly, the volume on June 22 was 1,204,400 shares traded, only 100 shares higher than June 8, which at 1,204,300 shares traded was the highest down volume day in the pattern within the prior 10 days. Strictly speaking, the definition of a pocket pivot buy point held on June 22, but if one hesitated to buy on that day, then the next trading day, June 25, offered an immediate second pocket pivot buy point. The main point in this example is that using pocket pivot buy points changes entirely how we think about buying compelling IPOs. Generally, the O'Neill methodology would dictate that we wait for a proper base of at least 6 to 8 weeks to form, or at least a high, tight flag type of formation. In the case of LDK, the stock built a rather nondescript little V-shaped pattern that did not fit the definition of a proper base. Viewed from the perspective of using pocket pivots to determine proper buy points within patterns, LDK was entirely buyable as early as June 22, 2007. It is not necessary to look at a weekly chart of Yingli Green Energy, IGE, to determine that the short flag formation it formed on the daily chart, Figure 5.21, was of insufficient length to be considered a proper, high, tight flag formation since it only had 1 week down in the flag. However, in evaluating IPOs, pocket pivots offer an entirely different approach to buying such hot IPO stocks, an approach that is not as dependent on the idea of the stock having to build a proper base formation first. On June 27, 2007, YGE moved up off its 10-day moving average on volume that was the highest in the pattern since the IPO date 13 trading days earlier, hence meeting the technical definition of a pocket pivot buy point. Bottom fishing with pocket pivots. Some pocket pivots can occur as stocks that have corrected and declined a significant amount finally hammer out a bottom after several weeks or months of base building along the lows of the decline. The severe market break that began in September 2008 took a lot of former big stock leaders from the immediately preceding bull phase down sharply. Some of these stocks eventually declined over 70% or more from their bull market price peaks, at which point they began to stabilize and probe for potential bottoms. After several weeks or months, the stock will have finally started to round out a potential bottom. It is at this point that investors should be alert to potential pocket pivots, as they will often show up in a stock that is potentially coming up off its lows and ready to stage some sort of material rally off the bottom. Baidu, Inc. Baidu was one such former leader that declined 73.8% off of its bull market price peak, and by late November 2008 was trying to probe for a bottom, figure 5.22. This process went on for the next 2 months before the stock was finally able to regain its 50-day moving average on a pocket pivot buy point on January 28, 2009, well before the market itself had bottomed. Note that once Baidu had climbed back above the 50-day moving average on the pocket pivot, it never broke back to the downside as it obeyed the 50-day moving average. Another big stock leader that declined precipitously in the severe market break of late 2008 was medical robotics pioneer Intuitive Surgical, ISAG, which had declined 84.86% off of its bull market price peak at its ultimate low. After peaking out at 359.59 in December of 2007, ISAG finally began trying to find a bottom as it dipped below the 90 price level twice in late January and then early March 2009 to form a double bottom bottoming formation, not to be confused with a double bottom chart-based formation, which is formed as part of a stock's overall uptrend during a price advance. Once the double bottom had been put in at the lows, ISAG advanced up to its 50-day moving average figure 5.23, before backing down again and moving tightly sideways through the end of March and into early April 2009. The general market had already followed through on March 18, 2009, signaling a new general market rally phase, and ISAG gave a pocket pivot buy point signal on April 9 at 103.75. This led to a very sharp price advance over the next 4 weeks that took the stock over 60% higher. By the end of 2009, ISAG had surpassed the $300 price level. If one had been lucky enough to enter the stock on the pocket pivot buy point day, April 9th, the ensuing upside move provided enough cushion to potentially allow one to sit through a longer upside price move. Using pocket pivot buy points can be applied similarly to stocks in deep bases, such as Baidu, Inc. Baidu, in April of 2007, figure 5.24. Baidu was in the midst of trying to find a bottom following a decline of 30.8% off of its January 2007 price peak of 134.10. And as it was dipping down below and tracking along the 95 price level, there was a noticeable decline in selling volume. This is visible in figure 5.23 throughout the first 3 weeks of April, roughly, before the stock burst up through its 50-day moving average on the necessary volume increase for a pocket pivot buy point on April 24th. 3 days later, Baidu was gapping up toward new price highs as it launched on a price run of over 100% in only 11 weeks from the pocket pivot buy point. We often see pocket pivot buy points show up in a stock's chart pattern a few days, sometimes even only 1 day, before a major price gap up, providing a material and potentially hugely profitable clue that enables us to buy the stock and be in position to benefit from the gap up. Research in Motion RIM, in mid-August of 2007, provides a fantastic example of a deep-in-the-pocket pocket pivot buy point 2 days up off of the absolute low of a deep double bottom type of formation that is only 4 weeks in duration, insufficient for a proper double bottom base formation, figure 5.25. On August 15th, RIM began to roll over, closing below its 50-day moving average. Volume was not particularly heavy given the break through the 50-day line, coming in at only 9% above average for the day. The next day volume picked up sharply, and RIM reversed back to the upside, but remained below its 50-day moving average. On August 17th, RIM gapped back above its 50-day moving average, and with very strong volume coming into the stock right off the market opening, it was immediately buyable as a pocket pivot buy point. Pocket pivots have proven to be useful in bottom fishing, as they provide more reliable reference points for buying stocks as they attempt to rally off the lows of a severe, prior price decline, or a very deep base formation of 30% or more. Continuation pocket pivots, using the 10-day moving average. Once stocks have broken out of a base and are in an uptrend, heading higher in price, finding low-risk points at which to add to one's position in a strongly acting stock is not always so easy. Waiting for a pullback to a prior standard base breakout pivot point, or the 50-day/10-week moving averages, is always possible. But having the ability to confidently pinpoint actionable buy points using pocket pivots within an uptrend is a highly useful additional arrow in our quiver. In general, we focus on the 10-day moving average as our buy guide when determining continuation pocket pivot buy points within a stock's uptrend. As always, we maintain a volume requirement that the pocket pivot off the 10-day moving average come on volume that is greater than any down volume day in the pattern over the prior 10 days. Riverbed Technology, RVBD, offers a good example of a stock obeying or respecting its 10-day moving average as it trends higher, figure 5.26. Two pocket pivot buy points occur in the uptrend as it bounces up off the 10-day moving average on October 27 and November 13, 2006. Notice that once RVBD stops respecting the 10-day moving average and closes below the line, it can be considered as a short-term sell signal, something we will cover a little later on in this chapter. Apple, Inc. Apple first emerged as a big leading stock in the latter half of 2004 as it was riding the iPod wave, initially breaking out of a cup with handle base in March of 2004, just as the Nasdaq Composite was already 3 months into a correction. As the market continued to correct into the summer of 2004, Apple formed 2 more bases, breaking out on August 25th, just 5 days after the Nasdaq Composite Index staged a 4th-day follow-through on August 18th, signaling the start of a new potential rally phase for the general market. As Apple made upside progress following the August 25th breakout to new highs, it more or less obeyed the 10-day moving average, as figure 5.27 shows. A few days before earnings were to be announced on October 13th, the stock dipped below the 10-day moving average and bounced off of its 20-day moving average. As it was coming up off the 20-day moving average, on the day that earnings were to be announced, Apple flashed a pocket pivot buy point as it came up through the 10-day moving average on volume that exceeded any down volume days in the pattern over the prior 10 days. After the close, Apple handily beat analysts' estimates, gapping up the next morning as it was off to the races. We played Apple very heavily in 2004, buying on the day of the gap up. Back then, we did not have knowledge of pocket pivot buy points, and looking back on these stocks with benefit of hindsight and the pocket pivot, we see many opportunities that could have been taken advantage of in stocks like Apple. After gapping up on the October 13, 2004, earnings announcement, Apple continued moving higher, figure 5.28, finding support along the way at the 10-day moving average. On October 27th, Apple staged a move up off the 10-day moving average with the proper volume action required for a pocket pivot buy point. The only potential problem with this particular pocket pivot was that its move started just above the 10-day moving average, rather than at the moving average, or just below it. In this case, the pocket pivot could be considered to be somewhat extended, something we will get into in more detail a little bit later. However, because of the very tight price action that preceded it, one could invoke some discretion and buy it anyway. Normally, because the pocket pivot began at a point somewhat above the 10-day moving average, it might be considered extended. Interpreting pocket pivots, however, requires analyzing them within the context of the price/volume action within the uptrend or base in which they form. In this case, the context of very tight price action before the pocket pivot made it buyable, even though it had the slight flaw of starting its move above the 10-day line. 7 days later, Apple had a small, intraday shakeout down to the 10-day moving average, bouncing right off the line and closing up for the day on volume that was greater than any down volume day in the pattern over the prior 10 days. First Solar, FSLR, provides an example of 3 different variations on a pocket pivot by point that form around the 10-day moving average, figure 5.29. The first pocket pivot, which forms on February 13, 2007, starts right at the 10-day moving average and moves up off the line with the required volume signature. The second pocket pivot in the pattern on May 4, 2007, occurs after the stock moves below the 10-day and 20-day moving averages and bounces off the 50-day moving average back up through the 10-day moving average on heavy volume, qualifying it as a pocket pivot buy point as well as a buy point on the move to new highs after bouncing off the 50-day moving average with big upside volume support. Finally, a third pocket pivot occurs on June 12, 2007, when FSLR moves below the 10-day moving average, bounces off the 20-day moving average, roughly, and ends up closing up on the day just above the 10-day moving average on volume that is the highest volume in the pattern over the prior 10 days. In general, proper pocket pivots that form on 10-day bounces do so from a position right at, or just below the 10-day moving average as the stock is traveling in an uptrend after breaking out from a proper chart base of 6 to 8 weeks or more. Paying close attention to the context of the pocket pivot by looking for constructive action in the pattern, such as very tight, sideways movement, leading up to the pocket pivot also helps one to determine when the rules can be bent just a little bit as a discretionary pocket pivot buy point is exercised, as we saw in figure 5.28. Improper or do not buy pocket pivot points. Just as there are proper pocket pivot buy points, there are also improper pocket pivot buy points. There are probably as many reasons or criteria to not buy a pocket pivot point as there are reasons or criteria to not buy a standard base breakout. Here, we cover some of the basic flaws that we have observed in pocket pivot points that fail. Given that the pocket pivot point is a relatively new discovery, we anticipate that this discussion will prove to be incomplete, as over time many more such flaws will likely be cataloged as our research into the topic continues. Something to watch out for are pocket pivots that occur when a stock takes a quick dip to the downside and then makes a straight V back up to new highs, such as what we see in GameStop Corp. GME, shown in figure 5.30. Notice how the pocket pivot on April 23, 2007, moves straight up to new highs after gapping down to a point just above the 20-day moving average 2 days earlier. This is a little straight down and straight up V-shaped type of move that is suspect, particularly after the stock has already been trending higher over several weeks, as GME was doing following its big gap-up breakout in late March. Generally, the stock will need more time to consolidate its gains. With this in mind, note how the second pocket pivot point in the pattern on May 15th was more constructive, as it moved up through the 10-day and 20-day moving averages after the stock was drifting downward on relatively quiet volume. It is important to determine whether a pocket pivot point may be too extended from its 10-day or 50-day moving average when it begins its move on the pocket pivot point day. Sometimes this can occur after the stock has been wedging upward, in other words, moving higher within its pattern on successively lighter volume. Normally, you want to see a stock drift downward on volume that is declining and drying up. When it drifts upward instead, this is called wedging action, and it is not constructive. Pocket pivots occur after wedging in a stock, such as we see in Yahoo. IHU, shown in figure 5.31. Notice how IHU wedged upward just before flashing a pocket pivot buy point on April 7, 1997, and this pocket pivot soon failed as the stock broke to the downside. IHU needed more time to set up, and through the end of May into mid-June, the stock moved very tightly sideways as the price/volume action provided a much more constructive context for the correct pocket pivot buy point which occurred in June and did set up again, becoming very tight within its chart pattern through the end of May and into the first 3 weeks of June. Again, we see that context is important. The wedging action in late March and early April provided an improper context for the April 7th pocket pivot buy point, while the tight, sideways price action in late May and early June provided a constructive and proper context for the correct pocket pivot point that occurred on June 20th. The same situation holds for GameStop Corp. GME, in Figure 5.32. From late January into most of February 2007, GME wedges up in its base formation before bursting up through the 50-day moving average with the requisite pocket pivot volume signature. However, as with the IPO example in Figure 5.31, this wedging rally preceding the pocket pivot creates a weak context for the pocket pivot, and it fails immediately when the stock violates the 50-day moving average. After the stock puts in more time building its base, undercutting the lows of the base in early March 2007, and then working its way back above the 50-day moving average toward the end of March, it flashes a correct pocket pivot buy point on March 26, 2007. This is clearly a pocket pivot as the volume, while just about average, is still higher than any down volume day in the pattern over the prior 10 days, as the stock moves right up off the 50-day moving average and back up through the 10-day moving average. A 10-day and a 50-day bounce type of pocket pivot buy point. Pocket pivot points that begin their move from a point that is above the 10-day moving average can in most cases be considered as extended, and hence risky to buy. Let's look at GameStop Corp. GME again, Figure 5.33, this time following up on the example we saw in Figure 5.30. Recall that the pocket pivot buy point on May 15, 2007 was a proper one, but note on Figure 5.31 that another pocket pivot point occurs 4 days later on May 21st, which begins from a point that is well extended from the 10-day moving average. This fails 3 days later. On July 9th, we see another, similar pocket pivot point that starts from a point that is extended from the 10-day moving average and is therefore flawed. It too fails in short order. A little earlier in this chapter, we looked at the 10-day bounce pocket pivot points that worked in First Solar's FSLR chart during 2007, but there were also some flawed pocket pivots in the 2007 chart that did not work, Figure 5.34. Pocket pivots that occurred on March 22nd and April 16th both started from points well extended up from the 10-day moving average, which immediately flags them as do not buy pocket pivot points. Keep in mind that when we talk about the pocket pivots, starting from points extended from the 10-day moving average, what we mean is that the extreme low point of the daily price range on the day of the pocket pivot point on the chart should be at a point right at the 10-day moving average or just below it. If that point is noticeably above the 10-day moving average, then the pocket pivot is considered to be extended, and hence is very risky to buy into. Similarly, we see a visibly extended pocket pivot point occur on Apple, Inc.'s Apple chart in September of 2006, Figure 5.35, that fails as the stock backs down and drifts below its 20-day moving average as it continues to consolidate. In general, extended pocket pivot buy points should be avoided unless there is an extenuating context, such as we saw in a different Apple example shown in Figure 5.35. Another type of flawed formation can occur when a stock corrects sharply off of a peak, and then just as quickly tries to come up, often forming a pocket pivot as it comes up the right side of a V-shaped up and down move. Riverbed Technology, Inc., RVBD, in Figure 5.36, illustrates this concept as it pulled back sharply below its 10-day and 20-day moving averages in early December 2006, and then shot right back above both moving averages in one fell swoop to flash a pocket pivot buy point. The real problem here is that the stock needed to put in more time consolidating its prior price gains, and a pullback just below the 10-day and 20-day moving averages was not enough to accomplish this. Generally, such a V-shaped pullback should come down and touch the 50-day moving average, a much more reliable area of support for such a sharp pullback off a price peak. Remember that context is everything, and this sort of break and recover type of move is not the constructive, quiet type of action we prefer to see preceding a pocket pivot buy point. While it may seem intuitive, it is worth mentioning that one should never buy pocket pivot points that are occurring within an overall downtrend, as opposed to a constructively downward sloping base formation. Baidu, Inc. Baidu was in a severe downtrend during the sharp bear market break in the latter months of 2008, but it still managed to flash a couple of sharp, upside pocket pivot point type moves on the way down, figure 5.37. Each of these failed immediately, and illustrate why pocket pivot points in a downtrend should simply be ignored. Even if a downtrend in a stock eventually turns out to be the left side of a cup-type base formation as it bottoms, and then starts turning back to the upside, one should still generally seek to buy pocket pivots that occur on the right side of such a cup, ideally in the top half of the base, or at least at or above the 50-day moving average, and generally not in the lower one-third of the base. Using moving averages as sell guides, stocks that have shown a tendency to obey or respect the 10-day moving average for at least 7 weeks in an uptrend should often be sold once the stock violates the 10-day line. If they don't show such a tendency, then it is better to use the 50-day moving average as your guide for selling. This is what we call the 7-week rule, and it can help prevent you from selling a stock prematurely if it is simply not its nature to hold the 10-day moving average, and it tends to do so often. Our studies of pocket pivots indicate that a pocket pivot buy point which results in an uptrend that is shown to obey the 10-day moving average for at least 7 weeks following the initial pocket pivot should be sold upon its first violation of the 10-day line. A violation is defined as a close below the 10-day moving average followed by a move on the next day below the intraday low of the first day. The example of Apple, Inc. Apple in figure 5.38 shows a stock that obeys the 10-day moving average all the way up until early December 2006, when it finally closes below the 10-day moving average, the day with the arrow pointing to it, and then the very next day moves below the low of that day. The inherent logic is that if a stock has been holding above its 10-day moving average for several weeks or more, it likely has been trending. Our studies show that after such moves back below the 10-day moving average, stocks will tend to rest for a while, allowing the nimble investor the opportunity to take a profit, and then lie back as the stock rests, consolidates, and potentially sets up for another move to the upside. The strongest stocks may not rest for very long, so it is important to be flexible and ready to jump on any new pocket pivot points that may appear in the pattern going forward. Dr. K's Laboratory, buying gap ups in leading stocks. There is nothing more alluring for a trader than a stock that is gapping up hugely on tremendous volume. Despite this, we tend to view gap ups as being extended and hence do not have the confidence to buy them, even though they may very well be signaling that the stock having the gap up is potentially a very powerful, big, winning stock. Sometimes big gap up moves can occur as simple new high base breakouts, and if the gap up move is within 5% of the high in the base at any point, it is buyable on that basis alone. We see this in GameStop Corp. GME in figure 5.39, which gaps up on August 23, 2007. Notice that GME had tried to break out earlier at the beginning of August but failed, pulling back and testing the lows of its base. This gives the base a sloppy look, but when it finally does break out of this base on a huge volume gap-up move, the strong gap-up action entirely exonerates any questionable price/volume action within the base. This is one basic rule of gap-up breakouts. They negate or exonerate any negative or weak action in the base, such as the erratic failed breakout of GME in figure 5.39. That said, gap-ups should not be bought back if the stock is in a clear downtrend. GME in this example is, however, a simple gap-up situation that is easily determined as buyable since it is also a clean new high base breakout. Apple, Inc. Apple in figure 5.40 is another gap-up move that is also a new high base breakout, and hence is buyable on this basis. Gap-ups that are also base breakouts are the most powerful base breakouts, and hence should almost always be bought when they occur in fundamentally strong stocks. Relative to other types of gap-up moves that are more extended, Buying gap-up breakouts is simple stuff. Gap-up breakouts that are immediately extended more than 5% to 10%, and gap-up moves that occur within an uptrend are far more tricky to buy. But it can be done using some rules we've come up with based on our studies of gap-up moves. The first rule of buying gap-ups is that it should only be done in quality, leading stocks with strong fundamentals. Buying big gap-ups in speculative $2 biotech or Canadian uranium mining stocks is not what we are talking about here. Gap-up moves in junk, that is to say stocks that do not represent fundamentally strong leadership, or at least potential leadership, should be avoided as gap-up buy candidates. Stick to stocks that trade at least $5 million a day in average daily dollar volume, and preferably much higher. A gap-up in a pattern should be fairly obvious, in that one should be able to eyeball on a stock's daily chart all the major gap-ups that are on the chart. We define a major gap-up as follows. 1. The stock gaps up at least 0.75 times its average true range ATR over the previous 40 trading days, though there are cases where the weeks leading up to the gap-up are volatile, such that 0.75 times its ATR is insufficient. Thus, if the gap does not look clear within the context of the chart pattern, it is best avoided. 2. Its volume on the gap-up day should be at least 1.5 times, or 150% of, the 50-day moving average of daily trading volume. Average true range measures the volatility of a stock, which can be calculated each day by using the greatest of the following. 1. The current high less the current low. 2. The absolute value of the current high less the previous close, or 3. The absolute value of the current low less the previous close. By keeping a running tally of this for the most recent 40 days, and maintaining a moving average of that tally each day, one can determine the average true range ATR over the preceding 40 trading days. In general, this means that the more volatile a stock is, the greater its gap-up must be in order for it to be considered a valid major gap-up. Sometimes, when dealing with new issues that have very little trading history, having a 40-day ATR or a 50-day moving average of volume is not possible. In such a situation, as we see in the example of Riverbed Technology, Inc., RVBD, shown in Figure 5.41, one can eyeball the ATR and determine whether volume increase is sufficient to be approximately 1.5 times or more of 50-day moving average of daily volume. Despite the fact that they can look somewhat scary to buy, most massive gap-ups in quality leaders that meet the conditions of a major gap-up can be bought, with the proviso that they hold the intraday low of the gap-up day's trading range. In Figure 5.42, Amazon.com Amazon gaps up on massive volume on October 23, 2009, and never trades below the intraday low of that day's trading range. Also note the tremendous power of the gap-up as expressed by the huge buying volume that comes into the stock at that point. Notice how the stock closes near the high of the day. Gap-ups can be bought at the beginning of the trading day, since the strongest names will often continue higher that same day after they gap up, such as in the case of Amazon. Buying a gap-up at the end of the day that closes at its high is okay, but you have to allow for that much more downside based on our gap-up sell rules, which we will discuss later in this chapter. Alternatively, one could buy half of one's intended position at the open and half at the close. The real trick with handling major gap-ups is where to sell if the stock starts to fail in the days after the gap-up. The basic rule is that the stock should hold the intraday low of the gap-up day, but once the stock is up and running higher from the gap-up day, where and under what conditions do you sell? Depending on the quality of the stock and its behavior around the 10-day and 50-day moving averages as it trends higher, this can vary. The two general sell rules for handling major gap-ups once a position is taken on the gap-up day, preferably near the lows of the intraday trading range, are as follows. Rule 1. Sell if the stock violates its 10-day moving average, for instance, closes under the 10-day line and then trades below the low of that day. Exceptions occur if 1. The stock violates the 10-day moving average in intervals of less than 7 weeks in duration, as a matter of course in its price history prior to the gap-up day. 2. the stock is in one of the following industry groups: semiconductors, retailers, or commodities, including oils and precious metal. Or 3, the stock has a market capitalization greater than $5 billion. For these 3 exceptions, it is better to use a 50-day moving average violation, defined the same way we would with a 10-day moving average violation, as your sell signal. Otherwise, the 7-week rule holds for stocks that show a tendency to hold above their 10-day moving average for intervals of 7 weeks or more within their price patterns prior to the gap up. If a stock adheres to the 7-week rule, then it is prima facie a stock that tends to hold the 10-day moving average. Therefore, once it breaks this moving average, it should be sold because it is now changing character by failing to hold the 10-day line. Conversely, stocks that violate their 10-day moving average all the time do not adhere to the 7-week rule. Hence, we use the 50-day moving average violation as the sell signal for such stocks. For stocks that meet the 7-week rule, then a violation of the 10-day moving average can be used as the point at which to sell at least half the position. An ensuing violation of the 50-day moving average can be used to sell any remaining balance. In the example of Intuitive Surgical ISUG from 2009, figure 5.43, ISUG violates its 10-day moving average within 3 weeks of the gap-up day on August 11th, and so does not meet the 7-week rule. ISUG is also a quality, large cap leader with a market cap well in excess of $5 billion. Therefore, we must use the 50-day moving average violation as our sell signal. This turns out to be the correct strategy, as even a sharp gap down on October 21, 2009, the day after the company announced earnings, was not enough to force the stock below the 50-day moving average as it held support there, retested it once more, and then turned back up to new highs. Figure 5.44 shows how well Baidu, Inc. Baidu held its 10-day moving average following the gap-up day of March 4, 2009. Baidu did not violate its 10-day line for 3 months after the gap-up, far longer than the minimum of 7 weeks required for the stock to meet the 7-week rule. Based on the rule, once Baidu violated the 10-day moving average, one should have sold at least half of any position taken on the gap-up, selling the rest once the stock had gapped down below the 50-day moving average on October 27th. There is always the option of simply selling the entire position on the first violation of the 10-day moving average, which is what we would be more inclined to do, since this allows us to lie back and wait for lower-risk re-entry points to show up, such as a possible pocket pivot buy point. A bird in the hand is always worth 2 in the bush, and as Bernard Baruch said, "I made my money by selling too soon." Rule 2. In the days following the gap-up, sell if the stock trades below the intraday low of the gap-up day. One can allow the stock to close first before deciding whether to sell on an intraday move below the gap-up day's intraday low. Stocks with higher volatility can be given a little more room than those with lower volatility. Also watch for pullbacks just under the intraday low of the gap-up day that are close to and hence might find support at the 10-day, 50-day, or 200-day moving averages. In the example of Riverbed Technology, Inc. RVBD in figure 5.45, note how the pullback after the gap-up dips below the intraday low of the gap-up day, but closes up on the day, finding intraday support off both the 10-day and 20-day moving averages. This particular day is also a pocket pivot buy point since the stock comes back up through the 10-day moving average on volume that is greater than the largest down volume day in the pattern over the prior 10 days. A 10-day bounce pocket pivot. It is always important once you are shaken out of a position by adhering to your stop-loss points that you continue to monitor the stock you have just sold for the right reasons in case it turns around and flashes some sort of buy signal, such as a pocket pivot buy point. In RVBD's case, if you sold the stock intraday as it was moving below the intraday low of the gap-up day, you could have turned around and bought it right back on the basis of the pocket pivot buy point. In this manner, we are ready to use all the tools at our disposal, including the pocket pivot point, to help us in handling a gap-up buy situation. Unlike RVBD, Apple Inc. Apple in figure 5.46 breaks below the low of its gap-up day on October 20, 2009, triggering a sell signal. Note that Apple also simultaneously violates its 10-day moving average only 6 days after the gap-up day, sealing its fate as a failed gap-up move. Apple does eventually back and fill for several weeks before moving to new highs again, but once the gap-up day fails, there is no point in continuing to play out the position. It should simply be closed out at a relatively small loss without further argument. Selling techniques using the 10-day and 50-day moving averages. Alert readers may have noticed that the sell rules for pocket pivot points are the exact same rules that are used for gap ups. This is because these sell rules are all based on the 7-week rule that we use for determining whether to use the 10-day or 50-day moving average as our guide for selling a stock, and this can be applied to any stock at any stage of its price trend. While the 20-day is used to some degree as well, we tend to focus more on the 10-day and 50-day moving averages as our primary guides for selling stocks or cutting back positions. It doesn't hurt to repeat the 7-week rule, which is that any stock that shows a tendency to hold above its 10-week moving average for intervals of at least 7 weeks should always be sold when it violates the 10-day moving average. Conversely, stocks that do not show this tendency should be sold when they violate their 50-day moving average. Sohu held its 10-day moving average for just about 2 months in 2003, figure 5.47, as it nearly tripled in price from late March 2003 to mid-June, before finally violating its 10-day moving average, at which point it should have been sold based on the 7-week rule. Since Sohu held its 10-day moving average for more than 7 weeks after it broke out in March of 2003, the 10-day moving average was your selling guide on that upside move. Once the stock broke the 10-day moving average, you would have sold it on this basis. You can then lie back and wait for another buy point, either a standard base breakout or a pocket pivot point, to show up. Crocs, Inc. Crocs gapped up very sharply in early May of 2007, figure 5.48, and launched higher. After the gap-up day, which was buyable based on our gap-up buying rules discussed in the previous section, Crocs held its 10-day moving average for more than 7 weeks, invoking the 7-week rule whereby the 10-day line would be used as your guide for selling the stock. It was not until late June of 2007 that Crocs finally violated its 10-day moving average. Remember that we use the term violated to specify the precise technical action we are looking for, which is that after the first day the price closed below the 10-day moving average. The stock must move below the intraday low of that first day to meet the definition of a moving average violation. The second day down through the 10-day moving average in figure 5.48, which also breaks down through the 20-day moving average, was the confirming violation of the 10-day line. Mosaic Co. Moss in figure 5.49 would also use the 10-day moving average as a selling guide following its breakout in late August 2007, since it did not violate the 10-day line for at least 7 weeks following the breakout. Note that while MOS did actually have 2 days where it did close below the 10-day moving average, it did not meet the definition of a moving average violation, because the stock never moved below the intraday lows of those first-day closes below the 10-day moving average, as the chart shows. This is important to keep in mind since you will never sell a stock for which the 7-week rule is invoked on the first day it closes below the 10-day moving average. You must first see the stock move below the intraday low of that first-day close under the 10-day line. This is one of the primary tricks to using the 10-day moving average as a selling guide per the 7-week rule. When a stock violates the 10-day moving average within 7 weeks of its buy point, whether a base breakout or a pocket pivot point, as AK Steel Holding Corp. Axe did in October 2006, figure 5.50, then the 50-day moving average is to be used as your selling guide. Once it finally violated its 50-day moving average in August 2007, it would have been sold with a 150% gain from the initial buy point in early October 2006. The 7-week rule is a very simple concept that works quite well. In general, The way to handle a stock that does not violate the 10-day moving average for at least 7 weeks from the buy point, whether a base breakout pivot point or a pocket pivot point, then a violation of the 10-day moving average can be used as the point at which to sell at least half of your position, if not all of it. If half the position is held following the 10-day moving average violation, then a violation of the 50-day moving average can be used to sell the other half. If a stock violates the 10-day moving average within 7 weeks of the buy point, then a violation of the 50-day moving average signals to sell the stock. One minor difference about how the 50-day moving average as our selling guide is that if the volume is appreciably greater on the first day, the stock penetrates the 50-day moving average, then it can simply be sold at that point. However, if the volume is not appreciably greater, then wait for the stock to meet the strict definition of a violation of the 50-day by moving below the intraday low of the first day close below the 50-day moving average before selling it. Putting IT all together. As we were careful to point out at the beginning of this chapter, pocket pivot buy points, gap up buy points, use of the 10-day and 50-day moving averages as sell guides, and the 7-week rule are not viewed as separate tricks, but rather as a holistic group of interrelated techniques that we have found very useful in practice. All of these components come together as concrete means of dealing with positions in big, leading stocks that have outstanding profit potential if handled properly. To illustrate this, let's go through 3 trading simulations, for lack of a better term, with 3 subject stocks from the market rally that began in March 2009. 1. Apple Inc. Apple. 2. Cerner Corp. CERN. 3. Green Mountain Coffee Growers GMCR. For readers interested in similar real-time analysis of individual stocks, see the Follow the Stock section on our website, www.virtuofselfishinvesting.com. Apple Inc. Apple 2009. Apple Inc. Apple flashed a pocket pivot buy point on April 16, 2009, figure 5.51, nearly a month after the general market logged a follow-through day, signaling a new general market rally phase. On the pocket pivot day, volume was the highest in the prior 7 days, and was also higher than any down volume day in the prior 16 days, thus meeting the 10-day minimum required for a proper pocket pivot volume signature. Apple began its move on the pocket pivot day reasonably close to the 10-day moving average, which qualified as a buyable pocket pivot. A second pocket pivot on May 26 came right off the 10-day moving average, at which point one could buy enough shares to fill out a full position. Notice that Apple does in fact violate its 10-day moving average relatively quickly after each of the 2 pocket pivot buy points. This dictates that we use the 50-day moving average as a selling guide for now. As Apple continued higher, it presented another pair of pocket pivot buy points on October 2nd and October 19th, 2009. Figure 5.52. Volume on the October 19th pocket pivot was clearly the highest in the prior 10 days, while the volume on October 2nd qualified because it was higher than any down volume day in the prior 3-1/2 weeks. The day after the October 19th pocket pivot on the gap up was buyable, but would have stopped you out of your position on the move below the intraday low of the gap up day. On December 7th, Apple violates the 50-day moving average, and since applying the 7-week rule dictates that the 50-day line will be used as a selling guide, the stock is sold. During the 2009 market rally, Apple was a big stock leader that was supported every time it pulled back to its 50-day moving average, which after a while became something of an insurance policy as institutional investors came in to support one of their most favored growth holdings, no doubt, Cerner Corp. CERN, 2009. Cerner Corp. CERN was a quiet leader in the 2009 market rally and had a habit of staging new high base breakouts on less than convincing volume. Promises of material, increased government spending on information technology, or IT, for the medical industry were a driving theme for CERN's price move, and there were enough pocket pivot buy points that could have been utilized to take a position in the stock. The first pocket pivot point presented itself on April 24, 2009, figure 5.53. and a 10-day moving average violation occurred within 7 weeks of that buy point on June 3rd. Applying the 7-week rule indicates that we will use the 50-day moving average as a guide for selling the stock. Also, at around $6 billion in market capitalization, CERN was a large cap stock, which also argues for using the 50-day moving average as our selling guide. On July 7th, CERN actually penetrates the 50-day moving average, but volume is only 22% above average daily volume, so we would then wait to see if the stock moves below the intraday low of this first-day penetration of the 50-day line in order to define it as a violation, and hence a sell signal. Since this did not happen, we do not sell the stock, allowing it to climb back above the 50-day moving average and soon to present another pocket pivot buy point on July 23, 2009. Even though volume is only average, it is the highest volume in 11 days, qualifying as pocket pivot volume, and occurs after 4 orderly, low-volume down days. As well, prior strength was seen in the pattern with the huge up volume day on July 16th, 6 trading days before the pocket pivot buy point. On September 1, 2009, CERN violates its 50-day moving average, which the 7-week rule indicates would be our guide for selling the stock. However, this is an example where an exception can be made, because while the stock is below the 50-day moving average, it is also at an area of support defined by prior lows in the pattern on July 23rd and August 19th, along which a dotted line has been drawn in figure 5.54. CERN finally did violate its 50-day moving average with a valid sell signal at that point on November 11th. The stock backed and filled a bit more under the 50-day moving average before presenting a pocket pivot on December 18th, figure 5.55. As we discussed previously in the section on pocket pivots under the 50-day moving average are risky to buy, and this particular pocket pivot is in fact below the 50-day line. However, it did work for a period of time as the stock broke out to new highs on January 5, 2010, but this breakout failed soon thereafter, and the stock violated the 50-day moving average on January 29, 2010. In this case, however, it would have been prudent to begin cutting back and selling CERN off as it broke down through its new high base breakout pivot point at around the 85 price level. Note, a minor pocket pivot emerged on January 4, 2010, but the same sell rules would apply as CERN's breakout soon failed. Green Mountain Coffee Roasters, GMCR, 2009. After one of the worst market corrections in stock market history, Green Mountain Coffee Roasters, GMCR, showed signs of life from November 2008 through February 2009. Even though the major averages broke below their lows set in November 2008, GMCR held its ground and resisted the general market downtrend in February. On March 12, 2009, the Dr. K market direction model issued a buy signal as the market had a bona fide follow-through day. The nice thing about the systematic portion of the market direction model, which will be discussed in the next chapter, is that it does not care how bad things look on a fundamental basis, because it focuses purely on the price/volume action of the major market indices. On March 16th, just 2 trading days after the follow-through day, GMCR flashed a pocket pivot buy point that was also a new high base breakout. But with volume only 12% above average, it was insufficient for a standard O'Neill-style base breakout pivot buy point, figure 5.56. However, because the volume on that day was higher than any down volume day in the pattern over the prior 10 days, it met the proper volume signature required for a pocket pivot buy point. By closing mid-bar, however, it was somewhat weak, but nevertheless fulfilled the pocket pivot criteria, so a small position in GMCR could have been bought on that day. On March 31, 2009, GMCR presented another pocket pivot buy point. Note how the low of the day rests right on top of the 10-day moving average and finishes the day up on appreciably higher volume. Additionally, the trading days leading up to this pocket pivot point were below average volume days, a sign of healthy consolidation. Note that April 9th is not a pocket pivot buy point because it is slightly extended. This should be visually clear, but an additional clue is that the low of its trading range is above the 10-day moving average. April 22nd, on the other hand, qualifies as a high-quality pocket pivot buy point because of the strong, high volume, and also because the days leading up to this pocket pivot are orderly, having very tight price closes over the prior 4 days leading up to the pocket pivot on the 22nd. Hence, the context of this pocket pivot is very constructive. Another pocket pivot buy point on April 28th qualifies for the same reason. By the time GMCR had its gap-up buy point on April 30, investors probably had accrued a fairly substantial position in the stock if they had been buying at the pocket pivot points. Depending on one's position sizing risk tolerance levels, one could add to their position here. If investors own no GMCR, they could initiate their position here. As with most all gap-ups that meet our requirements, it is best to buy at the open of the trading day. Stocks often will move higher from their gap-up point for the rest of the trading day. Our requirements for buying at the open are that the market has been behaving bullishly, that is, the market direction model is not on sell. The stock meets our minimum liquidity requirements. The stock has not been in a downtrend, and the stock is fundamentally strong. Continuing along, we note that June 4th is not a pocket pivot point because it is slightly extended with the low of its daily price range visibly above its 10-day moving average, figure 5.56. The same reasoning would apply to June 5th and June 8th, even though volume is high on all 3 days. On June 16th, GMCR violates its 10-day moving average for the first time in more than 7 weeks, so at least half the position can be sold here. On July 8th, GMCR touches its 50-day moving average and could be bought here for those who prefer to buy on weakness around the 50-day moving average. Buying on strength versus buying on weakness within an uptrend is a matter of trading personality. July 15th shows a pocket pivot because it just barely meets the volume requirements, and even though the low of its trading range is above its 10-day moving average, it is not extended when taken in context of the overall chart pattern, as the stock is just breaking out of a base. So part or all of the GMCR sold on June 16th could be bought back here. While the price paid on July 15th is slightly higher than the price sold on June 16th, capital used for GMCR was not at risk in GMCR, as it traded mostly sideways during this period. Moving to figure 5.57, we see that, on July 20, GMCR could be bought again on the basis that it had hit its 50-day moving average and was now moving to new highs on high volume. This is a standard new high breakout following a bounce off the 50-day moving average. The stock then flashes another pocket pivot buy point on July 30th, as the stock undercuts its 10-day moving average and then finishes with a strong close on huge volume. The wide trading range for that day is due to the bulls wrestling with the bears over its earnings report, and by the end of the day, the bulls had won. Then a few days later, a weak pocket pivot that closed mid-range as it stalled a bit occurred on August 7th. GMCR is finally sold on August 18 as it violates its 50-day moving average. Important note, the 10-day moving average violation on August 11 is not a sell signal, because while GMCR obeyed the 10-day moving average for at least 7 weeks prior to its 10-day violation in June, and thus was sold upon violation of its 10-day moving average, the count is reset once the stock reverses trend either by basing for at least 3 weeks or at least touching its 50-day moving average once. GMCR violates its 10-day moving average in its 5th week after resuming its uptrend the week of July 13. Thus, the 50-day moving average would be used as the sell guide. Late in the year, GMCR tried to break out to new highs again in late September, but failed on that breakout attempt. Interestingly, the stock built an entirely new base and flashed a pocket pivot buy point on December 18, 2009, and continued to move higher into January 2010. Note that had an investor initiated her first buy in GMCR on July 15th, and then continued to buy on July 20th and July 30th, then she should pay heed to the maximum 7-8% sell-loss rule. Had one bought equal dollar positions at the close on each of these days, one would have had an average cost of 65.45. One might not want to wait for a violation of the 50-day moving average at 58.13, since this is an 11.2% loss from their average cost. On the other hand, a stock like GMCR is relatively more volatile, so that, armed with this knowledge, one might institute a 10% stop loss for such a stock. In practice, however, you want to limit your losses to as little as possible. Conclusion: by fully utilizing the concepts of pocket pivot buy points, gap up buy points, and the 7-week rule with respect to the use of the 10-day and 50-day moving averages as sell guides, all in combination with orthodox O'Neill buying rules such as standard new high/base breakout pivot points, we can gain an edge in our position entry points relative to where the crowd might be compelled to come in and buy a stock. As well, these techniques provide critical assistance in how we handle a big, winning stock during its uptrend, both adding to and cutting back our positions along the way as the stock flashes by points, and moving average violations that help us handle risk and maximize our profit exploitation of such a stock. This chapter has provided a good deal of the meat with respect to how we maneuver the twists and turns of the market as we handle a potentially hugely profitable position in a big leader, and concretely answers the classic question every investor is faced with when they first buy a potentially big leading stock: now what?